Hi candidates, welcome to another session of Manifested Online Classes. My name is Joseph Kimani, your lecturer for Advanced Financial Reporting and Analysis. So in this session, I want us we start or basically look on topic number 5 in this particular unit called Advanced Financial Reporting and Analysis, and the topic is Public Sector Accounting Standards. And basically, this is an extension of what you covered in financial reporting and analysis because you did a similar topic. And what you're going to cover as far as this particular topic is concerned are various international public sector accounting standard. So we are going to look on IPSAS to do with the segment reporting. We're also going to look on another IPSAS to do with the related party disclosures, what now the public sector entities should disclose relating to transactions with the related parties. Also, we're going to look on another two standards there, or basically two other standards there, IPSAS 21 and also IPSAS 26, which deals with the impairment of cash generating asset and also impairment of non-cash generating asset. And then from there, we also look on something to do with the disclosure of information by the general government sectors, the information to be disclosed by the public sector entities. And also we look on something to do with the consolidated or the preparation of consolidated financial statement by public sector entities. And then we also look on how to account for the investment in associate and joint venture. So basically in that topic number 5, we are going to look on 5 subtopic. And basically those particular 5 subtopics, as we are going to see, they are governed by different IPSAS or by different international public sector accounting standards. So I want us to go straight to the first standard here, that is IPSAS 18. But even before we look on that, it is important first of all to recall that when we talk about public sector accounting, this is basically the process through which now the public sector entities prepare their financial statements. So what are public sector entities? So these are those particular entities which are usually accountable to the members of the public. These are those particular entities which provide services to the members of what? Of the public. And those entities include, number 1, the parastatals or the statutory corporations. Number 2, we have the county government. We also have the central government. And also we have what we refer as charitable organizations. So all these particular entities, they fall under public sector entities, and they are expected at the end of each year to prepare their financial statement. Basically, they should do that in compliance or basically in accordance with that with certain standards which are known as international public accounting standard. So I want us to go straight to the first standard here, which we need to cover under this particular unit here, that is Advanced Financial Reporting and Analysis, and that is the IPSAS 18. Now, this particular IPSAS 18 is drawn primarily from IFRS 8, which is one of the subtopics which we have already covered. And this particular standard here, that is IPSAS 18, it requires the public sector entities to be able to identify their segments, of which in this case, when we talk about a segment of public sector entities, we are talking of distinguishable activities or a group of activities undertaken by public sector entities. So once a public sector entity has been able to identify its segment, then it should go ahead and basically provide separate information about those particular segments. So at a later stage, we are going to look on how these particular public sector entities prepare the segment report in accordance with the IPSAS 18. But even before we do that, we can look on the introduction to this, and we say that IPSAS 18 requires public sector entities to identify distinguishable activities all group of activities as segments or as reportable segments, and provide, or in other terms we can say, or report their financial information. Information. So basically what that means that any public sector entity, be it a county government, be it a parastatal, basically the national government, it is required by this particular standard to be able to identify its segments. And in this case, we are saying the segments of these particular entities will be what? Will be distinguishable activity. For example, if a parastatal, even as a county government is undertaking a certain activity, then that particular activity we can say it is what? It is a segment. So therefore, once now those particular public sector entities identify now the segment which you are saying are distinguishable activities or a group of activities, then such an entity is required now to proceed and provide separate information about those particular what? Activities. So which information should be provided as far as these particular activities are concerned? The information to be provided include information to do with the segment revenue, the revenue for each segment, the information about the segment expenses, and also asset and liabilities of each what? A segment. But we are going to look on that in details when looking on the format, or basically how a segment report is prepared under what you refer as IPSAS 18. So then from there we can define what is a segment under IPSAS 18. So let's look on the definition of a segment. So first of all, it is important to note that a segment here is defined differently from how a segment is defined under IFRS 8. If you can be able to recall, we defined an operating segment under IFRS 8 as a component of an entity, number one, which engage in business activities from which it earn revenue and also incur cost. Number two, it discrete or basically separate financial information is available. And number three, we said its operating results is regularly reviewed by the entity's chief operating decision maker. Number one, for him to be able to assess its performance, and number two, to know the resources to be what? To be allocated. That's how we defined an operating segment under IFRS 8. But under this particular standard here, that is IPSAS 18, a segment here is defined to be a distinguishable activity or a group of activities by a public sector entity, and basically which must be reported on. So therefore, you can say that a segment, this is a distinguishable activity or a group of activities, of an entity, for which it is appropriate, to separately report its financial information, for two purposes, or basically we can say for the following purpose. So number one is basically to evaluate the entity's past performance. Number one, for evaluating the entity's past performance, in achieving its objectives, and number two, for making decisions, decisions about future allocation of resources, future allocation of resources. Yes. So basically that is the definition of a segment at IPSAS 18. And we are saying if you compare this particular definition here with the definition of an operating segment at the IFRS 8, you can be able to see there is a difference. And therefore, it is important to note that because mostly you may come across a question whereby the examiner has or requires you to differentiate or basically to define an operating segment at the IFRS 8 and also at the IPSAS what? At the IPSAS 18. Now, in this case, we have two types of segments. So we can talk of types of segments. Segments at IPSAS 18. So IPSAS 18 generally classifies segments into two. Number one, we have something called the geographical segments. And number two, we have what we refer as the component segment. Or in other terms, we can just refer to this as a activity component. So basically is a type of a segment which provide certain types of activity. So therefore IPSAS 18 basically classifies now the segment into those two categories. So then from there what I want us we do is basically we look on how a segment report is presented or is basically prepared under this particular standard here. So let's look on the format of a segment report. Format of a segment report. And equally in terms of how we prepare the segment report at IPSAS 18 is also quite different from the format which is used at the IFRS 8. So therefore let's look on that particular format here. So in preparing this particular segment report at the IPSAS 18, first of all, we have the details column here. Followed by columns equal to the number of segments. So, and remember what you have said is that when talk about the segment here, at the public sector entity, we are talking of a group of activities or distinguishable activities. So mean that you can be given a segment to be something like the primary services. Also maybe you can be given something like the secondary services. Undertaken by a public sector entity and maybe other services. So we assume that that particular public sector entity undertake those three activities: primary services, secondary services, and then we have other services, which now shall be regarded to be to be segment. And then we have another column here for elimination. And basically this column is for eliminating any intersegment transaction such that that transaction will not go to the last column, which automatically is the total column. So those basically should be the number of columns you have: the details column, columns equal to the number of segment, the elimination column, and the total or the consolidated column. So what do we start with here? So always we start by recording the revenue. Of each segment. And this revenue for this segment can come from various sources. Number one, we have the revenue which comes from the budget appropriation. So basically when we talk about appropriation, this is basically the money which is allocated to a public sector entity to be able to provide various services, and this money is allocated from the consolidated fund. So we get the total here, and basically because this is an external source of revenue, we take it to the last column. Then we also have things like the other source of income, which may be fees, from external services. So this is basically the amount of money collected by a public sector entity from the services it provides. Anytime you go to a government department like immigration department, the RAD department, and so on, so you're looking for some services, you're usually charged a small fee. So basically, this is still an external source of revenue. We take it to the last column, and then from there we also have something called the inter-segment transfer. So when talk about inter-segment transfer, this is basically money which is received by one segment from the other, or basically this is an internal source of what? Of revenue. So what we do, we get the total and we put it here as a negative because that is an internal source of what? Of revenue. And then from there, we come and we get the total segment revenue. We get the total segment revenue. This one we underline it, and you have to remember that this total revenue will basically comprise the internal and also what? The external sources of revenue. So in the elimination column, what we do is that we eliminate now the total inter-segment what? Revenue, such that the revenue now which we take now to the last column, this one, this only comprises of the external what? Of the external revenue. And this particular amount which is here, we don't underline it because we use it down here in terms of computing the surplus or the deficit for what? For that period. So after recording now this information about the segment revenue, so we proceed and we record information about the segment expenses. The segment expenses. So the expenses of the segment may include wages, salaries, and wages. So we record that here and take into account this is a cost or basically an expense. So when recording it here, we record it as a negative. So we also record other expenses such as what? Such as the depreciation, plant and equipment, and so on, and any other expense. And then what we do, we get the total expenses here. We get the total expenses. And then what we do is that this particular total expenses, we take that now to the last column, such that we less that now from our total revenue. We less that from the total revenue. And whatever you get there will be a surplus or basically the deficit from the operating activity. So what the name given to that is, remember, first of all, these are total expenses. These are total expenses. So whatever you get here, it can be a positive or basically it can be a negative. So if it is a positive, we refer to that as a surplus. We refer to that as surplus or basically the deficit. If a negative deficit from operating activities. From operating activities, or in other terms from operation. We also have to recall that these particular public sector entities do not operate with an objective of making profit. So therefore, the difference between the revenue and the expenses is not a profit or a loss. It is basically a surplus or what? Or a deficit. So therefore, we are saying a positive figure here is a surplus, whereas now a negative figure is what? Is a deficit. And then we proceed and to this we do what? And in some cases you can also be given something called the unallocated central expenses. So if you're given unallocated central expenses, you also come and capture it here before computing that surplus or basically the deficit for the period. So you can be given unallocated central expenses. Unallocated central expenses. So basically these are the expenses incurred by a public sector entity but not directly attributable to a certain what? Segment. So we take it to the last column there, and then what we do, we get the surplus or the deficit from operation or basically from operating activities. So I've said if it's a positive is a surplus, but if a negative here is what? Is a deficit. And then to this particular amount here, we come and we add something called the interest income. Interest income. Remember, this income here is not from operation, so that's why we are adjusting it from the to the surplus or the deficit from what? Operating activities. And then to this we also less the interest expenses. Which is still not an operating expense. So basically, this is the expense which will be incurred by a public sector entity as a result of having borrowed some what? Borrowed some finances. So interest income, we add it, whereas now the interest expenses, what we do, we basically less that. We less that from our surplus or deficit, and then from there what we do here, we get the surplus or the deficit for the period. Or basically for the year. So whatever you get here, if a positive is a surplus, if a negative is what? Is a deficit. And then next, now we proceed and record information about the segment assets. Assets. So basically we record asset of each segment here. Remember, in our case, we have three segments here. The primary services, secondary services, and then we have other services. Get the total, take it to the last word, a column. And then to this, you may also be given central unallocated assets. So these are basically those particular assets which are owned by this public sector entity. But these particular assets, we cannot say that they are directly owned by a certain what? A segment. So therefore, to this, what we do is that we add central unallocated assets. Central unallocated what? Assets. And basically unallocated asset, take into account these are assets not identified with a particular segment. So we don't record that at the individual segment, but we take that now to the last column there. To the last column, and wherever you get here is the consolidated what? Asset. So finally, after recording information about the assets, we record the information about the liabilities. So mean that next we record information about the segment liabilities. So we record liabilities of each segment here. Primary services, secondary services, and other services. We get the total. We take it to the last column, which is now the total or the consolidated column. And equally here, we also add unallocated central liabilities. So basically, these are the liabilities of this particular public sector entity, but not identified with a particular segment. We get the total here, which we refer to as the consolidated liabilities. Or in other terms, the total what? Liabilities. So that's basically how we present, or basically how we prepare this particular segment report under IPSAS 18. And equally, you can see that we have a slight difference in terms of how we prepare a segment report under IFRS 8, because we have already looked on how we prepare a segment report under what? Under IFRS 8. That is International Financial Reporting Standard number what? Number 8. So therefore, that is it. And I think with that, we can be able to look on an illustration question regarding the preparation of this particular segment report. So let's go through that particular illustration. We see what we are told, and equally what the examiner was requiring. Yes, so the question reads, the following information related to the Ministry of Trade and Industry for the fiscal year 2013 and 2014. So we are given a number of services there: primary services, tertiary services, special services, and other services. Remember what you have said is that as per IPSAS 18, these particular services which are provided by this Ministry of Trade and Industry, these are segment. These are what? Segment, because you have defined a segment to be activity or basically distinguishable activity or a group of what? Activities. So what you're given there, we're given the segment revenue or basically the revenue for each segment. We have the money which came from the appropriation or revenue which came from budget appropriation as fees from external services, and then we have the inter-segment transfer, and then we have the segment expenses which include salaries and wages, depreciation, other expenses, and then we have information about asset and liabilities. Then we have some additional information about whereby we are given unallocated central expenses which amounted to 70 billion. Number 2, we are given interest and also interest expense and interest revenue which amounted to 20 billion and 40 billion respectively. And number 3, we are told unallocated central assets and unallocated liabilities amounted to 350 billion and 400 billion respectively. So we have that particular information, and what now the examiner is requiring is we prepare a segment report which is consistent or basically consistent with the requirement of IPSAS 18 which governs now the segment reporting for the Ministry of Trade and what? Industry to be included in the financial statement of what? Of the ministry. So what we are required to do as far as that particular question is concerned is we prepare a segment report. Remember, we are going to prepare that particular segment report using this particular format which we have done what? Which you have already covered here. Yes, so we should start now here with the title of whatever we are preparing. So we start with the name of the ministry, and basically we are told that this is the Ministry of Trade and Industry. Ministry of Trade and Industry. What we are required to prepare is a segment report. Segment report for this particular ministry, which is for the fiscal year. For the fiscal year 2013-2014, 2013-2014. So what do we need to, or how do we prepare this particular segment report? Remember, I've said always we start with the details column, and basically columns or followed by columns equal to the number of segments which are given, and then we also have elimination column and the total column. So therefore, we are going to leave some space here for recording our details, and then in our case we are given a number of segments here which include primary services, and also our figures are given in billion of shillings. Then we have tertiary services, then we have special services, and then we have other services, and basically therefore this will be our four segment. And then next we have the elimination column. And then we also have the total column, and our figures here will be in billion of shillings. So this is the elimination column like that. So what do we start with here? We always start by recording the information about the segment revenue. And that information is given to us in our question there. So basically we have three sources of revenue. So we have the revenue which came from the budget appropriation. So we record that particular information here the way it is given. We have 480, we have 400, we have 220, and then we have 230. So basically we're going to get this particular total and we take it to the last column there. But before we do that, let's record the other source of income, which is fees from external services, which is still an external source of revenue. We have 50 billion, 40 billion, 20 billion, 60 billion. Equally, we're going to get the total. We take it to the last column. And then we also have now the inter-segment transfer. Inter-segment transfer, in this case, we have said that this is an internal source of income. We have 100 billion, 60 billion, 60 billion, and then 70 billion. So because this is an internal source of revenue, so what we do, we get the total and then we do what? We eliminate it in that particular column there, which is known as the elimination column. So what we need to do here, let's get these totals. Let's get these totals, because also here we need to have the total revenue for each segment. So we get the total revenue for all the segments. So let's first of all get the total revenue from budget appropriation. So we have 480 plus 400 plus 220 plus 230. 230. So which is giving us a total of 1330. And because this is an external source of revenue, we take it to the consolidated column. We take it now to the last one, column, which is also known as the total column. The same case with the fees from external services. This is still revenue from external sources. So once we get the total, we take it to the last column, which is the consolidated or the total column. So we have 50, 40, 20. And then finally we have 60 billion. So which will give us a total of what? 170. So and then we have the inter-segment transfer, which you have said is an internal source of revenue. So we have 100 plus 60 plus 60 plus 70. So this one we record it in the elimination column here as a deduction, such that once we add across this particular revenue there, it will not go to the last column, because we have said what we record in the last column there is only the external or basically is only the revenue which come from the external what sources. Any revenue from the internal sources, like transfer from one segment to another, that one should not be recorded in the total or the consolidated what column, because this is basically like a transfer. This is not a revenue, but rather it is a transfer from one segment to another, or maybe from one government department to another. So and then what we need to do, we need to get the total revenue for individual segment. Starting with the primary, we have 480 plus 150, which will give us 630. The same case here, this will be 500. The same case here, this will be 240, 300, 300, 360. And then we eliminate the internal source of revenue, because this is the external and also internal. So in the elimination column here, what we do, we eliminate now the internal revenue, such that what we have in the last column here, which will be 15, this only comprises of revenue from external what sources. And basically what you have said is that whatever you get here, don't underwrite that, because you're going to use that figure down here when computing the surplus or what the deficit from operating activities. So having done that, having recorded now the revenue, we proceed and record information about the segment expenses. Segment expenses. So in our case, we are given that information. You just need to bring it here in our segment report. So first of all, we have salaries and wages. Salaries and wages. We have an amount of 390, 310, 130, and then we have 130. There is something I said that because this is a cost or this is an expense, when recording it here, we record it as a negative. Yes, so then from there we have depreciation. We have depreciation. Depreciation, we have 90, 70, then we have 50, and then we have what? 70. Okay, so then finally we have other expenses. Other expenses, we have an amount of 120, we have an amount of 110, we have an amount of 100, and then we have amount of what? Of 90. So then from there what we do, we get the total segment expenses. So let's get the total segment expenses. Total segment expenses. So basically by adding the expenses of each segment here. So we have 390 plus what? Plus 90 plus 120. So we have 390 plus 90 plus 120. 120, basically that will give us 600. So then here we have 310 plus 70 plus 110, which is 490. And also we have to remember to record this inside the bracket as a negative figure because it's an expense. So here we have 130 plus 50 plus 100, so which will give us 280. And the last segment we have 200, 290. 200, 290. And then what we do is that we come and we add these expenses here. You see the total expenses for each segment. Then we have to add all these. Whatever we get, we take it to the last column so that we less that now from the total revenue of each segment. So let's do that. So we have 600 plus 490 plus 280. 280 plus what? 290. So that will give us a total segment expenses of what? 1660. And before we deduct that from the segment, total segment revenue, there is another information which is given in the additional information number 1, whereby we are told there was unallocated central expenses. These are still the expenses of the segment, but they have not been identified with individual what? Segment. So what we do here, remember there is a figure of 1660. So we also come and capture those particular central unallocated expenses, or basically unallocated central expenses. We are saying that these are expenses not identified with a particular segment, and we take that now to the last column, which is 70 billion. So and actually we less the two expenses from the revenue there, and whatever you get here can be a surplus or a deficit from what? Operating activities. And basically in our case I think we are going to have a negative there, which is basically a deficit. If we get a negative figure, is a deficit from operating activities. From operating activities. So how much will be that? So we have 1500 minus 1660 minus 70. So basically that will give us negative 230. Negative 230, which is basically what? A deficit from operating what? Activity. So after getting that, then I've said we adjust a particular deficit or surplus with now interest expense and interest what? Revenue. And in the note number 2, we are given interest expense and also interest revenue. So what we need to do first of all is we add interest revenue. Interest revenue, and basically that interest revenue is given as a total figure, so mean that this has not been identified with a particular segment. The interest revenue here is 40 billion, which we add there, we add here 40 billion, and then we also have now the interest expenses, which we less. Interest expenses, and equally you can see here we are not given the interest expense for individual segment, but we are given the total. So we take that now to the last column, which is a figure of what? Of 20. And basically we less that now from our what? From our deficit from what? From operating activities. So whatever you get down here will be the deficit for the period. So we will refer to that as deficit for the period. So how much will be the deficit for the period in this case? We have 230 billion plus 40 minus 20. So this will give us a deficit from or for the period as 210 billion. 210 what? A billion. So next we proceed and record information about the segment asset, and then the segment what? Liabilities. But always we start by recording information about the segment assets. So I think we can do away with whatever you have here so that we can record information about the segment assets and segment liabilities. Yes, so let's first of all record the information about segment assets. So, and that is still given at the paragraph 1, whereby you're given the segment assets for each segment: 540, 500, 340, and then we have 300. So basically we get the total, we take it to the last column, and then to this there is something which we add, which is given in note number 3, and that is unallocated central assets. Unallocated central what? Assets. So these are basically those particular assets not identified with any segment, and such assets we record them in the last column here. In the last column here, which is a figure of 350 billion. And then what we will get here are the consolidated assets or the consolidated segments assets. So let's get this total here. We have 540 plus 500 plus 340 plus 300. So that will give us a total of 1680. So we add 350 plus 350, which will give us consolidated assets of 2030. So next we record information about the segment liabilities. We need to record information about the segment liabilities here. We record information about segment liabilities. And also that particular information is provided in our question here, is provided in our question there. So the liabilities for the first segment are given as 250. We have 150, we have 80, and then we have 110. So what we need to do, we get the total, we take it to the last column there, and then to this we also add what you're given in note number 3, and that is unallocated liabilities. Unallocated liabilities is those liabilities not identified with a particular segment. And we are given those particular liabilities as an amount of 400 billion. And then finally, what we do, we get the consolidated liabilities. So let's first of all we get the total segment liabilities. We have 250 plus 150 plus 80 plus 110, and that will give us a total of 590 billion. And then we add that now to the unallocated liabilities of 400 which will give us now the consolidated liabilities here to be how much? To be 990. Remember, we have said that this now will be what? Will be the consolidated liability. So basically that is it. That what was required as far as that particular question was is concerned. So the examiner was requiring the preparation of a segment report in compliance, or basically in accordance with IPSAS 18. And basically that's what you need to know as far as that particular standard is concerned, and that is IPSAS 18. For now is a bye. See you in the next session.
Hello and welcome back to the lesson. The subject is Advanced Auditing and Assurance. Today we are going to study the subtopic Subsequent Events. Then we will consider the audit work that is done between the financial year end and date of signing the financial statements. But first of all, we're going to define subsequent events. Then we'll give a few examples of subsequent events so that you can be able to understand the meaning of subsequent events. Now, candidates, what are subsequent events? Subsequent events are events or transactions that occur after the financial year end, but before the date when the financial statements are authorized or issued. So assuming the financial year ends on 31st of December and the financial statements are authorized and issued, say, in 30th of January. So the time that lapses or the events that takes place between the date of signing financial statements and the financial year end, the events that occur, the transactions that take place between that time are what we are referring to as subsequent events. And such events can have a significant impact on the entity's financial position. It can have significant impact on results of operations as well as disclosures. And there are two main types of subsequent events. There are types of subsequent events that can be classified, let me say, into two categories. We have what we call recognized subsequent events, recognized subsequent events. That's the first category. Then there is the unrecognized subsequent events. But let's first of all define recognized subsequent. Now, what are recognized subsequent events? These are events that provide additional evidence about conditions that existed at the financial year end. Remember, we've said that subsequent events are transactions or events that take place between the financial year end and the date of signing the financial statements. I repeat, subsequent events refer to events or transactions that occur after the financial year end, but before the date of signing the financial statements. And there are two main categories of subsequent events. The first one is recognized subsequent events. Recognized subsequent events are those that provide additional evidence. They provide additional evidence. These are events that provide additional evidence about conditions that existed at the financial year end, all right? And require adjustments to the financial statements. And they require adjustments to the financial statements. So, number one, recognize subsequent events. These are events that happen between the date, the year end, and the date of signing the financial statements. Another feature about this event is that they provide additional evidence about the position, about the conditions that existed at the financial year end. And then they require adjustments to the financial statements. In other words, these events affect the financial statements recognition, measurement, and disclosure. They affect the financial statements. These events affect the financial statements. Now, to make you understand clearly, I'll give a few examples of recognized subsequent events. One obvious example is a settlement of litigation. Settlement of litigation. If a lawsuit or legal dispute is settled after the financial year end, then the settlement amount may need to be recognized and reflected in the financial statements. So number one, this settlement of litigation happened after the financial year end. Do you understand? It happened after the financial year end. So we are saying such an example is an example of a recognized subsequent event, which we have said it affects the financial statements, it needs to be adjusted, and it provides additional evidence. And therefore it has to be reflected in the financial statements. An adjustment has to be made. If a legal dispute is settled after the financial statement, but before the date of signing financial statement, then that has to be reflected in the financial statements. Number two is purchase or sale of assets. Purchase or sale of assets. Now, if a significant acquisition or disposal of assets occurs after the financial year end, then adjustments may be necessary. Why? To properly reflect the impact on the financial statements. If assets are sold or purchased after the financial year end, but before the date of signing financial statements, that is a recognized subsequent event that require adjustments to the financial statements. 3, bankruptcy. Bankruptcy. If an entity files for bankruptcy after the financial year end, but before the date of signing financial statements, it may impact the valuation of assets. It may impact the recognition of liabilities. It may also impact the presentation and disclosure in the financial statements. So such an event has to be adjusted. It will impact the valuation of assets. So if it impacts the valuation of assets, then that has to be reflected in the financial statements before the date of signing the financial statements. It's a subsequent event. Bankruptcy. I'll give more examples. Changes in accounting estimates. Changes in accounting estimates. Changes in accounting estimates. If there are changes in estimates, such as impairment or provisions, after the financial year, then adjustments should be made to reflect the changes. Do you understand? If there are changes in estimates, accounting estimates, then that's a recognized subsequent event, and therefore adjustments has to be made to the financial statements to reflect the changes. So these are recognized. Number one, recognized subsequent event. I'll discuss here number two, non-recognized subsequent events. Non-recognized subsequent events. This is the opposite of recognized subsequent events. Okay? Non-recognized subsequent events are those events that provide information about conditions that arose after the financial year end. They provide evidence about information that arose after the financial year end. And therefore, these non-recognized subsequent events do not need adjustments, do not require adjustments to the financial statements. Instead, they may require disclosure in the footnotes of the financial statements to inform users about significant events or transactions. These are subsequent events that do not require adjustments. These are transactions events that do not require adjustments. I've said these events or transactions provide information about conditions that arose after. They provide information about conditions that arose after the financial year end. The recognized subsequent events provide additional evidence of conditions that existed before the financial year end. These ones provide information about conditions that arose after the financial year end. Do you get the difference? This is after the financial year end. This one is before the financial year end. Do you get the difference? Why adjustments are required when recognized subsequent events occur? Do you understand why adjustments are not required when non-recognized subsequent events occur? So let's now give examples. I'll give examples just the way I did in the case of recognized subsequent events. Examples to help you understand clearly is issuance, number one, issuance of debt or equity. A, issuance of debt or equity. Issuance of debt or equity. If a company issues new debt or issues new equity securities after the financial year end, it may not disclose, it may disclose to inform users about the subsequent financing activities. So here, non-subsequent event, no adjustments are necessary, but the company can make it as part of the disclosures to the financial statements. Does not require to adjust. Adjusting the financial statement is not necessary, but the company can disclose it as a footnote in the financial statement. 2. Natural disasters. Natural disasters. If a natural disaster occurs, after the financial year end, it may not require adjustments to the financial statements, because a disaster is something that is not expected. It's not something that is expected. So you cannot say it provides evidence, additional evidence to the existing conditions. No. It does not provide evidence to the conditions that existed before the financial year end. Does not do that. And therefore, no adjustments are required. Do you understand? It may not require adjustments to the financial statements, but should be disclosed to provide information on the significant impact of the disaster on the entity's operations or financial position. It is a non-recognized subsequent event, a non-adjusting event. 3. Significant business acquisition. Significant business acquisitions. If a company acquires another business after the financial year end, then the details of acquisition, such as the purchase price and the impact on the financial statement, may be disclosed. It is a non-recognized subsequent event. No adjustments are required, but such an event has to be disclosed as a footnote to the financial statements to help users understand the effect of such a purchase on the financial statements. Significant business acquisition. Number 4 is changes in regulations. Changes in regulations. If there are changes in regulations or changes in laws that affect the entity's operations or financial position after the financial year end, such changes may be disclosed to inform users of the financial statements. Just require disclosure. Do you understand? It is a non-recognized subsequent event, a non-adjusting event. It does not need to, it does not require adjustments. It only provides information about conditions that arose after the financial year end. Change in regulations is evidence of information that existed after the financial year end. But things like settlement of litigation after the financial year end will require adjustments. Why? It's because before the settlement of litigation, there was a dispute. So if settlement is made after the financial year end, but before the date of signing the financial statements, then this has to be adjusted. The financial statements must be adjusted. As the same as purchase or sale of assets. Adjustments are necessary. Bankruptcy, adjustments are necessary. Estimates, changes in accounting estimates, adjustments are necessary. So candidates, that's the meaning of subsequent events. I've defined subsequent events. I've identified the types of subsequent events, that is the recognized subsequent events and the non-recognized subsequent events. Do you understand the difference? Do you get the difference? So candidates, before we look at the audit work done between the financial year end and the date of signing the financial statements, it's important to note that management and auditors, it is important for management and auditors to evaluate subsequent events to determine their impact on the financial statements. Because recognized subsequent events we've seen require appropriate adjustments, while non-recognized subsequent events may necessitate additional disclosure to provide users with relevant and timely information. And this ensures that the financial statements reflect the most current and accurate information available at the date of issuance. When adjustments are made, then it means that information is accurate, information is current for the users. Now let's now discuss the audit work that should be done between the financial year end and the date of signing the financial statements. Now, candidates, between the financial year end and the date of signing the financial statements, auditors perform specific audit procedures related to subsequent events. And these procedures aim to gather evidence about events or transactions that occurred after the financial year end but before the date of signing the financial statements. So we're going to look at the procedures that the auditor has to carry out during this period. Audit work. Audit work done between the financial year end and the date of signing the financial statement. The first one is inquiry. Inquiry, and also what we call analytical procedures and analytical procedures. Inquiry and analytical procedures. That's the first audit work. Now, auditors make inquiries of management and key personnel regarding any significant events or transactions that have occurred after the financial year end. Inquiries, asking questions of management, asking the key personnel questions. That's the meaning of inquiry. You ask the top management of any major events that may have occurred after the financial year end. Auditors may also perform analytical procedures. These are procedures to assess whether there are any unusual or unexpected fluctuations or relationships in the financial data that may indicate the occurrence of subsequent events. So the auditor may make inquiries from the management or can carry out analytical procedures using financial data. Okay? So that after carrying out analytical procedures, you can identify any unexpected fluctuations or any unexpected or unusual relationships in the financial data. That is the first audit work. Number two, review of subsequent events documentation. Review of subsequent events documentation. Reviewing subsequent events documentation. What are these documentations? This could be the minutes of board meetings. This could be the documentation in relation to management discussions or any other relevant records. So the auditors review the organization's subsequent event documentations, which include the minute of board meetings, the management discussions, and so on. And by reviewing these subsequent events documentation, this can help identify any material subsequent events that may have an impact on the financial statements. So candidates, after the financial year end, the auditor should carry out this procedure. The auditor should seek to review subsequent event documentation. And by subsequent events, we are talking about the events or transactions that takes place after the financial year end, but before the date of signing the financial statements. So between that period, if it's 1 month, then the auditor should check if there are any management discussions, if there are any board meetings. If there are any board meetings, then the auditor should review the board meetings, the minutes of the board meetings, so that he can find out if there are any subsequent events which may impact significantly the financial statements of the organization. If there are any material subsequent events, then that can come to the knowledge of the auditor by reviewing subsequent events documentations. Do you understand, candidates? Subsequent events documentation, there is no specific document known as subsequent event. No, these are the documentation that this is documentation in relation to events that takes place between the financial year end and the date of signing the financial statements, and that could be the minutes of board meetings and even minutes of management discussions and so on. That is a procedure, an audit procedure or audit work done between the financial year end and the date of signing the financial statements. 3, cut-off procedures. Cut-off procedures. Auditors perform what we call cut-off procedures to ensure that transactions and events are appropriately recorded in the correct accounting period. And auditors review documentation such as invoices, contracts, bank statements, and any other supporting documents in order to do what? To verify that the transactions are recorded in the correct financial year. So during this period, the auditor should carry out cut-off procedures so that the events that occur between the financial year end and the date of signing financial statements are events or transactions that relate to the financial year under consideration, so that the information is that relates to the financial year is recorded in the current financial year and not the subsequent financial year. Cut-off procedures. Number 4, evaluation of recognized subsequent events. evaluation of recognized subsequent events is another audit work that can be carried out during this period. Evaluation of recognized subsequent events. Now, auditors here assess whether any recognized subsequent events require adjustments to the financial statements, and that involves evaluating the impact of the events on the financial statements and ensuring that the adjustments are appropriately reflected in the financial statements. Evaluation of recognized subsequent events. That's another audit procedure. 5, disclosure of non-recognized subsequent events. Disclosure of non-recognized subsequent events. Remember, we said that non-recognized subsequent events do not require adjustment, but these are events that must be disclosed in the financial statements under the footnotes. Auditors here determine whether any non-recognized subsequent events require disclosure in the financial statements, and that includes evaluating the materiality and the relevance of events and ensuring that appropriate disclosure are made in the financial statement footnotes. Six, updating risk assessment. This is yet another audit procedure. Updating risk assessment. Auditors update their risk assessment and evaluate the impact of subsequent events on the assessed risks. And the auditors consider whether any new risks have emerged or whether the existing risks have changed as a result of the subsequent events. As a result of the subsequent events. Updating risk assessment. 7, management representations. Management representations. Here, auditors obtain written representations from management regarding subsequent events. And these representations confirm that management has disclosed all non-subsequent events that are relevant to the financial statements and that appropriate adjustments and disclosures have been made. So the auditors must seek management representation letters from the management in relation to subsequent events. And in looking for or requiring or asking for these management letters, representation letters, the auditor must confirm that the management, number one, has disclosed all non-subsequent events, and these are events that are relevant to the financial statements. And number two, appropriate adjustments have been made, and lastly, appropriate disclosures have been made. That is an audit procedure. That is the audit work done before the date of signing the financial statements. Then lastly is a review of events. Review of events. This is review of events occurring after the date of the auditor's report. Review of events occurring after the date of the auditor's report. That is the audit procedure that has to be done. Review of events occurring after the date of the auditor's report. Auditors review any events or transactions occurring after the date of their report, but before the financial statements are issued. They assess whether there is need to update the auditor's report or include subsequent event disclosures. Do you understand? So these are the audit procedures that must be carried out before the date of signing the financial statements. And that is between the financial year end and the date of signing the financial statements. So that will mark the end of our today's lesson, where we've defined subsequent events. By now, you should now be able to define subsequent events. We've also identified the types of subsequent events. We've said, first of all, that subsequent events are events or transactions that take place between the financial year end and the date of signing financial statements. We've categorized the subsequent events into two. That is the recognized subsequent events, which we defined to be events that provide additional evidence of the conditions that existed before the financial year end. We also say that these are events that require adjustments to the financial statements. We also mentioned that these are events that affect the financial statements, and that's why adjustments are necessary. We've gone ahead to give examples of recognized subsequent events. Number one is settlement of litigation. Number two, purchase or sale of assets. Number three, bankruptcy. Number four, changes in accounting estimates. 1, 2, 3, 4, given 4 examples. Then we defined non-recognized subsequent events. Non-recognized subsequent events. We say that these are events that provide information about conditions that arose after the financial year end, and such events do not require adjustments to the financial statements. And we've gone ahead to give examples. 1, issuance of debt or equity securities. Number 2, natural disasters. Number 3, significant business acquisitions. Number 4, changes in regulations and laws. That we did in our today's lesson. Then we finally discussed in this lesson audit work done between the financial year end and when the financial statements are issued or authorized. We've outlined 8 audit procedures. Number 1 is inquiry and analytical procedures. These are 2 in 1. Inquiries: making inquiry of management, making inquiry of the key personnel of any events that may have occurred during that period. The second procedure, audit procedure, is review of subsequent events, documentation. Review of subsequent events, documentation. If there are any events that occurred between the financial year end and the date of signing the financial statements, documents such as the minutes of board meetings or documents about management discussions, the auditor should review such documentation so that he can establish if there are any significant subsequent events that require disclosure or that may cause the financial statements to be adjusted. Cut-off procedures. Number 3, evaluation of recognized subsequent events. Number 4. Number 5, disclosure of non-recognized subsequent events. That is another procedure that has to be carried out by the auditor. Number 6, updating risk assessment. Number 7, management representations. The auditor must get representations from management. Okay, obtain written representations from management regarding subsequent events, and these representations confirm that management has disclosed all known subsequent events that are relevant to the financial statements, and that appropriate adjustments and disclosures have been made in the financial statements. Then lastly, review of events occurring after the date of the auditor's report. The auditor also has an obligation to review the events occurring after the date of the auditor's report. And in closing, candidates, the work done between the financial year end and the date of signing the financial statement is crucial in ensuring that the financial statements are accurate, complete, and that they reflect the most up-to-date information available. This work also helps auditors identify subsequent events that may require adjustments or disclosures, at the same time maintaining the reliability and the relevance of financial reporting. And on that note, we bring the lesson to a close. Subsequent events and audit work done between the financial year end and the date of signing the financial statements. Thank you. God bless you. Hello everyone, and welcome to the lesson. The subject is Advanced Management Accounting. In today's lesson, going to study the role of strategic management accounting in strategic planning and strategic control. So here there are two things: strategic planning and strategic control. What is the role of strategic management accounting in one, strategic planning? So the first area we are going to consider is strategic planning. Then number two, strategic control. So by the end of this lesson, you should be able to discuss the role of strategic management accounting in one, strategic planning, and two, strategic control. So candidates, let's begin with identifying the role of strategic management accounting in strategic planning. Now candidates, strategic management accounting plays a crucial role in both strategic planning and strategic control. And one area under strategic planning is that of identifying opportunities and threats. All right? Strategic management accounting helps in identifying opportunities and threats. That is, strategic opportunities and threats. Identifying strategic opportunities and threats. The SMA provides insights into the external environment. It provides insights into competitor analysis as well as customer trends, and thereby enabling the organization to identify potential threats or opportunities, to identify potential opportunities for growth, and also enables the organization to anticipate threats well in advance. So that is one role under strategic planning. The second point is related to objectives and goals. Strategic management accounting helps develop strategic goals Strategic management accounting helps develop strategic goals and objectives. It helps translate strategic goals into measurable and actionable objectives by providing data on resources, by providing data on, and also providing what we call performance benchmarks. So strategic management accounting helps in development of strategic goals and objectives. Now, related to strategic planning is what we call allocation of resources. Allocation of resources. Allocation of strategic planning. All these aspects are related to strategic planning. All right? Identifying strategic opportunities and threats, developing strategic goals and objectives, allocation of resources. There is also the evaluation. In strategic planning, there is also that aspect of evaluation and selection of alternatives, or what we call options. Strategic options. By now, candidates, I know you appreciate that strategic planning is a process, and within this process there are various steps, one of which is evaluation and selection of strategic options. When the company wants to evaluate or select strategic options, this could be long-term investments, right? Investment in long-term assets and so on. Then strategic management accounting will come in handy. Why? Because it helps evaluate different strategic options by providing forecasts, by doing what we call simulations, and also sensitivity analysis that assess the potential impact of each option on the organization's financial performance and the long-term success of the organization. So SMA is key, plays a key role in evaluating and selecting strategic options. And I've said strategic options could be long-term investments and so on. So evaluation and selection of strategic options is one of the steps in the strategic planning process. These are 4 roles of strategic management accounting in strategic planning. We may add a role like developing of performance measurements, development, performance, development of performance measurements, developing performance measurements or measurement systems. Let me say performance measurement systems. SMA contributes to developing performance measurement systems that track progress towards strategic goals. It may also identify areas for improvement. Now let's move on to study the role of SMA in strategic control. Strategic control. A, strategic planning. B, strategic control. Strategic control. One point here is, or role is that of monitoring strategy execution. Monitoring strategy monitoring of strategic execution. Now, candidates, SMA provides real-time data and insights into the implementation of strategic initiatives, and thereby enabling organizations to track progress, enabling organizations to identify deviations and adjust course as necessary or as needed. So it is through strategic management accounting that an organization can monitor the execution of a strategy. When a strategy is being rolled out, we all know strategy as a strategy option is a long-term need to monitor and check if the execution is on course. It is strategic management accounting that enables organizations to monitor through provision of real-time data, through provision of insights as the organization implements strategic initiatives. The organization is able to track progress, and by tracking progress, an organization can identify any deviations to the original plan and then adjust where necessary. So that's the role of strategic management accounting in strategic control. Number 2, identifying variances and their causes. Strategic management accounting helps identify variances and their causes. It helps identify performance variances from planned objectives and then diagnoses the root causes of such variances, allowing managers to take corrective actions. Strategic management accounting helps to identify variances and their causes of action and their causes, so that the organization then diagnoses the root causes of these causes, then takes corrective actions. Number 3, the third role of strategic management accounting in strategic control is evaluating strategy effectiveness. Evaluating strategy effectiveness. SMA provides information that helps in the evaluation of strategy effectiveness. SMA facilitates the evaluation of the effectiveness of implemented strategies by measuring their impact on the financial and non-financial performance metrics, evaluating strategy effectiveness. 4, the fourth role of strategic management accounting is that one of adapting strategies to changing circumstances. We all know that organizations operate in dynamic environments. So it is the role of strategic management accounting to help companies adapt strategies to changing circumstances. Why? Because SMA provides information that enables organizations to adapt their strategies to or in response to changes in the internal and also the external environments. Do you understand? 5, it helps ensure transparency or accountability. It is through strategic management accounting that accountability is ensured. SMA provides or helps hold managers accountable for achieving strategic objectives by providing clear performance metrics and reporting on progress. And candidates, these are the roles of SMA in strategic planning and control. And candidates, by providing valuable insights into financial and non-financial metrics, because remember we say that strategic management accounting goes beyond the traditional financial accounting but looks into the financial aspects and the non-financial aspects of an organization, and therefore it helps align strategic planning and strategic control processes, which leads to improved decision making. How? Because SMA equips managers with the necessary information to make informed decisions based on data and analysis. Furthermore, strategic management accounting enhances performance. How does it enhance performance? Performance is enhanced because SMA contributes to achieving organizational goals by optimizing resource allocation, by managing risks, and also identifying opportunities for improvement. It also helps in increased agility and adaptability. And how does that play out? That one is made possible because SMA enables organizations to adapt their strategies quickly. Because you've said that through SMA, the company is able to monitor strategy execution. The company is able to check if the plan is being executed accordingly. And if there is any need for change, then change is made because there is data, there is information, and there is also the analysis of the variances that enables the organization to also analyze the causes of the variances. So SMA, or strategic management accounting, enables organizations to adapt their strategies quickly and also effectively in response to changing market conditions, in response to competition, in response to competitive pressures, and so on. So candidates, these are the roles of SMA in strategic planning and control. And in conclusion, we can also say that SMA acts as a critical bridge between strategic planning and control because it provides the information and analysis necessary to formulate effective strategies, monitor their implementation, and also to ensure that there is success. So strategic management accounting acts as a bridge between strategic planning and strategic control. It's a bridge because the two go hand in hand. It's not possible to control strategy without having a strategic plan. And it is through SMA that an organization is able to execute its plans. It is through SMA that the organization can provide information and also analyze the implementation and also to monitor implementation and to ensure that there is success. So candidates, these are the roles of strategic management accounting in strategic planning. We began by looking at strategic planning. We say that the first role is identifying strategic opportunities and threats. Number 2, developing strategic goals and objectives. Number 4, allocation of resources. Number 5, evaluation and selection of strategic options. Number 6, developing performance measurement systems. Then roles associated with strategic control. Number 1 is monitoring and strategy and strategy execution. Monitoring strategy execution. Number 2, identifying variances and their causes. Number 3, evaluating strategy effectiveness. Number 4, adapting strategies to changing circumstances. Then lastly, ensuring accountability. SMA helps hold managers accountable for achieving strategic objectives by providing clear performance metrics and reporting on progress. Then we've also said that SMA provides insights into the financial and the non-financial aspects of the organization. And that will mark the end of the lesson. But I'm going to give you 3 questions before we close the lesson. Number 1, how does strategic management accounting contribute to the formulation of long-term strategic plans within an organization? And what specific tools or techniques does it employ to support this process? Number 2, in what ways does strategic management accounting aid in controlling and monitoring the implementation of strategic plans? Can you provide examples of how SMA facilitates performance evaluation against strategic objectives? Number 3, how does strategic management accounting balance the need for flexibility in adapting to changes in the business environment while ensuring control mechanisms are in place to track progress and ensure strategic alignment? Thank you for attending the lesson. Bye-bye.
Hi candidates, welcome to another session of Manifested Online Classes. So we are still soldiering on with our syllabus coverage, and we are still in topic number 4. And I want us to look on the subtopic number 3, and the topic is IFRS 8 operating segment. So in this particular topic here, we're going to look on what is an operating segment, the information to be provided to the shareholders, or basically to the users of the financial statement as far as the operating segment are concerned, and also we look on the preparation on how a segment report is actually prepared. So first of all, when we talk about a segment basically refers to a component of an entity, or basically a geographical area in which a company operates in. So mean that we have a number of, or basically most of the companies actually, or most of the businesses operate in a number of geographical areas. For example, a company may be having a number of branches, or a company may be providing various products or various services. Now, such a company is required by this particular standard here, that is IFRS 8, to be able to prepare something called a segment report. And that segment report is intended to provide more information to the shareholders, more information to the other users of the financial statement as far as each component of the business is concerned, or as far as each unit of the business is concerned. And therefore, basically here we're going to look on how do we prepare that particular segment report, which information need to be included in that segment report, and which segment should be reported on. But before we do that, we can say here that many companies, or we can just say many businesses, all companies operate in different geographical area, and also provide various products, all services, to their customers. So here we are saying most of the companies operate in a number of geographical areas. So by saying companies operate in different geographical areas, this means that a company here can be operating in a number of geographical areas. Or in other terms, a company may be having a number of branches. For example, a company may be having a branch in Kenya, a branch in Uganda, and also a branch in Tanzania. So this particular company here, other than preparing, for example, the income statement for the whole company, whereby the company will be showing the revenue by the entire company from the 3 branches, the expenses of that company, which is incurred now by the 3 branches, and also the profit of the whole company. This company is expected to prepare a segment report, which will be giving information about each of these branch. For example, the revenue from each of the branch, the cost which is incurred by each of the branch, and how much profit was reported by each of the branch. Equally, if a company provide a number of or basically deal with a number of products, or a company provide a number of services, maybe a good example we can take an example of a company like Safaricom. This company, we know it deal with a number of products. So one of the product of Safaricom is M-Pesa. We also have data. We also have airtime, and so on. So these are some of the product of Safaricom. So Safaricom at the end of the year, other than preparing the income statement for the whole company, whereby it will be showing the revenue for the whole company, the profit for the whole company, Safaricom should also go ahead, in accordance with this particular standard here, IFRS 8, prepare a segment report. That segment report will be showing, for example, the revenue generated from each of the product here, how much profit was reported by each of the product there, and actually how much cost was incurred by Safaricom in terms of providing each of these particular service. So therefore, IFRS 8 basically provides some principles regarding what refers as the segmental reporting, or basically provide the principles regarding how a segment report should be prepared, which information is to be included in such a segment report, and so on. So therefore, we can proceed and we say that such companies, basically the companies operating different geographical areas, providing various services or product, we can say such companies are required by IFRS 8 International Financial Reporting Standard number 8 to prepare a segment report, And this particular segment report here will basically be provided for each product, for each service, or basically for each geographical area in which now the company is operating in. So we can further proceed and we say that a segment report, this one provide information about this particular segment of the company, or this business unit of the company, like product, like maybe the services, of which that particular information, number one, it helps now the users of the financial statement to be able to make a more informed decision, and so on. So therefore, you can say segment report provide information about performance. Provide information about performance of different business units. So in this case, when we talk about the unit of the business, we are talking of products. We are talking of a product. We are talking of what? The services, etc. So segment report provide information about performance of different business unit to enable the users of financial statements to have a wider perspective, of the business, and make more informed decision, about maybe such a company, or basically such a business. So therefore, the main objective of this particular segment report, which will be prepared by companies in accordance with IFRS 8, is basically to provide information about the performance of different business units, which you are saying these include product, these include services, these include branches of the company. And this particular information contained in the segment report, we are saying it enable the users of the financial statement to have a wider perspective, a good understanding of the business of the company, and that help now those particular users in terms of making a more informed decision. From there, I think we can proceed and we define what is an operating segment here. So let's look on the definition of an operating segment. Definition of an operating segment. So an operating segment, generally, we have said this is a component of an entity. A component of an entity, we are talking of maybe a product, which a company produce and sell. A component can be a service provided by by a company, or can even be a branch. If a company has a number of branches, those particular branches can be regarded to be operating segment. So how do we define an operating segment? So an operating segment is defined to be a component. We say this is a component of an entity, number one, which engage in business activities, from which it earn revenue and incur costs. It is that particular component of an entity which you are saying engage in business activities from which it earn revenue and also do what? Incur cost. If you take a good example of a product of a company, you'll be able to see a product will fit that particular definition, because a product, we say, is a component of an entity engaged in business activities from which it earn revenue and also incur what? A cost, and also incur a cost. Number two, we say an operating segment is a component of an entity whose discrete in this case we are talking of separate financial information is available. Discrete or separate financial information is available. And number three is a component of an entity whose operating results are regularly reviewed by the entity's chief operating decision maker, entity's chief operating decision maker, to assess its performance, and know the resources to be allocated. So that is the definition of an operating segment. A component of an entity which is engaging in business activities and it is earning revenue and also incurring cost. And then you're saying, number two, you're saying whose discrete or separate financial information is available. And finally, whose operating results will be regularly reviewed by the person in charge of making decision in a company for him to be able to assess its performance, and two, to be able to know the resources to be allocated to such what? A component. So that is a definition of an operating segment. Next, let's look on something called a reportable segment. Reportable segment. So in this case, when we talk about a reportable segment, basically this is a component of an entity which must be reported on, meaning that when the company is preparing a segment report, then separate information about such a segment has to be provided separately or has to be provided separately in the segment what? In the segment report. So in this case, we can say a reportable segment. This is a segment to be reported on, i.e. it's financial information must be reported separately in a segment report. Yes. So now for a segment to be said to be reportable in accordance with IFRS 8, such a segment should meet various criteria. Such a segment must meet various criteria. We can say for a segment to be reportable, for a segment to be reportable, it must meet the following criteria. Which is that particular criteria? Number one is that such a segment must meet something called quantitative criteria, not quantitative, rather qualitative. Criteria. So in this case, when we talk about the qualitative criteria, we say it must meet the definition of an operating segment. It must meet the definition of an operating segment. Remember, in our case here, we have defined what is an operating segment. We have said is a component engaging in business activity. It is earning revenue, incurring cost. Its separate financial information is available, and also its operating results are regularly reviewed by the person in charge of making what? Decision. So if a segment meets that particular definition, then we say it has met now the qualitative criteria. It is a reportable segment. When the company is preparing a segment report, separate information about such a segment has to be provided in a segment report. So number two, we say that it must meet at least one of the following quantitative criteria. At least one of the following quantitative criteria. So which are those quantitative criteria? Number one, we say its revenue, which is both now external and intersegment. Intersegment revenue, in other terms, is the internal revenue, the revenue between segment. For example, a company having a number of branches, one branch can make the sales to the other. That is an intersegment or internal revenue. So its revenue, which is both internal and external, must be 10% or more of combined revenue, and that is now the total revenue for all segments. So therefore, if the revenue of a segment, both internal and external, is 10% or more of the total revenue of all segment, then such a segment has to be reported on, or is a reportable segment. Number two, we say its assets are 10% or more of total assets. Equally, if the assets of a segment are 10% or more of the total asset for all segment, such a segment is a reportable segment. And number three, we say its profit or loss, in absolute terms, is 10% or more of total profit or loss. So mean that for segment to be reportable, then you are saying its profit has to be 10% or more of the total profit for all segment making what? A profit. Or its loss has to be 10% or more of the total loss. So basically what that means here, let's assume that a company is having like 4 products, product A, B, C, and D, and we are given some information here. We are told the first 3 products here maybe reported a profit of 10 million, 5 million, and maybe something like what? Like 5 million, which is a profit. But the last product here reported a loss of 10 million. That is a loss. So in using this particular criteria here, we are saying, first of all, consider those particular segments which are making profit only. Don't take into account the segment making the loss. Get the total profit here, which will be 20 million. And then you express this as a percentage of the total profit. So 10M all over 20 million times 100. And that will be 50%. So, and then you do the same here, 5 million all over 20 times 100 times 100. So this will give us 25 what percent. So mean that the profit for these 3 segments you can see is more than 10% of the total profit for the 3 segment making what? The profit. But now for this particular segment which is making the loss, you need to consider its loss on its own, or basically get the total loss. The total loss will be 10 million, and we are saying take that particular loss in absolute term. You ignore it is a negative. Ignore that negative. So, and basically here you take the loss for that segment, divide that with the total loss. We only have one segment making a loss. So once you express that as a percentage, that will give you 100%. So therefore, using this particular criteria, we can say all the segment are what? Are reportable. All the segment are what? Are reportable. So therefore, this is how a company is able to identify which segment is reportable and which is not. So therefore, we are saying for a segment now to be reportable, number one, it has to meet the first criteria, the qualitative criteria. It must meet the definition of an operating segment. And then number 2, we are saying it has to meet at least one of the following. At least one of those particular what? At least one of those particular 3 quantitative what? Criteria. So then from there we can proceed and look on something else as far as the segment is concerned. I want us to look on the disclosure requirements. Disclosure requirements. Yes, disclosure requirements. So in this case, when we talk about the disclosure requirements, we are talking of the information to be disclosed as far as each reportable segment is concerned in accordance with IFRS 8. So which information need to be provided to the shareholders and other users of financial statement as far as each segment or as far as each reportable segment is concerned. So the first information is information about the segment revenue, both external and internal, both external and internal. So the other information to be provided for each segment is information about the segment assets, segment asset. Number 3, and basically in this case we can talk of mostly PPE, property, plant and equipment. So we also have information about the segment what? The segment liabilities. Segment liabilities. We also have information about the segment profit or loss. This information also need to be disclosed. The other information the company need to disclose as far as each segment is concerned is information about the depreciation and amortization of each of the segment. The other information which also need to be disclosed is the criteria used by the company, to identify reportable segment So identify reportable segment. Also, the company will need to disclose information about certain items of incomes and expenses of each segment. So these items of incomes and expenses to be disclosed include information about interest income or the finance income, and the interest expenses. Expenses. So this is basically the information which the company is expected to disclose as far as its reportable segment is what? As far as its reportable segment is concerned. So I think for the time being, we can stop at that point. I want us, once we come back, we look on an illustration question which was tested in one of the past papers. So here is today's assignment. Question 1. In context of IFRS 8, define an operating segment. Question 2. Outline the disclosure requirements for a reportable segment under IFRS 8. Question 3. Explain what is a reportable segment and the criteria to be met by such a segment. In our next session, we are going to look on how to prepare a segment report, how we prepare a segment report, and equally we look on an illustration regarding the presentation of a segment report. So see you in the next session. Hi candidates, welcome to another session of manifested online classes. We are still continuing with the topic of operating segment. And in this particular session here, I want us to look on an illustration question which was tested in the sitting of September 2021, specifically question number 2B. And this particular question here, the examiner was testing the candidate's knowledge in terms of applying IFRS 8, specifically in terms of identifying which segment is reportable and which segment is not reportable. So we go through that question, we see what we are told and equally what the examiner was requiring. So the question reads, Tadaza Limited is a conglomerate whose equity shares are quoted in the National Securities Exchange. The group manufactures, distribute and retail food products. The group also operates in a hotel chain for the purpose of diversifying its revenue. The group financial controller wishes to know if IFRS 8 operating segment applies to the entity, and if so, what segment should be reported on. He informed you that the operating results of each of the division presented below are internally reported separately to the chief operating decision maker. The following information is available. So you're given some information there regarding the businesses of this company. We have 5 businesses which include manufacturing, distribution, retailing, hotel chain. We have the revenue which is external. We have the revenue which is internal. We also have the profit or loss for each of the segments there, and then we have the asset. So what we are required by applying the requirement of IFRS 8 to the above information, explain which of the above businesses of Tadaza Limited are reportable segments. So what the examiner here was testing is whether the student is able to apply IFRS 8 specifically in terms of remembering the criteria of identifying the reportable segment. Remember, in our previous session, we have defined what is a reportable segment, and basically we have said a reportable segment is a segment to be reported on. When a company is preparing a segment report, information about that segment must be provided separately in a segment report. And actually we have said for a segment to be reportable, we have said it must meet a number of criteria. So number 1, you have said it must meet the qualitative criteria, which you have said is the definition of an operating segment. And number 2, we have said a segment must meet at least one of the quantitative quantitative criteria. So therefore, in that case, what was expected of you there as a candidate is basically to explain what is a reportable segment, or basically to be able to remember what is a reportable segment, a reportable segment. And in that case, you just a candidate needed to say that a segment is reportable if number one it meets the qualitative criteria. What is qualitative criteria? I.e., it meets the definition of an operating segment. Operating segment. So what is an operating segment? You must give that particular definition here. You say an operating segment is a component of an entity, number one, or basically Roman 1, which engage in business activities from which it earn revenue, and incur costs. Cost. So basically, if you go back to the information which are given here, you'll be able to see that those particular businesses of this company, manufacturing, distribution, retailing, hotel chain, all of them engage in business activities, and that's why you can see you are given their revenue there, and also you are given their profit. If you are given a profit which is different from the revenue, it means that they also incur some cost. So they meet that particular definition. Number two, whose discrete or basically separate financial information is available. Financial information is what? Is available. Also, if you check on the information which are given in that question, you'll be able to see that you're given separate financial information for each of those businesses. We are given the revenue, the profit, and also what? The asset. So mean that the separate financial information about each of those particular components is what? Is available. So mean that all those particular businesses meet those two, or basically meet this particular definition. And number three, we have said whose operating results are regularly reviewed by entity chief operating decision maker to assess its performance and know the resources to be allocated. Equally, there is some information which are given in this particular question. We are told he informs you, that is the group financial controller, he informs you that the operating results of each of the division presented below are internally reported. Internally reported means it is reported to the entity chief operating decision maker for him to be able to review that particular operating results and basically assess the performance of each of the segment here, and also maybe to know the resources to be allocated, like maybe the money for advertising and so on. So therefore, all those particular businesses of this company, manufacturing, distribution, retail, hotel chain, all of them meet the definition of an operating segment. So therefore, you can say all those particular segments, they meet now that criteria, and that is what? The qualitative criteria. Qualitative criteria. Number two, we have said that for a segment to be said to be reportable, it must meet at least one of the following, quantitative criteria. At least one of the following quantitative criteria. So which are those particular quantitative criteria? Number one, we have said that its revenue has to be 10% or more of the combined revenue. So we say its revenue, and basically we have said revenue, these include external and internal, is 10% or more of combined revenue. And take into account we are given the revenue for those particular businesses or those particular segments. So what we need to do is basically to check which segment are reportable and which are not reportable using this particular quantitative criteria. So what we need to do in that case, we are going to have those particular business units which are now our segment. We have manufacturing, we also have distribution, and then we have retailing, and then we have hotel chain. So what we need to do is to get the revenue for each segment, and this revenue will have to be the total, the external and what? Internal. Because we are given those revenues separately, we need to add them. Like for the first segment, manufacturing, we have 460 million plus 250 million. That will give us a total of 710 million. Then distribution, you have 5 plus 42, which will give us 47. Then we have retailing, which will 750 plus 15, which will give us 765. And then we have hotel chain, which will be 153. And then what we need to do is we get the combined revenue, and then we express this revenue for each of the segment as a percentage of the combined revenue. So we have 710 plus 47 plus 765 plus 153. This will give us a combined revenue of 1675. So what we need to do is to express this revenue as a percentage, and then from there we determine which segment is reportable and which one is not reportable. R is for reportable, NR is not for reportable. So let's start with the manufacturing. 10 divided by 1675 times 100. So that will give us 42%, 42.3. So percent. So we can say that is reportable segment. So because its revenue is 10% or more of the combined what? Revenue. So what about the other segment? 47 divided by 1675. So which will give us 2.8%. So this one is not reportable. You can see that revenue is not, the revenue of that segment is not more than 10%, or basically is less than 10% of the combined revenue. So we have 465 divided by 1675. So this will give us around 45.7%. So equally this one is reportable. What about the hotel chain? 153 divided by 1675. So which will be 9.1%. Equally that one is not what? This one is not reportable. is not what? Reportable. So going with this particular criteria here, then we can say that the segment which should be reported on is the manufacturing and also what? The retailing. So these two, that is distribution and manufacturing, they do not meet that particular criteria, despite meeting the first qualitative criteria. They do not meet that particular what? That particular quantitative criteria. So what we need to do, we need to proceed to the other quantitative criteria. We see whether distribution and hotel chain will meet the other quantitative criteria. Which is the other quantitative criteria? Number 2, we have said the assets of a segment, maybe you can say that it's assets must be 10% or more, 10% or more of combined assets. Combined, or basically the total what? Assets. The assets of a segment, we are saying, must be 10% or more of the total asset of all what? A segment. So let's use that particular criteria, because we are given now the asset of the segment. So we have the businesses which include manufacturing, which we are saying in other terms, this will be our segment. We have distribution, we have retailing, and then we have hotel chain. So we have the assets here. The assets here we have 1450, 250, 375, 100. So what we need to do, we get the total, then we express that as a percentage. We determine which segment is reportable and which one is not reportable. Which one is not reportable. So let's do that. Let's first of all get the total. We have 1450 plus the 250 plus 375 plus 100, and that will give us 2175. So we need to express this now as a percentage. So we have 1450 divided by 2175, which will give us around 67%. So therefore you can say this one is reportable. What about distribution? 250 divided by 2175, which will give us 11.5%, which is still reportable. What about retailing? 375 divided by 2175, this will give us 17.2%, still reportable. What about the hotel chain? 100 divided by 2175, which will give us 4.6%, which is not reportable. So using or going with this particular criteria here, we can see manufacturing is reportable, distribution is reportable, retailing is reportable, hotel chain is not reportable. So you can see there it is only one segment, which is now the hotel chain, which do not meet that particular word criteria. So hotel chain does not meet this quantitative criteria, it does not meet that one. So we need to proceed now to the last quantitative criteria. The last quantitative criteria, which is now for the profit or loss. We have said it's what? It's profit or loss. Or the last quantitative criteria is its profit, or the profit or loss must be 10% of total profit or total what? Total loss. So let's use this particular criteria here. So we have our businesses, which include manufacturing, distribution, retailing, and then we have the hotel chain. So what we need to have here is their profit or their loss, because that information is also provided in our question here. So we have a profit we have a profit of 32, we have 3, And then we have 75. And then the last segment reported a loss of 14. A loss of what? 14. So what we need to do is to express whether this particular profit or loss is 10% or more of the total profit or the total what? Loss. But in this case, there is something I explained. And when using this particular criteria, you first of all consider the segments which are making profits on their own. First of all, consider those particular segments. So get their total profit here. Then for the segment which is making loss, like in that case, get the total loss for that. The total loss in our case, this one would be 14 million. What about the total profit here? The total profit will be 32 plus 3 plus 75, which will give us 110. So what we need to do, we need to express this now profit of individual segment as a percentage of the total profit. So for the first segment, we have 32 divided by 110, which will give us 29.1%. So mean that that segment is reportable because its profit is 10% or more, or is basically more than 10% of the combined or the total profit. What about the other one, distribution? 3 out of 110, which will give us around 2.7%. So as per that criteria, that segment is not reportable. What about retailing? 75 divided by 110, which will give us around 68.2%, which means that that is still reportable. What about this one? We take the loss and actually ignore now the negative. We take it as absolute figure of 14. We divide that with the total loss. The total loss is still 14. So this will give us 100%. So meaning that that particular segment there is what? Is reportable. Is what? Is reportable. So therefore, using this particular criteria here, you can see manufacturing is reportable. This one, distribution, is not reportable. Retailing is reportable, and then hotel chain is what? Is reportable. Is what? Reportable. Now what we have said is that for a segment to be reported on, for a segment to be reportable, then we have said must meet the first qualitative criteria. And basically we said all this particular segment, they meet this particular criteria here. They meet that qualitative criteria. And then we have said must meet at least one of these three quantitative criteria. So basically we need to check. Here we have said manufacturing, retailing meet this particular criteria. Manufacturing and what? And retailing. So what is not meeting that criteria is distribution and hotel chain. So we need to come and check, are they meeting this criteria here? So manufacturing meets, and actually here we are only checking for two, distribution and hotel chain. Distribution, if you check what we have here, it meets that particular quantitative criteria. What is not meeting is this one. So let's come here and check. Is it meeting this particular quantitative criteria? Yes. So therefore, in this case, we can say that all these particular segments are reportable. All, that is now the conclusion here. Conclusion. All the segment of this company, that is all the segment of Tadaza Limited. Tadaza Limited are reportable. Are what? Reportable. Basically what that means is that when this company is preparing now the segment report, it has now to do what? To provide separate information for each of those particular for a segment in the segment report. Yes, so that is it, that what was required in that particular question. A question for September 2021, which was question number 2B. So for now, we stop at that point. Once we come back in our next session, we are going to look on how a segment report is prepared, and also we look on a past paper question. So see you in the next session.
Hello and welcome to the lesson. The subject is advanced auditing and assurance. In our today's session, we'll be looking at other special audit assignments. Having done around 6 or 5 subtopics, the chapter is audit, evaluation and reviews. In our previous sessions, under the audit of companies, we studied the audit of consolidated financial statements. We looked at the audit of banks and non-banking financial institutions. We studied the audit of general insurance companies. We went ahead to study the important points to take into consideration when auditing cooperative societies. In our session, we covered the audit under taxation laws. In our today's lesson, we're going to look at the factors to consider or matters to pay attention to when auditing other special audit assignments, when carrying out other audit assignments. And candidates, other special audit assignments refers to specific engagements that are outside the scope of regular financial statements audits. We know that the auditor is required to carry out audit on financial statements, but there could be other special audit assignments which you are referring to other special audit assignments. And these assignments are typically tailored to meet the specific needs and the objectives of the audit or a client, and may involve various areas of examination and reporting. In our today's lesson, we are going to look at a few examples of other special audit assignments. And the first one being the forensic audit. Forensic audit. Number 1, forensic audits. This is one special audit assignment. Forensic audit. Now, these audits, forensic audits, focus on investigating and uncovering potential fraud, misconduct, or irregularities within an organization. And forensic auditors use specialized techniques to collect and analyze evidence, interview relevant parties, and provide expert opinions in legal proceedings if necessary. That's forensic audits. Then there is number 2, compliance audits. This is another example of a special audit assignment. The auditor may carry out compliance audit. And compliance audits assess an organization's adherence to specific laws, regulations, and industry standards. And these audits ensure that the organization is complying with relevant requirements and may cover areas such as environmental regulations, areas like data protection, financial regulations, and occupational health and safety standards. The third special audit assignment is the internal control audit. Internal control audit. Now, internal control audits evaluate the effectiveness of an organization's internal control systems in managing risks and safeguarding assets. And these audits assess the design, the implementation, and the operation of internal controls to provide assurance that financial reporting, operational efficiency, and compliance objectives are met. That's the objective of internal control audits. Then number 4, we have what we call information technology audits, IT audits, IT audits. IT audits focus on evaluating an organization's information technology systems, processes, and controls. These audits, the IT audits, assess the security, the integrity, and availability of data, as well as the effectiveness of IT governance and risk management. And it's important to note that IT audits may also examine areas such as system development, areas such as network infrastructure, and data privacy and protection. So an auditor may be asked to carry out a special audit on information technology. 5, performance audits. Performance audits. What are performance audits? Now, performance audits assess the efficiency, assess the effectiveness, and also the economy of an organization's operations or specific programs. These audits evaluate whether resources are being used optimally, whether objectives are being achieved, and whether there is compliance with relevant policies and regulations. Performance audit is another example of a special audit that may be carried out by an auditor. Due diligence audit, number 6. Due diligence audits. Due diligence audits are conducted as part of a business acquisitions or mergers. These are audits that provide an independent assessment of a target company's financial statements, operations, and also risks to help the acquiring party make informed decisions and evaluate the financial viability of the transaction. So if company A would want to acquire company B, then company A may engage an auditor to carry out a special audit known as due diligence audit, such that after which the company will be unable to have information as to whether to acquire company B or not. It is an independent assessment of the target company's financial statements, operations, so that the target, the acquiring company can get more insights and make informed decisions about the viability of acquiring the target. Due diligence audit. Grant audits, number 7, is another example. Grant audits. Grant audits are performed on an organization that receive funding or grants from the government agencies or from foundations or any other sources. And such audits verify that the funds are used in accordance with the terms and conditions of the grant, and that the organization has complied with reporting requirements, and the organization, we can also say, has achieved the intended outcomes. So candidates, these are examples of special audit assignments. All right? They are just a few of many other special audit assignments. And candidates, the specific nature and scope of these assignments will vary based on the client's needs and the objectives of the engagement. And auditors who perform or conduct these special assignments may require additional expertise, may require specialized methodologies a knowledge of specific regulations or industry practices. If an auditor is to carry out an audit in information technology, then the auditor needs to have expert knowledge in IT. The same as forensic audit. Specialized knowledge is required to carry out compliance audit. Specialized knowledge is required to carry out internal control audits. Specialized knowledge is required to carry out due diligence audits, grant audits, and so on. So these are just examples of other special audits that may be undertaken by an auditor over and above the regular audit of financial statements of institutions. These just examples. In our today's lesson, we gave out examples. We'll be looking at specific ways in which these special audit assignments can be carried out. We'll be discussing in detail, particularly in our block revision videos. We'll be looking at comprehensive questions that will help us understand how to carry out audit procedures in so far as special audit assignments are concerned. Thank you for your time. God bless you. Bye-bye.
Greetings to you all and welcome to our today's lesson. My name is Nicholas Sikali. Our today's lesson will focus on pivot tables in Excel. Pivot tables are a powerful tool that is used for data analysis in Excel, and it enables you to interact with huge sets of data in a way that you want. So for pivot table, you can be able to summarize huge data set and come up with some more tables that will be able to make you understand the data that you have better. So in pivot table, you will analyze data interactively, come up with other tables, and be able to make more viable interpretations and decisions from the new tables that will be created from one table, of course, which we'll be having at the initial point. So welcome, and I believe you will enjoy this session. So with me here, I have a huge data set which we'll be using to be able to explore our data table techniques, or our pivot table techniques. You can see with me here, we have the order ID in column A. Order ID in column A, it moves up to all the way to 213. We have the second bit. We have the second bit here, which is product. Different products like carrots, broccoli, banana, orange, all the way. There is category. Of course, they are categorized either into vegetables or fruits. We have amounts that were sold. We have the dates that each one of them was sold. And we have the specific countries that relate to that. So we want to make interpretation from this particular table, you can see. And within a short period of time, if you are to be asked, which country do you think made the most sales? Of course, which country? Is it the United States that made the most sales? Is it Germany? Is it Canada? Is it France? Which country made the most sales? It's very difficult for you to be able to tell that. You can be asked, which product between carrots, broccoli, banana, beans, apple, and all these products here, which one was sold most? And again, you can see it's very, very difficult for you to come up with that particular decision. Which category between vegetables and fruit had the highest amounts of revenues or sales? Again, it becomes very difficult because the data is too huge. Remember, it's ranging from 1 all the way to 213. So it's huge. You can't really tell how much was from apple, how much was from banana, from beans, from orange, from carrots. It's very difficult, and you really, or you can spend the entire day analyzing this data and finding out which product had the highest, which category had the highest, which country had the highest, so it becomes very hectic and very difficult. But with the help of pivot table, you can be able to come up with sub-tables from the main table, from which reading of data becomes very easily. You can come up with the reports at any time, at any point, using the shortest time possible. You can do it in a matter of seconds and come up with a list of products, or a list of countries, or a list of categories that had the highest amount of revenue. So welcome, and I believe this session will provide you with an opportunity to be able to interact with this huge data set and break it down into sub-reports that can be able to help you to make decisions using the shortest time possible. So pivot tables, and for you to be able to access pivot tables, they are inside the insert menu, and you can be able to see pivot table here. So insert menu, and you can be able to see pivot table here, and when you click on it, of course, you can see that you have an opportunity to be able to do it from a table, and you can also be able to do it from an external data source. So it can either be from a table or a range. When you click on from a table or a range, it means you have to select all this. To make your work easier, instead of, again, this is a range now, selecting the range, to make your work easier, you prefer, or personally I prefer, making pivot table from a table and not from a range. From a table and not from a range. That is what I personally prefer. But you can also be able to make it from a range, as we are going to see. Now first, I want us to format our data in form of a table. We want to format this data in form of a table so that it's arranged in form of a table. Of course, we have advantages of formatting data in form of a table. That is, in case you add a new data like 214, the table will automatically be adjusted. So that is very important. So let us format our data in form of a table. That is, you click inside anywhere in your data. Just click inside anywhere here in your data. You click inside anywhere, not outside, but anywhere, just anywhere inside your data. Then go to the home menu. Home menu. Under the styles group, you can see the styles group here. There are three things: conditional formatting, format as a table, and cell styles. I want us to use format as a table. So our data now will be formatted as a table. You click on the arrow, you pick any style. You can go for any style here. I will go for a style which has some blue, and let me pick that. Now our data, you can see the range has been picked to the end. Nothing has been left out, all the way to 213, all the way to column F. So all the way to F214. F214 has been picked. Click on OK, and now our data has been formatted in form of a table. Now this is a table now, and you can see it even has the filters. You can be able to filter things out and do that. Now that is formatting data as a table. The importance of formatting data as a table is that if you are adding, let's say 214, and you have some orange, you can see that the data gets updated automatically. If you go to 215 here, the table gets updated. It keeps increasing to include 214, 215. The range keeps increasing automatically. So that is the beauty of formatting your data as a table. We will use 213 as we had there before. Remember, you can change the styles if you want by just clicking anywhere inside. Then you can change to any other style. If you prefer any other style here, you can still be able to change your data into variety of styles that are provided in Excel. Once you've done your first step of formatting your data as a table, which is not mandatory, by the way, it's not mandatory that when doing pivot tables you format your data as a table, though it's highly recommended. The second step is that now you go to insert and pivot table. Insert, then pivot table. So I'll click on pivot table, then we will click on from table stroke range, there. Then you can see we picked table 1, so no need of selecting anything. Table 1, and that is the table or range. Already it's table 1. choose where you want the pivot table to be placed. Where do you want it to be placed? Is it new worksheet, existing worksheet, or where? We want it to go to a new worksheet. Then you just click on OK, and you will have that. So what we have here is sheet 1. Remember this pivot table here, the data that we had initially, but a new worksheet has been added here known as sheet 1. So we are on sheet 1. So we have pivot table, which we have here, then we have sheet 1. So I'm going to start with certain things that you see here. This is where our report will be placed. Our pivot table report will be placed here. But we have pivot table fields on this particular side. You can see choose fields to add it to the report, and no need for using that. There is also this particular fields here. You can see order ID, which was the first one here. You can see the order ID. We move back to category. There was category there. There is amount, there is date, there is country, and so many things. You can be able to go to more tables if you want. Now there is dragging the fields above between the areas below. There is filter, there is column, there is row, and there is values. You can see how that looks like. Now we want to, assuming that you want your category or your product is to be dropped on columns. Look at what happens. If you want your product to be dropped in columns, that is what happens. Let us untick. I want to drop products in rows. Products in rows, and this will come here that way. So products in rows. You can see products in rows, and our report is building up. Then I want to see these products. What are the values attached to them? What are the values attached to them? So amount into values. Amount into values. If you take amounts to columns, that is what happens, but I don't want my work to look like that. So amount to values, and that is what you will see there. I want to remove the other one and take amount to values, and you come up with that. So this becomes very easy, and actually within seconds you can be able to see that Apple had an amount of let me input column so that we can clearly see that way. So Apple sold 191, 257. Banana, you can see sold 340, 295, 557, 281, 142, in that order. Within a very short period of time, you can be able to tell and retrieve such a small report from what you have there. You can do a lot. Assuming that you want country, you can even drop country to columns if that is what you want. If it looks so bad, you can just drop these to rows. That is how it will look like. Now look at that report, it has changed. If you take country to rows, this is what you see. And it gives you apple in specific countries, banana in specific countries, beans in specific countries. So if you want to undo country, of course you just remove the country and you remain with that. So I just removed the country from the other side. What if you want the country to be in values? That is what will look like. Apple count of countries, and you can be able to see that. So I will remove country and remain with this small report there. Category, if you want to bring in category and take it to either columns, you can see the category. I'll undo. You can take category to products, and you can see what happens. And category inside products. So I'll undo category and remain with this small report. I'll save that report. Of course, I'll close this and now save this report to analysis of products. This is products and amount. Product and amount. So that is a report showing you the product and amount there. I can give this a color. Product and amount. This one I can also give it a color red on the other side. So we have, of course, let me move this before product and amount. No, not creating copy, so that it's the first one. So we have pivot table followed by product and amount and all that. Now from this huge data set, we which will take a day for you to analyze the products and the amount of sales that they made, we've used a very short period of time to get product and amount here. So let us do another one. Again, pivot table, insert pivot table, then here, then same range, then okay. We want to do another one. What if it is category? So you take category and put it inside rows like that. Which category led? So category against amount or against values. You can see categories against values, and you can see vegetable and also the other one. I will include the zeros and the commas. The category that led was fruits, which was at 693,069. Vegetables followed at 336,665. So I will rename to category and amount. So that is category and amount. Then I will give it a color from which we can move it to end. So we are moving it to end. Then okay, so now it is at the end. You can see category and amount. Again, from this data set we want to do another pivot table, which is a bit more complicated, including so many things. So pivot table, then okay, and here we want to start with the ID. The IDs will be under filters, or maybe no. I want to start with category under rows, not necessarily category but products. Let products be under rows, then category also that way. No, let me start again. So I'll start with category under rows, then products also under rows. So you can see category, then products also under rows. Then we have the country, which we can put under columns, country under columns. Then the amount can also be seen under values. Now look at that, a very another dynamic of how a pivot table can look like. Fruits, total of 91 to, that is 91, 9, 12 and what? Let me put the 0 so that it can clearly be seen. In the home menu, you put the commas and you reduce the zeros. Fruit in Australia amounted to 91, in Canada amounted to 82, in France amounted to this. Apple, again the same breakdown of things in every other thing. So these are more complicated kind of report that you can be able to make from that huge data set, where we had product, category, amount and country. So this one can also be able to be saved here, and this will be, it has a I can give it a name, analysis 1, analysis 1, maybe analysis 1 there. Then I can move it to end. Let us move it to end. So move or copy, move to end, then okay. Then tab color, that way, in tab color, one that is more, yeah, that is fine. So this is analysis 1, where you can be able to see categories like fruits and the countries, different products, countries and the total, category of vegetable and different countries, beans, of course, under vegetable we have this, and also various items there. Now we have analysis 1, we have category and amount, we have product and amount, then we have our main data that is from the pivot table which we have here. The last one that I want us to try is that this can also be even more complicated, and one can come up with something that it's even hard to read. Like we have that, then we have it goes to columns, you can see there. Then we have countries, which also goes here. That one looks bad, so country, I'll take it to rows. Look at that. Then amount, I'll take it to values. So this is what we have now. A very other complicated, though it's understandable, like fruits, vegetable, and grand total on the other side. You can select and give it some, select home, then the zeros after the commas here, we reduce the zeros to what we have there. Now look at the first one, fruits. There is apple and vegetable, of course, from different countries and all that. Now this is another set of pivot table which we can call analysis 2. So this one can be analysis 2, like that. Then move this to end, move this to end, and of course it's at the end there. Can give it a color, and this can be that one of a color. Now look at that. We started with the data from which making a decision was very difficult. Somebody would ask you a simple question and one cannot even tell, like, which category between fruits and vegetable had the highest. You will take so much time, but with pivot table you can quickly get here. Now which product had the highest? With pivot table you can be able to see that it is our bananas that took the highest. You can see category and amount, this analysis 1, this analysis 2, and so many things. One can do a lot. For instance, you can get another pivot table and say okay, and just do these things randomly. Like you want this to come here, you want this to come here, and no, I'll do away with that. You want this to come here, you want the countries to come under category, you also want the countries to go under columns, and that one looks bad. You want the amount to come here. This is another set of pivot table that you can come up with. So this one can be given analysis 3. So you can do a lot of analysis from your pivot tables, comma, then we will reduce that to that point. So this will be analysis 3 of pivot table. Again, this can be interpreted. We have fruits and other fruits, you can see countries, and this one is giving you different items, vegetables, and also different items here. So this will be analysis 3 after changing the color. We'll give it analysis 3, analysis 3 in that order, and clearly it's now taking shape. We'll move this to end, so move or copy so that it's taken to the end, and okay, this can always be closed and we remain with our data here. Now we have the first one, which was pivot table, our data which we formatted as a table using this option. We did a simple one here, that is product and amount. There is category and amount. There is analysis 1, this analysis 2, and this analysis 3 of doing this pivot table. And remember, pivot tables usually go as well alongside the pivot charts, which is also done the same way. So up to that point, I believe that you should be in a position to do pivot tables. The file that we used will be shared below the video description so that you can be able to do your practice. You can be able to do practice on your own and come up with various summaries from a huge data set. That means you work with your data interactively and come up with so many other reports from the main table, which can be used for various decision making ideas or analysis of data to come up with different views. Bye for now, and see you again. Hello learners, and welcome to this session. Today we intend to cover more advanced functions and formulas in Excel, and specifically we are going to start with areas to do with cell referencing. So we are going to cover cell referencing. Of course, cell referencing is divided into 3. We have relative cell referencing, we have absolute cell referencing, and we have mixed cell referencing. We are going to look at all of the above mentioned type of cell referencing so that we can be able to come up with how they work and how they help you as a user or a user in Excel to be able to execute your functions. Welcome, and I hope this session will be fruitful. First, we are going to open Excel the normal way. And once Excel is open, we will create a new workbook. Remember, this is a workbook that we had previously looked at, or we had previously studied. I'm going to apply a keyboard formula of Control and N, Control plus N, to be able to come up with a new workbook. Control N. Control N gives me a new workbook named Book 1. We are in Sheet 1. So I'm going to immediately save this workbook by clicking on File, then Save. I'll give it a name, Cell Referencing. Cell Referencing, then saved. Then in my first worksheet, I'm going to give this worksheet a name, Mixed Cell Referencing. Mixed Cell Referencing, that is the name of the first worksheet that we have here, Mixed Cell Referencing. Now, before we go to Mixed Cell Referencing, what is cell referencing? When you talk about cell referencing, it simply refers to how formula cell references adjust, or how formula cell references change in relation to the new areas that they are copied to. So cell referencing refers to how formula cell references adjust or change in relation to the new location they are copied to. Remember, formulas can be copied downwards, or they can also be copied across. So cell referencing refers to how formula cell references change or adjust in relation to the new areas that they are copied to. A good example is if you, maybe let us use an illustration, or before we go to an illustration, there are three types of cell referencing. Mixed, the one that we are going to start with. So let us start with mixed cell referencing. Not mixed cell referencing, but relative cell referencing. That was an error there. So relative cell referencing. Relative cell referencing is a scenario where the formula's cell references change, or the formula cell references are free to move, or they are free to adjust in reference to the new areas that they are copied to. So it means formulas are free, formulas change willingly in the new areas that they are copied to, either downwards or even across. That is relative cell referencing. And in relative cell referencing, you don't have to do anything. Actually, it is the default type of cell referencing in Microsoft Excel. So it's default, it comes by default, and you don't have to do anything to a formula, because when you copy it down or when you copy it across, a formula will just change its cell references in relation to the new location that they are copied to. So let us use an example. So we have here ABC Limited, cooking fat distributors, ABC Limited cooking fat distributors, and after ABC Limited cooking fat distributors, we have the product that ABC deals with. Product, of course, this one will be product name. We have quarter one. I can use quarter one. We have quarter 2, quarter 2, we have quarter 3, then we have quarter 4, in that order. Then we have total. After that, we are going to bring in the products, like they are selling Kimbo, they have Elianto, they have Zenta, they have Chipo. Then in quarter one, maybe this one is in shillings, it could be 4,500 in shillings or in units. Here maybe they sold 2,340. On this side they sold 2,500. Then quarter 4 they sold 7,500 or 756. Elianto 3,200, 2,300, that one is 3,401, 1,510, 2,305, 1,110, 2,350, 3,468, 2,457. Then is Chipo 3,400. They did not sell anything there, so maybe 0. 5,210, then 2,000 flat. This is what they sold, and here we also have total. Then we also have annual sales here. Annual sales in that particular area there. After that, this is to be, maybe you can do something here, then insert borders. So I'm going to insert borders on that, all borders, so it's bordered. And again, I'll make it more interesting by deleting those cells. So I'll delete those cells there. They are gone. I will, yeah, it looks fine. I'll also adjust this if need be, so that we have something like that. If you want to, there are things that you can also merge. You can merge the above area, so merge across, can make it bold. You can also be able to increase the size of that so that it's more visible. Could do the same here by increasing the font size so that it's more visible to all the users. So something like that. Then you can adjust. You can even make this bold again to just to make it more appealing and visible. Now we want to put in practice relative cell referencing, and we say relative cell referencing is where the formula cell references are free to move or adjust in relation to the new areas that they are copied to. I want to get the total for Kimbo in quarter 1, quarter 2, quarter 3 and quarter 4. So the formula is that we just add, or we can use sum, or I can just add whichever formula that you see you can use to get this. So look at the formula: equal signs B5 plus C5 plus D5 plus E5. When you hit enter, remember this is B5, C5, D5 and E5. Up to that point there is no any other plus. When you hit enter, the answer is what you see here, 10,096. You can be able to add the commas this way and decrease the zeros or increase the zeros if you want. I want mine to be like that. So what I'm interested with is, if you double click here, the formula B5. The formula cell references is B5, C5, D5 and E5. What if you copy the formula down? So if you copy the formula down by dragging at this particular location here, and you drag down the formula, it arrives at that. Look at the second portion. All the answers are here. I'll undo and copy again. So if you copy down, it changes and the rest of the answers are given. Look at the second one. The second one is now B6, C6, D6 and E6. So the references have changed. Again, I repeat, the first one that we entered was B5, but when you move to the second one, you can see it has moved to B6, C6, D6 and E6. So it means the formula has changed its references in relation to where it was copied, that is downwards. If you look at this one, it moved from what we had here as B5 and it's now B7, C7. So the references are what we are talking about. They are changing as you copy the formula down. So that is formula references changing in relation to the new location that you copy it to. Even the last one is B8, C8, D8 and E8. Remember, we entered only one formula here, which was B5. You can see your formula bar here, B5, C5, D5 and E5. But as you copy it down, it changes to now the B8, C8, D8 and E8. So that's how relative cell referencing works, where the formula cell references are free to move or change in relation to the new location that they are copied to. Now what if it is to be done now across? Let's see. What if you are to copy your formula across? So we're going to use one of the many functions that we already know of. I can use formulas, sum, then sum. So it picks everything already. The same thing, of course, can be done by preceding that with an equal sign, then sum, then double click on the sum, drag from top up to down, then you close with the bracket, then you hit enter. Before you hit enter, the formula cell references are B5, the range of B5 to B8, B5 to B8. If you enter, remember it can be copied down. I will include the decimals and after that reduce the zeros that way. Now I repeat, B5, B8. Those are the formula cell references. If you copy it across, if you copy this formula across, the way I'm dragging the formula here using this option, I copy it across. Now what are the new formula cell references in specific location? Remember, the hash means that the space was limited there, so I've expanded column D. Now the formula changes to C5. Remember, here the formula was B5 and B8. But if you copy it across, the formula cell references changes to C5 and C8. Here you can see it is E5 and E8. So it keeps changing. It's not the same as the other one. In fact, the columns are being adjusted as you move to the right. The formula cell references keep changing as you drag it to the right. Again, the first one was B5 and B8. But when you move to the next one, the B changes to now C, and this one moves to C, and C5 and C8. This other one will be D5 and D8. The other one will be E5 and E8 in that order. This one moves to F5 and F8. So in relative cell referencing, the formula cell references are free to move as you copy your formulas, either moving down or moving across. What if you want to get the annual sales here? This would be equal sign, then you take the total here, then you multiply that with, of course, 4, because a year has 4 quarters. After that, your answer is 162, 388. So that is relative cell referencing. Remember, you can do a lot on this. You can change the colors if you want. If at all you want to change that color, you can be able to change. You can even change the background color if you so wish. If this is what interests you, you can change the background colors and all that. So you can do a lot even to this. Assuming you want to adjust various things there, like background colors, it's all possible. You can be able to change the background colors and all that. This can also be changed to something else, like that. Looks nice. You can also change this to a different background color if that is what suits your your needs. So that is relative cell referencing. Remember, in relative cell referencing, formulas are free to move or adjust in relation to the new areas that they are copied to. Next, we will look at absolute cell referencing. Of course, in absolute cell referencing, that one is a bit different. So I'm going to create a new worksheet. Remember, this one is relative. I'll give it a tab color. That is better. Then I'll be able to create a new one and name it to absolute cell referencing. Absolute cell referencing. Absolute cell referencing. Now, this was relative. Now we move to absolute cell referencing. Change the tab color to even blue, like that. Now, in absolute cell referencing, it's a bit different, because under this kind of cell referencing, formula cell references are made to be fixed, or let's say constant, pointing to the cells that have been made, of course, to be fixed or constant. So it means the formula cell references are made to be fixed, or they are made to be constant, pointing to the cells originally copied from. That is absolute cell referencing. Remember, as you do your formula, there is this particular cell that maybe you want your formulas to keep referring to. If you want to do that, then it means you'll be applying absolute cell referencing, where the formula cell references are made to be fixed or constant, pointing to the cells originally copied from. And for you to be able to make a cell to be fixed or constant, it means you will precede both the column heading and the row heading of that particular cell with a dollar sign. You will precede the column heading and the row heading of that particular cell with a dollar sign. For you to be able to do that, it is the function, one of the functional keys, F4. So if you press on F4, we'll be seeing that as we begin on that. It means you will have inserted a dollar sign both before the column and the row heading, or shift together with 4. Shift together with 4 also does the same tasks as F4 when you want to bring on board a dollar sign both before the column and the row headings. Let's put that again in practice, and we will have, let's say XYZ universal traders, XYZ universal traders, XYZ universal traders, and we can talk of analysis of product sales, analysis of product sales for the year ended 2022, and here we have value added tax, VAT rate. So we have VAT rate, value added tax rate. So that is value added tax rate. We have discount rate. So discount rate, of course, it will be in percentage. VAT rate is 16%, so I'm going to 16%. The discount 2.5. The discount is 2.5%. Here, product there, and then buying price. This could be buying price. There is VAT amount, VAT amount. We have after VAT amount we have selling price in that order. We have discount or discounted price in that order. So we have selling price and we also have discounted price. Of course, we have products, tissue, pampers, we have cooking oil, and maybe should not be in sentence case, tissue, pampers, cooking oil, and the last product can be honey. One can also bring in the milk. That way, then the buying price of tissue, we are going for a roll of maybe 4 or a roll of 10 or a roll of 8. That can be around 320. Pampers 865. Cooking oil 1399. Honey, that can be 1500. Milk 534. So that is the buying price of those products. But before we move forward, I want us to insert the borders. So you select everything this way. Before that, you can also get the total. You can also get the total here. Total. Then now we select everything that way. Then insert borders. Insert borders, all borders. Once you've inserted all borders, you make sure that it's a bit visible by increasing the size. Once you have that, you adjust again that everything fits well. Just make sure everything is visible, even the amount, price, discounted price. Then I want to merge this. Merge and center, merge and center, or merge and center. I want to do away with some border there, so I'll say bottom border. I'm doing away with bottom border. It's still there, but bottom border again, bottom border, it's still there. Okay, what about top border? Bottom border, yeah, it's still there, it's fine. I can also, this one is centered, well centered. I believe I can remove this. You just select and delete cells. So I delete cells and they are gone. There is a border that has gone away, so that is the right border. So the right border is back. Now this is what we can use in absolute cell referencing. We want to get the VAT amount. Maybe I can do the formulas here. How do you get VAT amount? Assuming that you have VAT amount, the formula for VAT amount is that is equal to VAT rate or buying price. That is buying price, because that will be multiplied with the VAT rate. Buying price times VAT rate. Now this is the formula for getting the VAT amount. Buying price times the VAT rate. Now what if you just go ahead and say, that is buying price times VAT amount, that is buying price, so equal sign, then buying price, which is B7, times VAT amount, and you enter 51.2. Well, the first answer is correct because it's taking buying price times VAT rate, which is 51.2. So very correct. What if you copy it down? What if the answer is to be copied down? Are the other answers correct? Let's see the second one. The second one, it is saying that it's 21.625. Do you think 865 times 16% is 21.625? Let us confirm. Remember, it is taking 865, which is B8, but it is now multiplying with 2.5% and not 16%. Remember, VAT amount is buying price times VAT rate. So the formula needs to keep taking the buying price times VAT rate and not moving down to 2.5. So the second answer is wrong. What about the third answer for cooking oil? It's taking B9. B9 is this. Then it's multiplying with buying price. You cannot take a number and multiply with a text. Of course, that is why your answer is value, which means there is an error here. So it's also wrong. What about honey? Do you think 1,500 times 16% is 480,000? Let's confirm. So this is taking, yes, 1,500, but it's multiplying with B7. B7 is 320. So again, it's wrong. The third one is also wrong. So to avoid such wrong answers, that is where absolute cell referencing comes in. That means as you copy the formulas down, they need to keep taking the buying price, but keep referring to 16%, which is the VAT rate. So it means this cell need to be made fixed or constant. Wherever you copy the formula, either down or across, this cell has to be fixed or constant, and that is where absolute cell referencing comes in. So we're going to change our formula and do it afresh now using absolute cell referencing. So equal sign, yes, 320. Then you multiply with this. You can see we've clicked on B4, which is 16%. Once you've done that, press on F4 on the keyboard, a functional key, F4. So we have F4, which is between F3 and F5. So there is F4 there. You press on it on the keyboard, and it gives you dollar signs. You can see the dollar signs here, both before the column and the row heading. So dollar sign B, dollar sign 4. If you don't want to do that, you can do manually, Shift and 4. So dollar sign, then you press B, then again dollar sign, Shift and 4, then you press on the row headings, which is 4. Again it is dollar sign B, dollar sign 4. That is a long cut. So the thing that you should do, press on 16, then press F4 on the keyboard, so that it gives you the this one becomes fixed, or rather constant, pointing to the cell that has been made fixed or constant. So once you've done that, you enter on the keyboard. So you just enter on the keyboard. The answer is 51.2. What if now we copy down? If you copy down, it moves to the answers that you now need. The second VAT amount is 138.4, and that can be confirmed. It is 865 times 16%. The third one is 1399 times 16%. This other one is 1500 times 16%. The last one is 534 times, again, 16%. So what we've done is that the cell B4 has been made to be fixed using absolute cell referencing by inserting the dollar sign both before the column and the row headings. That's why we have correct answers here. So wherever you copy that particular formula, it will keep referring to this cell which is fixed. That is where 16% is, and this is absolute cell referencing, of course. Now, selling price. How do you get the selling price? Selling price is given by buying price plus VAT amount. Buying price plus VAT amount. So that one doesn't have absolute cell referencing. You just add. That is equal sign this, then you add with this other one to give you the selling price. That one doesn't require absolute cell referencing. Once you have this answer, of course, that is a relative cell referencing. You just apply relative cell referencing where no cell is to be made fixed. So you copy it down and you'll have your answers to the end. Discounted price. Again, under discounted price, we will need the guidance of absolute cell referencing. So how do you get discounted price? Discounted price is given by selling price, minus discount amount. Selling price minus discount amount. That means you get discounted price. But do we have discount amount? we don't have discount amount, though we have selling price. We're saying that discounted price is selling price minus discount amount. So we are going to insert some formulas here which will help us to get the entire thing, of course the discounted price. Every formula is preceded with a dollar with an equal sign. So you start with an equal sign, then it is selling price. So you click in 371.2, which is D7, minus, now we need to compute that discount. Maybe discount is given by, or the discounted amount is given by the selling price times the discount rate. Selling price times the discount rate, which means that again you click on the selling price. Before you click on the selling price, you can include bracket, then you click on the selling price, then you multiply with the discount rate, because whatever is in bracket is the discount amount. Discount amount is given by the selling price times the discount rate. So you multiply with 2.5. Then you want this to be fixed or constant. So again you must apply absolute cell referencing. So that is F4. So that it can be fixed, you close the bracket, and this is what you have. So what we have here in this particular formula is selling price minus discounted amount, where discounted amount is given by selling price times the discount rate, whatever is in bracket, selling price times the discount rate. Then you enter, you'll have that particular answer, which can then be copied down, and all of the rest are now correct. And then I will finish here. So the discount amount is given by selling price times discount rate, selling price times the discount rate, like that. So these are the formulas that we've used in getting what we wanted in that particular illustration. So I can reduce this so that it's the same size as the others there. Once you have that, there are so many things that you can do here. If you want to include decimals, you just click on the comma and you go ahead and just reduce this to maybe 2 decimal places is fine. Again, total, you can use any of the formulas. You can even use AutoSum. There is AutoSum here, which will help you to get the sum of the above. You confirm if you want to sum from B7 to B11, and indeed that is correct, from which you'll just drag across to here. So that is what we've done in absolute cell referencing, you can see. And this, again, if you want to insert the colors the way we did the other one, it's very much possible. So that means you just want to make it more user-friendly or more appealing, as you want. And if you want again to change inside here, very much possible to change. So we can leave ours like this, and the most important thing was absolute cell referencing. So that is relative cell referencing, absolute cell referencing. Of course, the last type of cell referencing is known as mixed cell referencing. So let us look at mixed cell referencing. Mixed cell referencing is where you decide to insert a dollar sign either before the column or the row heading, but not both of them. So it means the dollar sign will either be before the column or the row heading, but of course not both of them. Where there is no dollar sign, it's known as relative cell referencing. Where there is dollar sign both before the column and the row heading, it is known as absolute cell referencing. But where there is only one dollar sign, either before the column heading or the row heading, it is known as mixed cell referencing. So let us see mixed cell referencing. Mixed cell referencing. Mixed cell referencing. So that is mixed cell referencing. We can change the tab color to a different one like that. Then this is relative, this is absolute, then this is mixed cell referencing. So mixed cell referencing is where a user decides to use a dollar sign either before the column or the row headings, and we are going to straight away do an example. This is AMC Holdings Bank. AMC Holdings Bank. Holdings Bank. Then we say interest rate. Interest rate. I need them to be caps. Interest rate computation schedule. Computation schedule. So that is interest rate computation schedule. Then we will have some interest rates here, or we can have year amount. There is interest rate and there is amount, then we'll be computing. So there is a rate and of course amount, rate and amount, rate, amount. This one can be expanded. We have here 5%, 7%, 8%, 12%, 15%, that way. Then now under amount, we can have 100,000, we can have 300,000, 500,000, 700,000, 1 million, and 1 million in that order. So this is what we have. I want again to have the borders, so all borders, then that is fine. We can be able to actually use these and get the interest amounts now. Now in this particular case we are going to apply mixed cell referencing. I can increase their sizes for more visibility to that. Then with that you can also be able to adjust this to make it more appealing. You can merge this and center, or this one first, merge and center, merge and center, like that. If you so want, you can change the colors of those things to different colors of your choice. Just leave it at black. Now we want to compute if the loan amounts 100,000 and we have here 5%. What is the interest? So interest rate computation schedule. A equal sign. Every formula is preceded with an equal sign. Remember, if you want to get the interest amount, you just get the amount of the loan divided by the interest. So the amount of the loan, I mean, you multiply with the interest. The amount of the loan, you multiply with the interest. So equal sign, this, then you multiply with the interest. And you can be able to insert a dollar sign either before the column or the row heading. Assuming that you are inserting a dollar sign here, what is the answer? So remember here the dollar sign is before only the column heading. Before only the column heading. The dollar sign is before only the column heading. The answer is 5,000 here. Can this be copied down or across? It can only be one way. If you copy down, the answer is wrong. What if you copy across? Again, you get some wrong answers which are wrong. Let us see. The dollar sign, if inserted before the column headings, gives you a wrong answer. What if it's inserted before the row heading? So the dollar sign shift and 4 so that you can have the dollar sign here. Remember, in absolutes, in mixed cell referencing, the dollar sign will either be before the column or the row heading. Either before the column or the row heading. So let's see. This one is before the row heading. If you copy it down, the answer is correct, I believe. But if you try copying this formula across, the answer is wrong again. So it means it can only be copied down in that particular case. F5, which is 100,000 divided by B dollar sign 4. So that one gives you a correct answer if you copy it down. Now again, if you want to do the same thing and copy across, it will be equal sign, then now dollar sign, that is shift and 4, then A, where the 100,000 is, is column A, so A, then multiply that with this percentage, which is B3. Now the dollar sign is before the column, then now multiply with the 5%, you enter. There is a problem with the formula, of course there is. This means we did not complete. It is A5 here, so that it picks this. Enter. The answer is the same, 5,000. Then this can now be copied across comfortably. So if you copy that across, remember the answer is 100,000 here divided by 5. What about the second one? Still 100,000 divided by 7. What about this? 100,000 divided by 8. What about this? 100,000 divided by 12, in that order. So the answer is correct if you do it that way. Again here, equal sign, then dollar sign, that is shift and 4, then A, then 6. Multiply that with 5. Then hit enter, that is 15,000. You can copy it across. So you do it one by one, and you'll be able to use mixed cell referencing to get all your answers. So shift, dollar sign, A7, multiply with 5%, hit enter, then you can be able to copy this across. Copy that across. Again, equal sign, shift and 4 for dollar sign, A8, then you multiply with the 5%, hit enter, then you copy across for your answer, which is there. Then finally, equal sign, shift and 4 for the dollar sign, A, column A, where there is 1 million, row 9, then multiply that with the 5%, hit enter, and you copy across for you to be able to get your answer there. So all these answers are correct. Now you can see it is 1 million times 15%. 1 million times 15%, you get what you want here. And that completes the mixed cell referencing. Remember, instead of using mixed cell referencing, the same thing can be done using absolute cell referencing. You can just be able to use absolute cell referencing to get this interest rate computation schedule. Instead of using mixed cell referencing, the absolute cell referencing is also very much applicable. So I believe the session was great, because you now can be able to use the 3 types of cell referencing. You can be able to apply mixed cell referencing, absolute cell referencing, and relative cell referencing as you do a lot of executions in Excel, as you perform your analysis of data, as you do different comparisons and computations. We'll be able to apply relative cell referencing, absolute cell referencing, and mixed cell referencing in your variety of tasks. Maybe your only task to do is to try and do this. So task to do, we have the something here, radius. So this one is radius. No, radius, and you have to get the area, you have to get the perimeter. So just get area and perimeter, given a radius of 450. And also given a radius of 500, given a radius of 800, and given a radius of 910, and given a radius of 1200. Remember, pi is equal to 22/7. That is 22/7. Let's see. That is equal sign 22 divided by 7. 22 divided by 7, and we can squeeze this to include only a few decimal places, 3 decimal places. So 3.143. If pi is 3.143, get area and get perimeter of this. So this is your task to do. And for you to be able to do this, we are going to apply absolute cell referencing. So make sure that you apply absolute cell referencing and get the area and also get the perimeter of these particular items that I've placed there. So that is your task to do, and I hope you will be able to complete it using absolute cell referencing. So use absolute cell referencing and do that particular task of getting the area and perimeter. Thank you for now, and see you in our upcoming classes.
Hi candidates, welcome to another session of manifested online classes. So we are still soldiering on with the syllabus coverage, and in this particular session I want us to look on a subtopic 3 of topic number 5, which is to do with the determination of impairment loss for what we refer as non-cash generating asset in accordance with the IPSAS 21. Now, this particular standard here, that is the International Public Sector Accounting Standard number 21, basically requires public sector entities to do an impairment review at the end of the year if there is some indication, or basically if there is some evidence showing that the non-cash generating asset owned by such an entity could be impaired. Could be what? Could be impaired. So at a later stage, we are going to look on some of the factors, some of the indicators which shows that an asset could be what? Could be impaired. Now, why is an entity required to do that? Generally, when any entity is preparing the statement of financial position, the assets should be recorded in the statement of financial position at an amount equivalent to their recoverable amount. So mean that that value at which an asset is recorded in the company statement of financial position, and basically we know that assets are recorded in this statement of financial position at a value which is called the carrying amount. This standard requires that this particular carrying amount should always be equal to recoverable amount. So what is the recoverable amount? Recoverable amount essentially is the amount at which now an entity can be able to receive if it sells an asset currently. But in some cases, it may happen that this particular recoverable amount may be less than the carrying amount. If that is the case, then this particular standard comes in and it requires now a public sector entity to reduce the carrying amount to an amount which is equal to recoverable amount, of which now the difference between those two values, carrying amount and recoverable amount, is then known as the impairment loss. But we're going to look on how we determine that. Let's first of all, we do some introduction here, and we say that IPSAS 21, IPSAS 21 requires public sector entities to carry out impairment review if there is there is evidence showing that assets or its assets could be impaired. And this particular standard here, that is IPSAS 21, it basically relates now to impairment review on what we refer as non-cash generating assets. So what are non-cash generating assets? Non-cash generating assets are basically those particular assets which are owned by the public sector entities and which are not expected to generate any commercial return. So therefore, this standard requires that if there is some indication or basically some evidence showing such asset could be impaired, then this particular entity should go ahead and do what? Carry out an impairment review. So basically this impairment review entails comparing two values. So we can say this entails comparing the carrying amount of an asset, and specifically in this case we are referring to non-cash generating assets of a non-cash generating asset, and its recoverable service amount, and if the recoverable service amount, maybe we can abbreviate the recoverable service amount using this abbreviation, recoverable service amount. So, if the recoverable service amount, is less than carrying amount, equally we can abbreviate this carrying amount here using capital CA for carrying amount. And if the recoverable service amount is less than a carrying amount, then the asset is impaired. The asset is what? Is impaired. So, and if the asset is impaired, what a public sector entity should do is basically to proceed and determine what is known as impairment loss. So, how is the impairment loss determined here? So, let's look on the formula for that. So, impairment loss is equal to carrying amount, which is also known as the net book value, abbreviated as NBV, minus the recoverable service amount. We are going to define some of these particular terms here. So therefore, the impairment loss here we are saying is the difference between those two values, the carrying amount, which is also the net book value, and the recoverable service amount. Maybe we can look on before we look on basically how we determine this particular impairment loss using various methods. Maybe first of all we can define some of these particular terms here, and we say carrying amount is the net book value of a non-cash generating asset and cash generating asset, i.e. it is the value an asset is carried in the statement of financial position. So therefore we are saying that the carrying amount that is here is the same with the net book value of an asset, and we are saying that this is basically the value at which an asset is carried in the statement of financial position. So how do we compute this carrying amount, or how do we compute this particular net book value? So let's have the formula for that here. Net book value, or the carrying amount, this one is equal to the cost minus accumulated depreciation, So that is how we determine the carrying amount. Then from there, here we are also talking of another term here, which is the recoverable service amount. We have a recoverable service amount, and actually this is defined under this particular standard here to be the higher of two values. So we say that the recoverable service amount, this is the higher law of non-cash generating assets and cash generating assets. Number one, we have something called the fair value less cost to sell, fair value less cost to sell, which is also known as NRV, net realizable what? value, or number 2, something called the value in use. The value in use, of which in this case when we talk about the value in use, this is defined differently from the definition of value in use under IS 36. So value in use under IPSAS 21, this one is defined as what? As the present value. So we can say that this is the present value of remaining service potential, potential of a non-cash generating asset. A non-cash generating what? Asset. So that is the definition of value in use, which is basically different from how we define the same term under IPSAS what? Under IPSAS, not IPSAS rather, but under IS 36. So therefore what we have said here is that this particular standard, IPSAS 21, requires any public sector entity at the end of each year to determine or to carry out impairment review if there is some indication or basically some evidence which shows that such asset could be impaired. So we are saying this particular impairment review entails comparing two values. The first value is the carrying amount and what? The recoverable amount. In this case, we have said if the recoverable amount, this one is found to be less than the carrying amount, it is obvious that that asset is impaired. What an entity should do, what a public sector entity should do, is to determine the amount of impairment loss and also recognize that impairment loss as an expense in what referred as a statement of financial what? Performance, statement of financial performance. So, but equally, it is also important for you to know how do we determine these two values which you are comparing here, the carrying amount, recoverable service amount. Carrying amount, we are saying, is the same with the net book value of an non-cash generating asset, which is equal to the cost minus accumulated depreciation. And then how do you determine the recoverable service amount? We are saying you take the half of two values, the fair value less cost to sell or net realizable value, and then the value in use. Now, value in use, we are saying, is the present value of the remaining service what? Potential of non-cash generating asset. And therefore, this particular standard here, IPSAS 21, basically provide three methods, or in other terms, three approaches, which can be used by a public sector entity in terms of determining what referred as the value in use. But we are going to look on those particular approaches, those particular terms, which may be used in terms of determining the value in use at a later stage. But before we do that, I want us to look on, or we define some additional terms here. We look on definition of additional terms here. Definition of terms. Basically, these are additional terms we need to define, because already we have defined some few terms here, like carrying amount, like the recoverable service amount, and so on. So the other term we need to define here is something called a cash generating asset. Cash generating assets. So when talk about the cash generating asset, as the name suggests, this is basically any asset which is held by a public sector entity and which is expected to generate some commercial returns. Which is expected to generate commercial what? Returns. So therefore you can say that this is an asset held by a public sector entity, and which is expected to generate commercial returns, to generate commercial what? Returns. So in this case, when we talk about an asset generating commercial returns, it means that that particular asset generate now cash flows. Generate what? Cash flows. And generally, these are those particular assets which are owned by some entities which are under the control of the government, which are known as government business enterprises. Government business enterprises are those particular entities which are under the control of the public sector entities and which operate in the same way, just like the profit-oriented entities. Profit-oriented what? Entities. Maybe a good example of this, we can talk of something like Kenya Railways. So Kenya Railways, basically we can say it operates like any other profit-oriented what entity, though that particular entity is under the control of the government, is under the control of what? The public sector entity, because we know something like Kenya Railways is not reliant on continued government funding for it to be a going concern. So it is expected that the revenue which is generated by that entity, Kenya Railways, is able to sustain its operation. So therefore, that is a good example of a government business enterprises. And therefore, the asset which it owns, e.g. the trains and so on, those assets are basically regarded as or referred to as the cash generating what? Assets. Simply because you are saying those particular assets are expected to do what? To generate some commercial returns, or in other terms, they're expected to generate some what? Some cash flows. So we know that if, for example, today you want to travel from Nairobi maybe to Mombasa using a train, you have to pay for that. So basically it means that Kenya Railways generate now some revenue from those particular what? From those particular trains and so on. So in this case, we proceed and we say that holding an asset, holding an asset, we have a full stop there. Holding an asset to generate commercial returns, means that the asset is deployed in a manner consistent with that of profit-oriented entities. Profit-oriented entities. So holding an asset to generate commercial returns means that that particular asset is deployed, or in other terms, it is used by that public sector entity in a manner which is consistent with that basically deployed by what? Profit-oriented entities. Profit-oriented entities are those particular entities which operate with an objective for making profit, and anytime such an entities own an asset, those particular assets are deployed, are used in a manner, or basically they are used in order to generate what? To generate cash flows. To generate what? Cash flows. So maybe further we can proceed and we say, that holding an asset to equally generate commercial returns, returns indicates that the entity intends, number one, to earn commercial returns from the asset. Number one, earn commercial returns from the asset. And number two, that the entity or basically in this case, earn commercial returns which is equivalent, or basically which reflect, maybe you can just put it like that, which reflect the risk involved in holding that asset, risk involved in holding the asset. Holding the asset. So mean that holding an asset to generate commercial returns mean that the entity here intend to generate commercial returns, intend to generate some cash flows, and basically in this case we are saying that the cash flows which are to be generated are always equivalent to the risk which are involved in holding what such an asset. And finally, number two, we say that the entity intend to do what? To generate cash flows from the asset, from the asset. So basically that is the meaning of what you refer as the cash generating what asset. Basically this is one of the term which you may be required to define. There was a question which was tested some time back whereby the examiner was requiring the definition of this term, and actually the marks allocated in that question were 4 marks. So basically that what was expected of you. So the other term we also need to define here is non-cash generating assets. And cash generating assets. And basically we say that this refers to any other asset other than the cash generating what? Asset. So we can say this is any other asset, other than a cash generating asset. Other than cash generating assets, i.e. it is not expected to generate commercial returns, or in other terms to generate what? Cash flows. So therefore these are those particular assets which are owned by public sector entities and which are not expected to generate any form of cash flow. A good example is whereby, for example, the national government or even the county government may construct some classes in a public school. So those particular classes which are constructed in a public school, we know that they are assets but which are not expected to generate commercial returns. Equally, if, for example, like the national government or even the county government or even a parastatal, maybe buy a school bus or even a certain public school buys a school bus, that particular school bus is a non-cash generating asset. It is an asset which is owned by a public school, either a primary school or a secondary school, but which is not expected to generate any form of commercial return. So that is a non-cash generating and cash generating asset. So maybe from there we can proceed and we define the other term, which should be term number 3. The other term number 3, which is government business enterprises. Government business enterprises. And these one are abbreviated as GBEs. So these are those particular entities which are under the control of the public sector, and this one, they operate in the same way, just like the profit-oriented entities. And actually, we have said any asset which is owned by these particular entities here is a cash-generating asset. Is a cash-generating asset. So therefore, we can say that this is an entity with the following characteristics. Or basically you can talk of with the following features. Number 1, it has powers. It has powers to contract on its own. Number 2, we say that it is controlled by public sector entity. controlled by public sector entity. Basically, a good example of this is something like Kenya Railways. Kenya Railways operate under the Ministry of what? Of Transport. Is basically a good example of a GB. It's basically, it has powers to be able to contract it on its own. And also on the other hand, you have said that Kenya Railways operate on something called the full cost recovery. In other terms, it is not reliant on continuing government funding for it to be what? To be a going concern. So therefore, feature number 3, we can say, it do what? It sells goods, stroke services at full cost recovery, full cost recovery, all at a profit. At a profit. And number 4, we can say it is not reliant on continuing government funding, funding for it to be a going concern, for it to be a going concern. A going what? A going concern. So basically this means that GBs are not reliant, or basically they do not receive allocation from the national government on annual basis for it now to be a going what? A concern. So those are basically now the various features, or basically the various characteristics of what we refer as the GBs, or the government business what? Enterprises. Now before you look on how we determine the value in use. Remember, I say that in determining the value in use, there are various approaches which may be used by the public sector entity. Before we look on that, I want us to look on some of the factors which indicate that an non-cash generating asset may be impaired. So we look on the indicators of impairment. Indicators of impairment. So when talk about indicators of impairment, those are or these are those particular factors which may show that a non-cash generating asset could be impaired. And if this particular evidence, or basically these particular factors exist, then we are saying what a public sector entity should do at the end of the year is basically to carry out impairment review, compared to the two values, the carrying amount and the recoverable service amount. If the recoverable service amount is found to be less than the carrying amount, then it means that such a public sector entity should do what? Should proceed and determine now what it refers what? The impairment loss. So these particular indicators of impairment are generally classified into two categories. Number 1, we have the internal indicators of impairment. So generally, we can say these are like those indicators, those factors which indicate the asset could be impaired, and which mostly are under the control of the entity. So number 1 is what we refer as the physical damage. Physical damage of an asset. Damage of an asset. Number 2, we have what we refer as indication. Indication that service performance of an asset, service performance, or generally the performance of an asset, service performance of an asset, is worse than originally expected, expected. Number 3 is where we have decision which has been made to halt, or basically to stop the construction of an asset. Decision to hold. To hold is the same with to stop the construction of an asset. Construction of what? Of an asset. So basically these are some of the internal indicators of impairment. So anytime any of this particular factor exists, then it shows that the non-cash generating asset could be impaired. And we are saying, according to IPSAS 21, a public sector entity at the end of the year should carry out impairment review because there is some evidence that the asset could be what? Could be impaired. So basically these ones we have referred to them as internal indicators of impairment. Then from there we have the external indicators. So external indicators, basically these are those factors which shows that the asset could be impaired and which are not purely under the control of what? Purely under the control of the public sector entity. So the external factors which shows that a non-cash generating asset could be impaired include the following. Number one is cessation of demand of services provided by the asset. In very simple terms, this means that the services which were provided by the asset, those services are no longer needed. Maybe, for example, the national government had constructed some classrooms, and maybe that particular school has been closed down, maybe due to insecurity and so on. So it means that the services which were being provided by those particular assets are no longer what? Needed. So that may shows that those particular assets could be what? Could be impaired. Number two is where we have adverse changes in technological market. Adverse changes in technological market, or maybe technological environment. So this whereby, for example, if a public sector entity maybe own an asset like a machine, there is a more advanced machine in the market due to advancement in technology. So that is still another factor which indicate that that particular machine which is currently owned by the public sector entity could be what? Could be impaired. So therefore, these are basically some of the external factors which indicate that the asset could be impaired. Therefore, what you have said is that IPSAS 21 requires that anytime there is an evidence, there is a factor which shows that the asset could be impaired, then is a requirement that a public sector entity at the end of the year should proceed and carry out impairment review, in which case we said carrying out impairment review entails comparing two values, the carrying amount of the asset and its recoverable service amount, whereby we have said if the recoverable service amount is found to be less than the carrying amount, then an impairment loss should be what? Should be determined and also recognized as an expense in the statement of financial performance. Now, I want us to look on the various methods of determining the value in use, methods of determining the value in use, at the IPSAS 21. But even before we look on these methods, it is important to recall what we covered in topic 1 of financial reporting and advanced financial reporting and analysis. We looked on how private sector entities should determine impairment loss in accordance with this particular standard, IS 36. And we said the value in use under this particular standard here is equal to the present value of the expected cash flows to be generated by what? By the asset. But remember here, IPSAS 21 deals with impairment of non-cash generating assets. Non-cash generating assets. So meaning that this asset here do not generate any cash flow, do not generate any what? Cash. So therefore, the value in use, obvious, cannot be determined by discounting the cash flows which are generated by such what? An asset, simply because this asset do not do what? Generate cash flows. And therefore, what IPSAS 21 has done is that it has provided 3 methods which may be used by a public sector entity to determine the value in what? In use. So therefore, we can say that the value in use is determined or we can say the value in use can be determined using any of the following three approaches. So the first approach is called the depreciated replacement cost approach. So under this particular method here, how do we determine the value in use? So the value in use here is determined, number one, by taking the replacement cost. What is the replacement cost? Replacement cost basically is the cost which will be incurred by a public sector entity in terms of replacing an asset which is impaired. If, for example, we have like a primary secondary school which owns a school bus, and that particular school bus has been involved in a road accident, it has been declared as a write-off. So that particular secondary school may intend to acquire a similar bus with a similar capacity. So how much cost will be incurred in terms of acquiring a similar bus currently with a similar capacity? So that cost is what we refer as the replacement cost. So therefore, under this particular method here to determine the value in use, what we do is that we take the replacement cost, which always will be given to you, will be provided to you by the examiner. And then what we do is that we depreciate this particular replacement cost. We depreciate this replacement cost for an equivalent duration. The asset which is now deemed to be impaired was depreciated. Was what? Depreciated. So depreciate this replacement cost for an equivalent duration. The asset which is now deemed to be impaired was what? Was depreciated. Whatever you get here is the value in use. The value in use. So then we have the other method or the other approach used to determine the value in use. Number two, we have restoration cost approach. Restoration cost approach. So under this particular method, the value in use is determined as follows. So first of all, we take the replacement cost. I've explained what is replacement cost. Replacement cost. We depreciate it for an equivalent duration. The asset which is deemed to be impaired was depreciated. So mean that to this we less accumulated depreciation. Accumulated depreciation. Whatever you get here is known as depreciated replacement cost. Depreciated replacement cost. And then to this we proceed and we less something called the restoration cost. So what is the restoration cost? The restoration cost is the cost which is incurred by a public sector entity in terms of restoring an asset to its pre-impaired state. It's a cost which will be incurred to restore the asset how it was before it was impaired. Generally, this is the repair cost. This is the repair what? Cost. Whatever you have here is now what we refer to as the value in what? In use. And then we have the last method, the last approach used in determining the value in use, and that is the service unit approach. Service unit what? Approach. So under this particular method, we determine the value in use as follows. The value in use is determined as follows. First of all, just like what you have done up there, we take the replacement cost. The replacement cost. We have to depreciate this for an equivalent duration. The asset which is deemed to be impaired had been depreciated. So to this we less the accumulated depreciation. We less accumulated depreciation, and we get now the depreciated replacement, depreciated replacement cost. So once we have that depreciated replacement cost, what we do is that we have now to adjust this with the remaining service potentials for us to be able to get what? To get the value in use. So to get now the value in use, so we take this depreciated replacement cost, assuming now it is A. So we take A and then we multiply this. We multiply this with the proportion of the remaining service potential of a non-cash generating asset. When talk about the service potential of a non-cash generating asset, or the remaining service unit, this should be remaining service unit. Okay, so remember I've said we take this one, depreciated replacement cost, we multiply that with what? With the proportion of the remaining service units, remaining service unit. So when talk about the remaining service unit, we are talking of those particular units of a non-cash generating asset which are still providing services. Let me give a good example of that. We can be told that a certain public sector entity own a building, and maybe this particular building has, for example, 8 floors. But due to a number of reasons, this particular public sector entity has been ordered, for example, by NEMA, not to occupy the top 3 floors. The top 3 what? Floors. So it means that the remaining, or the units of this particular building, when talk about the units, we can talk of the floors. The floors which are being used are 5. So therefore, we say that the remaining service units are 5 out of what? 8. This is now what we refer to as the proportion of the remaining service unit. So once you have gotten now this depreciated replacement cost, you come and you multiply it with the proportion of the remaining service unit. Like in our case, the proportion of the remaining service unit will be what? 5 out of 10. 5 out of 8. And basically that will give you now what refer as the value in use. So therefore, according to IPSAS 21, there are those 3 approaches, those 3 particular methods which may be applied in terms of doing what? In terms of determining the value in what? In use. So here is today's assignment. Question 1, define impairment of non-cash generating asset in accordance with IPSAS 21. Question 2, with reference to IPSAS 21, impairment of non-cash generating asset. Roman 1, explain the meaning of cash generating asset. Number 2, define a government business enterprises. Roman 3, analyze the factors that could indicate that the asset is impaired. And then we have the last question, which is question number 3. Explain 3 approaches an entity can use to determine the value in use of a non-cash generating asset in accordance with IPSAS 21. So for now, I want us to stop at that point. Once we meet in our next session, I want us to look on some illustration questions which are based on the past paper questions regarding how to determine the impairment loss under those 3 approaches: the depreciated replacement cost approach, the service unit approach, and also the restoration cost approach. For now, is a bye. Hi candidates, welcome to another session of manifested online classes. So in this session, I want us to continue with the subtopic of impairment of non-cash generating assets. And in this particular session specifically, I want us to look on some illustration questions regarding how to determine the impairment loss of non-cash generating asset under the 3 approaches we have discussed in our previous session. that is depreciated replacement cost approach, restoration cost approach, and what we refer as the service unit approach. So let's read or go through that particular illustration. You see what we are told, and it reads on 1st January 2009, the government built a market at a cost of 150 million. The market was expected to provide services for 40 years. On 31st of December 2018, after 10 years of use, a fire caused a severe structural damage to the market. Due to safety concern, the market was closed down for repair that would cost 106.5 million. These repairs were made to restore the market to occupiable condition. The current cost of a new market is shillings 300 million. So what have we required is to determine the impairment loss to be recognized for the market using the cost restoration approach. So what we are required to do there is we determine the impairment loss using a restoration cost approach. So the first thing which you need to remember here as a student is how do we determine the impairment loss of an non-cash generating asset under IPSAS 21. So the impairment loss is equal to the carrying amount of a non-cash generating asset, which is the same with the net book value, minus the recoverable service amount. So therefore, what we need to do for us to be able to determine this particular impairment loss, we have to determine these two values, the carrying amount and also the recoverable service amount. So let's determine we start by determining the carrying amount. Which is the same with the net book value, and we are determining this on which date? On 31st of December 2018, because what we said in our previous session is that impairment review is undertaken whenever there is a factor or indicator showing that the asset could be impaired. And actually what you are told is that on 31st of December 2018, this market, which was constructed by the government, which is a non-cash generating asset, was damaged by fire. So that is a factor which indicates that this market, which is a non-cash generating asset, could be impaired, and therefore the impairment review must be carried out on that date. So we need to have the two values on that date. So the net book value or the carrying amount, this one is equal to the cost, and we are given the cost of the market, which is 150 million. So we less the accumulated depreciation. So the accumulated depreciation in this case will be computed by taking 150 million. And then in sentence number 2, we are told that this particular market, which was constructed by the government, it was expected to provide services for the next 40 years. So anytime you're given the expected useful life of an asset, you then determine its depreciation using the straight line method. You take the cost divided by the estimated or the expected useful life of that particular asset, and then this will give us now the depreciation per annum. So what we need to do is to determine, we are determining depreciation for how many years. So from 2009, when the market was constructed or was built, up to 31st of December 2018. So how many years do we have there? So we have 2009, 2010, 2011, 2012, 2013, 2014, 2015, 2016, 2017, 2018. So these are how many years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we have 10 years. So meaning that our interest is to compute or to determine the accumulated depreciation for how many years? For 10 years. So this is the cost, which is 150 million. So let's compute this particular accumulated depreciation, which will be equal to 150 divided by 40 years times 10, which will give us 37.5 million. We less that from the cost, and whatever you get here is the carrying amount or the net book value. So we less that from 150 million, which will give us 112.5 million. So having that, then we proceed and we determine the what? We determine the recoverable service amount. So we have to recall what we said in our previous session, that the recoverable service amount, recoverable service amount, this is the higher of two values, higher over two values. Number one, the fair value less cost to sell, which is also known as the net realizable value, net realizable, or we can just abbreviate it as, we can just put it as NRV, net realizable value, or Roman 2, what we refer as the value in what? In use, the value in use. Now, if you check on the information which you're given in this particular question here, you'll be able to see that the examiner has not given us what we refer as the fair value less cost to sell, because the fair value less cost to sell, this is the amount at which now the asset can be sold at currently minus any cost which will be incurred in selling that particular what? Asset. And as per the information which you are given, this figure is not provided. So this figure is not provided. So therefore, this will not apply in our case. We are not going to consider that figure there. What we need to do is we proceed and we determine the value in use. Now, remember in our previous session, we said we have three methods, three approaches which can be used to determine the value in use. But in this particular question, the examiner is requiring us to do that using a method which is known as what? The restoration cost approach. So therefore, we are determining the value in use using the restoration cost approach, restoration cost approach. So how do we determine the value in use under the restoration cost approach? So first of all, we take the replacement cost, which is basically the cost which will be incurred currently in terms of replacing that asset which is damaged. And I think in the last sentence of this particular question, we are told the current cost of a new market is 300 million. So if the government want to construct a similar market currently, that will cost the government 300 million, and 300 million, meaning that this is the replacement cost. Then what we do, we depreciate this replacement cost for this equivalent duration. So what that means is that to this replacement cost, we less accumulated depreciation, which will be equal to the replacement cost. And then we are saying we depreciate 300 million for an equivalent duration. So meaning we divide that with 40, just like what you have done here, times what? Times 10. Times 10. So this will give us now an amount of how much? So we have 300 million divided by 40 times 10. So which will give us 75 million. We less it from that figure, which will give us 225 million. So whatever you have here, we refer to this as depreciated replacement cost. Now, after getting that under this particular approach here, we proceed and we less the restoration cost. So remember, we said the restoration cost in our previous session is the cost which will be incurred in terms of restoring an asset to its pre-impaired state. So essentially, we said that this is equivalent to the repair cost. How much repair costs will be incurred by this particular public sector entity in terms of repairing an asset which is now deemed to be impaired? And I think if we go back to the question which you are given, to the information which you are given, we are told due to the safety concern, this market was closed down for a repair to be done, and we are told that repair will cost, or basically the repair cost is 106.5 million. So that is now the restoration cost. So we less it from our figure up there. So you have 225 minus 106.5. So which will give us 118.5 million 0.5 million. Yes. So this is now what? This is the value in use. The value in use. So having the value in use, next what we need to do is to determine now the recoverable service amount. The recoverable service amount, of which you are saying the recoverable service amount should be the higher of these two values. Should be the higher of what? Of the fair value less cost to sell, this one, and the value in use. And take into account we don't have this value, it is obvious that our recoverable service amount will be equal to the value in use. So therefore the recoverable service amount is 118.5 million. 0.5 million. So having that value, what we need to do is to determine whether this asset is impaired or not. Remember we said that an asset is said to be impaired whereby the recoverable service amount of such an asset is less than the carrying amount. So in our case, we already have these two values. So we have the recoverable service amount, which is a figure of 118.5 million. What about the carrying amount? The carrying amount is what we have here. That is 112.5 million. So we need to check, is this particular amount here, recoverable service amount, is it less than this? So obvious, this one is not less. This one is not less than the carrying amount, is not less than the carrying amount. What does that mean? It means that this particular market here, this particular non-cash generating asset here is not impaired. Is not what? Impaired. Therefore, no impairment loss which is to be recognized. So that will be the answer here. So we say the asset is not impaired, simply because the recoverable service amount is not less than what? The carrying amount. The asset is not impaired, and therefore no impairment loss is to be recognized. No impairment loss is to be what? Is to be recognized. So basically that is it, that what was required. So let's move to the other illustration, and it reads, on 1st of January 2014, the government acquired a modern software to enhance the service delivery at a cost of 350 billion. The software had estimated useful life for over 8 years, and its benefits would accrue evenly on a straight line basis over the software useful life. As at 31st of December 2018, the usage of the software had dropped to 15% of its originally anticipated demand. A software to replace the remaining service potential of the existing software would cost 150 million. So what are we required? We are required to determine the impairment loss to be recognized for the software using the depreciated replacement cost approach. So here what we are required, remember this was Roman 1 of our illustration. That was Roman 1. Roman 2, we are also required to determine the impairment loss to be recognized, but using which approach? Using the depreciated replacement cost approach. And it is also important for you to recall that the difference between these three methods, what we have done here, restoration cost approach, the depreciated replacement cost approach, and the service unit approach, the difference is purely how we determine the value in use. So how we determine the carrying amount and the net realizable value, the approach is the same. The difference comes in when determining the value in what? In use. So what we just need to remember here is, or we need to have the formula for computing the impairment loss, which you have said is equal to carrying amount, which is the same with the net book value of the asset, minus the recoverable service amount. So we need to determine these two values, and basically we are determining this particular impairment loss on the date when there was some evidence showing that this particular asset could be impaired. And I think there is some information which you are told there, or which you are given, whereby you are told on 31st of December 2018, the usage of this software had dropped by 15%. Had dropped by 15 what? Percent. So meaning that the performance of this particular software is worse than what was originally expected. So this is one of the factors which indicate that this particular asset could be impaired, and therefore, in accordance with IPSAS 21, the public sector entity should carry out impairment review at the end of 2018. So therefore, we are determining this carrying amount, this particular net book value on that date, on 31st of December 2018. So to compute this is basically quite simple. We take the costs of the software, which we are given in the first paragraph, which is 350 million, and then we less the accumulated depreciation. How do we compute the accumulated depreciation? We take 350 million, divide that with the expected useful life of this asset, which are 8 years, and then on this date, this particular software had been used for how many years? So remember, it was acquired at the start of 2014. So meaning that it was used, the software was used in 2014, 2015, 2016, 2017, 2018. Those are how many years? 1, 2, 3, 4, 5. So we need to compute the accumulated depreciation for 5 years. And basically that will give us what? That will give us the net book value or the carrying amount. So let's compute that. We work out that. We have 350 divided by 8 times 5. We rest that from the cost of 350, and that will give us 131.25 million. So that is the carrying amount or the net book value at the end of 2018. So then from there we proceed, and we already have this, we proceed, we determine the recoverable service amount. Recoverable service amount. That is the abbreviation for that, recoverable service amount. And basically this is the higher of two values. This is the higher of two values. Number one, the net realizable value or fair value less cost to sell. And equally, if you check on the information given in this particular question here, this figure is not given. We are not given the NRV, the net realizable value or the fair value less cost to sell. So that will not apply here. So we take the higher of that, or number two, what we refer as the value in use. The value in what? In use. Now the value in use, which approach are we using here? The examiner requires to compute this using this particular approach, the depreciated replacement cost approach. So therefore, that is the approach which you're using here, depreciated replacement cost what? Approach. Yes, so let's determine the value in use under that particular approach or method. Value in use. So to determine the value in use, what we do, we take the replacement cost. The replacement cost is basically the cost which will be incurred by the government in constructing a similar market. We are given that information, not a similar market, but in terms of acquiring a similar software. A similar software, we are told acquiring a similar software currently, or a similar software currently goes for 150 million, and we depreciate this, or to this we less accumulated depreciation, which will be equal to the replacement cost, which is 150, and we depreciate this for an equivalent duration, as this particular asset. Divide that with 8 times what? Times 5. Times 5. So let's work out that. We see what it will give us. We see what we are going to get here. We have 150 divided by 8 times what? Times 5. Times 5, which will give us 93.75 million. And whatever you get here is now the value in what? In use. So that is how we determine the value in use under this particular approach here, or under this method, which is depreciated replacement costs approach, which is 56.25. So having that, finally, we need to get now the recoverable service amount. Recoverable service amount. The recoverable service amount, you should take now the higher of this value in the value in use and the fair value less cost to sell. In our case, remember, we don't have that, so automatically our value in use will be equal. Sorry, our recoverable service amount will be equal to the value in use, 56.25 million. 0.25 what? Million. So having that, then we equally need to determine whether our asset is impaired or not by checking whether the recoverable service amount, whether this amount is less than the carrying amount. Is less than the carrying amount. This was supposed to be less. It's supposed to be less than the carrying amount. So the recoverable service amount is 56.25 M. What about the carrying amount? Is this one, 131.25 million. So in our case, we can say this one, the recoverable service amount is what? Is less than this one. So meaning that we need to proceed and we determine what? The impairment loss. So the impairment loss is determined using this formula. So the impairment loss is equal to carrying amount, which you already have here, 131.25 million minus the recoverable service amount, which we have here, 56.25 million. And we get the difference. We get the difference. Yes, so which will be 75 million, 75 million. So that is basically the impairment loss, or how we determine the impairment loss using that particular what? Using that particular approach, which is known as the depreciated replacement what? Cost. I want us to look on the last illustration. We look on the last illustration. So let's go through the illustration. We see what we are told. So the illustration leads with reference to IPSAS 26, which deals with the impairment of cash generating asset, explaining the following terms. So IPSAS 26 basically is equivalent to IS 36. So the definition of those particular terms under IS 36 is the same with the IPSAS 26. So the first term we are required to define is the value in use. So the value in use, in very simple terms, is the present value of the expected cash flows to be generated from the continued use of the asset and also from its what? Disposal. So what about the recoverable amount? The recoverable amount, this one, is the higher. We say this is the higher of cash generating assets, value in use, or number two, fair value less cost to sell. Less cost to sell. That is how we define those particular terms. And then part B, that is what I want us we compute here, or basically we do. So we are told on 1st January 2008, Mashabani County Education Department purchased a printing machine at a cost of 40 million. The department estimated that the useful life of the machine would be 10 years. And then you're told on 31st of December 2012, it was reported that automated feature of the machine function did not operate as expected, resulting in 25% reduction in the machine annual output over the remaining 5 years of its useful life. The cost of a new printing machine was 45 million as at 31st of December 2012. So what are we required to do? We're required to determine the impairment loss using the service unit approach. So we are required to determine the impairment loss using service unit approach. Using a service unit what? Approach. The first thing always you need to have here is the formula for computing the impairment loss. The impairment loss is equal to a carrying amount of the asset minus the recoverable service amount. Recoverable service amount. So we need to have these two values. Let's start by determining this one, carrying amount, which is basically the same with the net book what value. And equally, we are determining this when there was a factor which showed that this asset could be impaired. And there is some information which are given in that question that on 31st of December 2012, it was reported that automated feature of this machine was not operating as expected, resulting in 25% reduction in the machine annual output. It means that the performance of this asset was worse than what was originally expected due to that feature, automated feature of the machine not working as what as expected. Therefore, an impairment review was supposed to be conducted on 31st of December 2012. So how do we determine the carrying amount? We take the costs, which we are given in paragraph 1 as 40 million. 40 million, we less the accumulated depreciation. The accumulated depreciation would be 40 million. Divide this with the expected useful life of this machine, which are 10 years, and then times the number of years the machine had been used before the end of, or basically as at 31st of December 2012. So how many years do we have? Take into account it was acquired in 2008. So we have 2008, 2009, and then we also have 2010, 2011, 2012. So these are 5 years. 1, 2, 3, 4, 5. So we have 5 years. 5 years. So this will give us what? This will give us 20, meaning that the carrying amount or the net book value will be what? Will be 20 million. So having that, we proceed and we determine now the recoverable service amount. The recoverable service amount, which we know by now that this is the higher of two values. Higher of number 1, net realizable value, or the fair value less cost to sell. And in our case, equally, we are not given this. We are not given this. In most of the questions, it is important to note that you will not be given that fair value less cost to sell, because it is very rare for the government to be able to sell its asset. To be able to sell its what? Its asset. That's why you can see actually in all questions which you have done, there is nowhere we have been given, or there is no question or no illustration whereby you are given the fair value less cost to sell. So we take the higher of that all. Number 2, the value in use. The value in what? In use. Now, this value in use, we are required to compute that using this approach here. The service unit what? Approach. Service unit what? Approach. So how do we determine the value in using this particular approach? The first thing we need to do is to compute the depreciated replacement cost. So we take now the replacement cost, which is also given in that question in the last sentence, whereby you are given the cost of a new printing machine. If the government wants to acquire a new printing machine currently, such a machine will be bought at 45 million. So what we need to do is we less accumulated depreciation, which is computed by taking the replacement cost, and then we depreciate that amount with an equivalent duration. So we divide this with 10 times what? Times 5, which is basically half of that, 22.5 million. And whatever you get here is known as the depreciated replacement cost, which equal to be 22.5 million. So having this depreciated replacement cost and the service unit approach, we say to get the value in use, we take the depreciated replacement cost, and then we multiply that with the proportion of the remaining service potential. We multiply that with the proportion of the remaining service potential. There is something which are given in that particular question, whereby we are told, due to that automated feature of the machine not operating as expected, the annual output of this machine in the next 5 years was expected to reduce by 25%. So meaning that the remaining service potential of this particular machine over the next 5 years, we can say is 75%, because the annual output of this machine in the next 5 years is expected now to do what? To reduce by 25%. So therefore, what we have done to compute the value in use, we have taken the depreciated replacement cost, and then we have adjusted that. We have multiplied that with the proportion of the remaining service remaining service units. So we have 22.5 times 75%, which will give us now what? Which will give us 16.875 million. And I think now, having that, finally what we need to do is to determine the recoverable service amount. We determine the recoverable service amount, of which the recoverable service amount automatically will be the higher of these two values here. So remember, in our case, we don't have this. So automatically the recoverable service amount will be equal to value in use. The value in use is this one, which is 22.5 million. 0.5 what? A million. And I think having that, finally, we need to determine whether this asset is impaired or not by comparing the two values, by determining whether the recoverable service amount is less than carrying amount. So our carrying amount, we have it here, 20 million. What about the recoverable service amount? Is 22 point, not 22, sorry. This should be whatever I have determined here. Let's change that. So this, the recoverable service amount is 16.875 million. So our recoverable service amount is 16.875 million. So what we need to do is basically to determine, is this less than that? Yes. So we can see the recoverable service amount is less than the carrying what amount. If that is the case, then finally we need to determine the impairment loss, because this particular asset is impaired. The recoverable service amount is less than the carrying amount. So the impairment loss will be equal to carrying amount, which is 20 million, minus the recoverable service amount, which is 16.875 million. So what will be the difference here? It is 3.125 million, and that is the impairment what? The impairment loss. So basically that is it, that what was required in those particular three illustrations, whereby the examiner was requiring, as a candidate, you compute the impairment loss of non-cash generating asset in accordance with the IPSAS 21. So therefore, we have looked on how to compute the impairment loss under the depreciated replacement cost approach, under the restoration cost approach, and also under the service unit approach. And basically that brings us now to the end of that subtopic. So once we meet in our next session, we are going to look on how we determine the impairment loss under IPSAS 26. So for now, we stop at that point. See you in the next session. Hi candidates, welcome to another session of manifested online classes. So we are still continuing with the topic of public sector accounting, and in this particular session, I want us to look on IPSAS 26, which deals with the impairment of cash generating asset. Now, the first important point for you to note here is that IPSAS 26 is drawn primarily, or is written primarily from IS 36. So meaning that in terms of how we determine the impairment loss under the two standards, IS 36, International Accounting Standard number 36, and IPSAS 21, IPSAS 26, the same approach is used. And if you can be able to recall what we said under IS 36, or in the topic of determining the impairment loss under IS 36, we said impairment loss of those particular assets which are owned by the private owned entities or the profit oriented entities is equal to the carrying amount minus the recoverable amount. The recoverable amount, we are determining that as the higher of two values, the net realizable value or the fair value less cost to sell, and the value in use. And the value in use, we were determining that as the present value of the estimated what? Cash flow. So that is the same approach which is used under this particular standard what? Here. But maybe first of all we can say that IPSAS 26 is drawn primarily from IS 36. IS 36. So basically this means that the two standards are the same. Are the same. It's drawn primarily from IS 36, and therefore impairment loss under the two standards, the two standards we are talking of IS 36 and IPSAS 26 is the same. Impairment loss under the two standards is determined in the same way. Determined in the same way. Let's look on how we determine this particular impairment loss under the two standards. So the impairment loss in this case is always equal to the carrying amount of an asset, or basically the cash generating asset, and then to this we layer something called the recoverable amount. So we don't use the word recoverable service amount as we were using under IPSAS 21, but here we talk of recoverable amount. So the carrying amount or the net book value, this is determined in the same way. We take the cost minus what? The accumulated depreciation. But what about the recoverable amount? The recoverable amount. So the recoverable amount, this is defined as the higher of two values. So basically we can say that this is the higher of cash generating assets. Number one, net realizable value, or the fair value less cost to sell. So basically this is the amount the entity will get after selling the asset currently minus the cost which will be incurred in selling that particular what? Asset. We take the higher of that, all over to something we refer to as the value in use. The value in what? In use. The value in use. So basically in this case, when we talk about the value in use of cash generating assets, value in use of cash generating asset, this is equal to the present value of the expected cash flows, expected to be generated from continued use of the asset, continued use of assets, use of assets, and from its disposal, So that is how we define the value in use of a cash generating what? Unit. Recall what we said in our previous session. To determine the value, or basically the value in use of a non-cash generating asset, we define that as the present value of the remaining service potentials of a non-cash generating asset. So therefore, you can see the definition of this particular term here. The value in use under IPSAS 21, IPSAS 26 is different. That is something which is important for you to be able to do what? To note. You may come across a question whereby the examiner is requiring you to define the value in use under IPSAS 21 or under IPSAS 26. You can see the definition is what? Is the same. So I think we can look on additional definitions here, which equally you may be required to define in an exam. Additional definitions. The first term maybe we can start by defining here is a cash generating unit, abbreviated as CGU. So when talk about the cash generating unit, basically we say this is a group of, or actually the smallest group of identifiable assets which are owned by an entity or which are held by an entity with an objective, with a primary objective of generating some cash flows which are largely independent from cash flows generated by other what? Assets. So therefore we can say that this is the smallest identifiable group of assets held by an entity with a primary objective of generating commercial returns, or basically cash flows that are largely independent from cash flows, or basically from other or from commercial returns, cash flows or commercial returns generated by other assets or group of assets, or group of what? Of assets, or group of assets. So that is how we define a cash generating unit. A group of what? Asset which are held with a primary objective of generating cash flows which are independent from cash flows which will be generated by other what? Assets. So the other term we also need to define here is maybe we can define the value in use, although I think we have briefly mentioned that here. So we define the value in use of a cash generating asset. And we have said that this value in use of a cash generating unit is quite different from the value in use of a non-cash generating unit, because you have said that this is basically equal to the present value of the expected cash flows. The expected what? Cash flows which will be generated from the continued use of the asset and also from its disposal. So these are basically some of the terms which the examiner, or which you may be required to define in an exam. One of it is the recoverable amount, and in this case we are talking of the recoverable amount of cash generating assets. Cash generating what? Assets. You may also be required to define this other term here, which is a cash generating unit, and also what you refer as the value in what? In use. But basically what you have said is that IPSAS 26 and also IS 36 basically are the same, meaning that how we determine the impairment loss at the two standards is actually the same. And actually we don't have any question which has been tested from this particular standard here, whereby the examiner was requiring a candidate or candidates to compute now the impairment loss under IPSAS what? 26. So the questions which are usually tested are questions under IS what? 36. So most of the questions which come from this particular standard here, they require you to define a number of of terms. Like you can be required to define the cash generating unit, the what you refer as the value in use of cash generating asset, or maybe the recoverable service amount. So that basically is the end of that particular small subtopic regarding a determination of impairment loss of the cash generating assets in accordance with IPSAS 26. So for now, here is today's assignment with the reference to IPSAS 26, impairment of cash generating asset. Explain the following terms. Number 1, value in use. Number 2, recoverable amount. And number 3, a cash generating unit. So that is today's assignment. See you in the next session. Hi candidates, welcome to another session of Manifested Online classes. My name is Joseph Kimani, your lecturer for financial reporting and advanced financial reporting. So in this session, I want us to look on topic number 4. And in this topic, the topic is analyzing financial statement. So in this topic, you're going to look on 4 subtopics. The first subtopic you're going to cover is the topic regarding computation of earnings per share in accordance with the International Accounting Standard number 33. Subtopic number 2 is related party disclosures, where we are going to define who are related parties, and also we see the information which a company is expected to disclose as far as the related party transactions are concerned. Subtopic number 4, we are going to look on preparation of a segment report in accordance with IFRS 8. And then finally, we are going to look on financial reorganization and reconstruction. And basically in that particular subtopic, you're going to look on 2 ways in terms of how the company may restructure. That is the internal reorganization or the capital reduction, and what we refer as the internal reorganization or internal, that is external reorganization, or basically the external reconstruction. So therefore, here we are going to look on those 4 subword topics. So I want us to go straight to topic or to subtopic 1, which is regarding the computation of earnings per share, that is EPS. And in this topic, we're going to look on a number of issues. 1, we are going to define what is earnings per share. Number 2, we are going to look on the significance. What is the benefit of the company computing the earnings per share? And then from there we proceed and we look on the 2 types of the earnings per share to be computed and disclosed by the listed companies, and that is the basic earnings per share and the diluted earnings per share. So mean that by the end of the day, once we are through with it, with this particular topic, you must be in a position to define earnings per share, to know the significance of earnings per share, and also to compute the basic and diluted earnings per share. But I want us to start by defining what is earnings per share. And EPS basically refers to the amount of profit or the amount of earnings which is attributable to each ordinary share issued by the company. Is the amount of profit which is attributable to each ordinary share issued by what? By the company. So therefore, here we can say EPS, this is amount of profit, amount of profit or earnings attributable to each ordinary share, issued by a company. It is the amount of earnings, or basically the amount of a profit which is attributable to each ordinary share issued by what? By the company. Basically, what you have said is that all listed companies, and these are those particular companies whose shares are trading in the securities exchange market, it is a requirement that they must compute and also disclose the earnings per share as part of their notes, as part of the note to the financial statement. So we can say listed companies are required by IAS 33 to compute and disclose earnings per share. So by disclosing mean that this particular earnings per share which is computed, it should be part of the notes to the financial statements. Now, what are the significance, or basically what are the importances, or what are the benefits of this particular earnings per share? So let's look on the significance, or in other terms, we can say that these are benefits of earnings per share. So once this earnings per share is computed, how is it important to the company and also maybe to the shareholders and other stakeholders? Number one is that earnings per share helps to compare financial performance of an entity over time. Basically, what that means is that as a shareholder of a company, you can be able to use this particular earnings per share to compare the performance of the company over a number of years. Basically, to know or basically to compare the profitability, how the company has been performing over a number of years. Number two is that this particular earnings per share also helps to compare, maybe we can talk of profitability of different entities, to compare performance of different entities. So mean that the earnings per share can also be used in terms of comparing performance of company A and performance of company B. Number three is that the earnings per share is also used, we can say it is used in computing, the price earning ratio. So the price earning ratio, this is basically a ratio which is computed by taking the market price per share, and then we divide that with the earnings per share. So to compute that ratio, definitely you need to have the earnings per share. And also this earnings per share, we can say, is used by shareholders to know the amount of profit generated for each share held. In the company. So as a shareholder of the company, you can be able to know the amount of profit that particular company was able to generate for each share held in that particular company. So therefore, those are basically some of the significance, some of the benefits of the earnings per share, which we are saying must be computed, disclosed by all the listed companies. So before we look on how we compute the earnings per share and also the different types of earnings per share, first of all, I want us to look on definition of various terms. So some of the terms we need to define here. Number one is something called the potential ordinary shares. These one are abbreviated as POS. And this refers to any contract which has been entered into by the company, or any other form of financial instrument issued by the company, and which requires the company to issue ordinary shares in the future. So we can say it is a contract or financial instrument requiring an entity to issue ordinary shares in the future. So examples of these include stock options. Stock option is a contract between the company and the employees that for the company to issue shares to the employees in future at a price below the market price. Another good example of this is convertible securities. Convertible securities, e.g. convertible debentures. If you acquire convertible debentures of the company, then you have the right to do what? To convert them into ordinary shares. Those are good examples of the potential ordinary shares. So the other term which you also need to define here is an option, and warranties. So options and warranties, on the other hand, these are those particular contracts which requires the company to issue ordinary shares in future at a price which is below the market price. A good example is whereby the employees of the company will be given a privilege or basically a right to buy the shares of the company in the future at a price below the market price. So therefore, we can say that this is a contract, requiring an entity to do what? To issue ordinary shares in future at a price below market price per share, at a price below market price per share. So that is basically the other term which you must be in a position to define. The other term is something called the contingently issuable shares. Contingently issuable shares. So when we talk about the contingently issuable shares, basically we say that these are those particular shares which are issued by the company in the future, either at no consideration or at nil consideration or at retro consideration, once certain specified conditions have been met. For example, in this case, the company can promise to issue shares to its executive, or basically to the executive managers, if the profit of the company exceed a certain amount. So mean that once the profit of the company exceed a certain amount, then the senior managers will be issued with the shares of the company free of charge. So basically, this is something which is exercised by most of the companies. For example, if you check company like Safaricom, company like Equity Bank, they ordinarily issue shares to the senior managers once the profit of the company exceeds a certain amount. So therefore, we can say that these are shares. These are shares issuable in the future, or issuable at nil, or retro consideration. Once specified conditions are met. Once specified conditions are met. Once specified conditions are met. Yes. So that is the other term. The other term we need to define here, number 4, is the term dilution. So dilution, basically these to dilute is basically to reduce the effect of something. So therefore, this is the reduction in the earnings per share, or basically the increase in the loss per share, on the assumption that the potential ordinary shares, e.g. convertible debentures, or maybe stock options, have been converted into ordinary shares. So therefore, you can say that this is the reduction in in profit, or basically let's talk of in earnings per share, in earnings per share, or increase in loss per share on the assumption that potential ordinary shares potential ordinary shares, which are abbreviated as POS, have been converted into ordinary shares. We refer to that as dilution. The other term is anti-dilution. So anti-dilution now is the direct opposite of dilution. So mean that anti-dilution now is the increase in earnings per share or decrease in loss per what? Per share, on the assumption that POS have been converted into ordinary shares. So we can say that this is a increase in earnings per share, that is EPS, or decrease in loss per share, on the assumption that potential ordinary shares, POS, have been converted into ordinary shares. Have been converted into ordinary shares. So basically, these are some of the terms which you must be in a position to define. You may come across a question whereby the examiner is requiring you to define some of this particular word term. Like there was a question which was there in the past papers, and that question was requiring the definition of the potential ordinary shares and the contingently issuable shares, and still the question there was requiring the definition of the term what or explanation of the term what? Dilution. So therefore you must be in a position to do what? To define any of those particular word terms. Equally, you should be able to remember those particular word significance. So here is today's assignment. Question number 1: why is earnings per share EPS considered a crucial metric for investors when evaluating companies' performance? Number 2: how does earnings per share help shareholders in assessing the profitability and growth potential of company over time? 3: what factors can influence a fluctuation in earnings per share, and what implication does this fluctuation have for investors? Question 4: explain the concept of potential ordinary shares and how they impact the calculation of earnings per share. 5: what are options and warranties in the context of EPS calculation, and how does they affect the number of outstanding shares? The other question: define contingently issuable shares and discuss their significance in calculating the diluted earnings per share. The other question: what is meant by dilution in context of EPS, and how is it important for investors to understand its implication? The other question: how does stock option, warrants, and convertible securities contribute to dilution, and how is this reflected in earnings per share calculation? The last question: explain the concept of anti-dilution and provide examples of measures companies might take to prevent dilution of earnings per share. So that is today's assignment. I want us to take a short break, or basically we take a break. Once we come back in our next session, we are going to look on the types of earnings per share to be computed, And then from there we start by looking on the computation of the basic earnings per share. Hi candidate, welcome to another session of manifested online classes. And I want us we continue with the topic of earnings per share. So this is our lesson number 3. In the previous lessons on the same topic, we defined what is earnings per share. We looked on the significance or basically the benefit of earnings per share. And also we were able to define some few terms. In lesson number 2, we defined what is basic earnings per share, and actually looked on how basic earnings per share is computed, and also we discussed on some of the reasons as to why the number of ordinary shares issued at the start of the year may change. So in this session, I want us to do an illustration question regarding the computation of basic earnings per share. And that illustration question is based on a past paper question, and the question is November 2019, which is question number 5A. So we go through the question and then we see what the examiner was requiring. So the question reads, Dakika Limited has prepared its consolidated financial statements for the year which ended 30th September 2019, extract of which are shown below. Also provided below are extract of the consolidated financial statement for the year to 30th September 2018. So we are given some information for 2 years, the year which ended 30th September 2018 and 2019. So number one, we have profit before interest and tax. We have the finance cost. We have the tax charge. We have the ordinary dividends paid, preference dividends paid, and profit attributable to non-controlling interest. And then you're told you have also obtained the following information in respect of company's share capital. Number one, you're told the ordinary shares as that is ordinary share capital as at 1st of October 2017 was shillings 15 million, made up of shares of shillings 5 par value. Number two, you're told Dakika Limited issued some 500,000 shares at full market price on 1st of January 2018. And number three, we are told Dakika Limited also made a right issue of two new ordinary shares for every 10 ordinary shares held as at 1st April 2019. The right issue price per share was shillings 42.5. Market value per share as at the same date was shillings 48. Number four, we are told Dakika Limited also had 1 million 6% shillings 10 par value non-redeemable shares as at 1st of October 2018. So from that particular information, what the examiner was requiring, number one, is we compute the basic earnings per share, BEPS, for the year which ended 30th September 2018. And number two, we compute the diluted, the basic earnings per share for the year which ended 30th of September 2019. So here we are required to compute the BEPS, basic earnings per share, for 2 years. And what we said is that in computing the basic earnings per share, we take the profit attributable to ordinary shareholders, we divide that with the weighted average number of ordinary shares. In other terms, we take the PATOS, divided that with what? With the one-offs. So that is the first thing we need to have here. That is a formula for computing the BEPS for the first year which ended 30th of September 2018. So the formula here is that we take the PATOS, which in full is the profit attributable to ordinary shareholders. We divide that with one-offs, weighted average number of ordinary shares. So we need to compute these two items. We start by determining the profit attributable to ordinary shareholders. And we start with that for the first year, which ended 30th of September 2018. So in terms of how we compute this, we said we take the profit for the year, or the profit after tax, less the preference dividends for that year, and then we less any profit attributable to non-controlling interest. So what you're given in that particular question, we don't have the profit after tax, but we have the profit before interest and tax. So what we need to do for us to get the profit after tax, we take that profit before interest and tax, we less interest, and also we less now the tax, so that we get now the profit after tax. So to get the profit after tax, so we're going to take the profit before interest and tax, and we are starting with the year 2018, which is given as 7012. So to this we less the interest, which in other terms we refer to as the finance cost, and then we less tax, which is 1264, and that now will give us the profit after interest and what? After interest and tax. And then to this we also less the preference dividends. Preference dividend. You also have to recall what we said in our previous session, that if the preference shares issued by the company are redeemable, we don't less their dividends here, because they have already been deducted in arriving at this particular profit as part of the finance cost. But in the additional information number 4, we are told that preference shares issued by this company, they are non-redeemable. They are non-what? Redeemable. So therefore, you're going to less those particular dividends here, and you are given the dividend 60,000, and then to this we also less the profit attributable to non-controlling interest. We have that particular figure as a figure of what? 160. So whatever you're going to get here is what we refer to as the PATOS, the profit attributable to ordinary shareholders. So let's compute that, but we need to first of all determine the profit after tax, which is 7012 minus 60 minus 160. Okay, sorry. We take 7012 minus 987 minus 1264. 1264. So that will give us a figure of 4761. And then we less these two items. We less 60 and also we less 160. So we get 541. So 4541, this is what? The profits attributable to ordinary shareholders. So in our case, we already have that. So next, what we need to do is to determine the weighted average number of ordinary shares. And for us to compute this, that is the weighted average number of ordinary shares, we said we take the ordinary shares issued and fully paid at the start of the year. And this particular year, which was ending 30th September 2018, this year started on 1st of October 2018. That is when the year started, not 2018 here, but 2017. And that year ended 30th of September 2018. So therefore, to compute the one-off weighted average number of ordinary shares, we take the shares issued at the start of the year, and then we add the other shares which were issued during that particular year. In our previous session, we also discussed on how we treat the various types of shares which are issued during a certain financial year or in a certain financial year. So you have to recall what we discussed in our previous session. So what you are given, if you go to the note number 1, you're told the ordinary share capital of this company is at 1st of October 2017 here is 15 million, made up of shares of 5 shillings per value. So basically what you're given here is the share capital of the company, which was 15 million. So therefore, to compute the one-off, we take the shares issued and fully paid at the start of the year, which we are saying started on 1st of October 2017. So, and the shares issued and fully paid at the start of the year, we can refer to that as balance brought down. So what we do, we work with our figure still in thousands of shillings. So for us to be able to determine the shares issued and fully paid at the start of the year, we take the share capital, and we have to be very keen that 15 million, these are not the number of shares, because our interest here are the shares issued and fully paid at the start of the year, but this is the total value of the shares. So therefore, for us to get the shares issued and fully paid, we take 15,000 divided that with 5, which is the par value per share, and basically this should give us 3,000. So those are the shares issued and fully paid at the start. Then what we have to do is we check during this year, were there some shares which were issued? So let's check the information which are given in note number 2. You're told Dakika Limited issued 500,000 shares at full market price on 1st of January 2018. 1st January 2018. So you can see 1st January 2018 is within the first year, because here we are given information about 2 years. So you have to check whether that transaction occurred in the first year or in the second year. So therefore this one occurred during the first year, that is the 1st January 2018. So we say there was issue of shares, or basically ordinary shares, at full market price. Issue at full market price. Now, these particular shares which are issued at full market price, we said in terms of how we treat them, for the purpose of computing the basic earnings per share, we weigh them on time basis. We multiply them with the proportion of time they were held during that year. So these shares were held from January of 2018, actually 1st January, to the end of or to 30th September. So here automatically we have 9 months, because from January to the end of September, 9 months. So therefore what we need to do is to multiply these particular shares on time what? On time basis, or basically based on the proportion of time they were held during that year. So we have 500,000 times 9 divided by 12. That will give us 375. So and then from there we have the other transaction, note number 3. We are told Dakika Limited also made a right issue of 2 new ordinary shares for every 10 ordinary shares as at 1st April 2019. 1st April 2019, is it within the first year here? No, that is not within the first year, because we also have to recall we are given information for second year, which ended on 30th September 2019. That is September 2019. So therefore that transaction regarding the right issue is a transaction for the second year. For the second year. So we are going to consider that in computing the BEPS for year 2. And then note number 3 is about the preference shares. Do we consider the preference shares here in computing the basic earnings per share? No. So therefore in our case we can get now the one-offs. The one-offs by adding these two, which will give us 33.75. So in our case, it basically means now we have the 2 items which we require. We have the patos, and then we have what? The one-offs. So having that, we can then proceed and we compute the basic earnings per share, which will be equal to patos 45.41 divided that with one-offs 33.75, and that now will give us the earnings per share, the basic earnings per share. So the basic earnings per share will be 45.41 divided by 33.75, and this will give us shillings 1.345, which is shillings per share, shillings per share. So basically that is it, that what is required as far as Roman 1 is concerned. And you can see the marks which were located there are 4 marks. Mostly what will be marked here is the patos. Were you able to get that figure correctly? And also this. Were you able to determine the shares issued and fully paid at the start? And also were you able to treat or basically to deal with those particular shares issued at full market price? Basically by doing that, you get your 4 marks. You get your 4 marks. So let's move to Roman 2 of that particular question there, whereby we are required to compute the basic earnings per share for year 2, which ended 30th of September 2019. So Roman 2, BEPS, basic earnings per share, for the year which ended 30th of September 2019. So the formula for computing this remains the same. We take the patos, all of our notes. We don't need to repeat the formula because the formula is not marked. So, but what we need to do is to determine these 2 items, the patos and one-offs. So let's start by determining the patos for the second year. So the procedure is the same. Take the profit after tax minus preference dividends minus the profit attributable to ordinary shareholders. So the profit after tax, equally this one is not given, but we are going to compute it in the same way. We take the profit before interest and tax, which is given as 830, minus the finance cost or minus the interest, 1045, minus the tax charge, which is 1718, and basically that will give us the profit attributable to ordinary shareholders. Not the profit attributable to ordinary shareholders, but the profit after tax. And then to this we less the preference dividends, dividends, and also we less the profit attributable to non-controlling interest. So the preference dividends still is a figure of 60 as the first year. The profit attributable to non-controlling interest is 180. So this will give us now the patos. So let first of all we work out the profit after tax, which will be 8830 minus 1045 minus 1718, so which will give us 67, and then to that we less 60 preference dividends and profit attributable to NCI, which will give us 5827. So in our case we already have now the patos. Next we need to proceed and we determine the wanos, weighted average number of ordinary shares. So we know that the second year here started on 1st of October 2018. That is when the year started, 1st of October 2018. So what we need to do is to determine the shares issued and fully paid at the start of the second year. So this is something which the examiner will not have given you. Anytime you're given information about 2 years, is upon you to determine the shares issued and fully paid at the start of the second year. Where do you get that information? That information is not in the question. You get it from the computation you did in the previous year. So from the previous year, we know the shares which were issued and fully paid at the start were 3,000. So you take those shares, 3,000, and then you check during that year, were there other shares which were issued? Yes. So we have these shares, 375. But now what you do, you take the actual shares. The actual shares were not 375, but the actual shares were 35, because those shares as at the start of the second year will be issued and fully paid. So therefore, you take the actual shares and basically you add them to the shares issued and fully paid at the start, which will give us 35. And then you check during the second year here, was there other shares which were issued? Yes. So in note number 3, we are told on 1st of April 2019, there was a right issue. Remember, you said in our previous session that this is a very, very common concept, a very, very important concept which is tested in almost all questions for earnings per share. So, and what we said is that during a right issue, the company issues additional shares to the existing shareholders of the company at a price which is below the market price. As a result of that, we said those shares which are issued to the existing shareholders of the company, some of them are deemed to be issued free of charge, whereas others are deemed to be issued at full market price. And therefore, we said these shares issued during the right issue, we have to split them into two components, into shares issued at full market price and the shares issued free of charge. But for us to do that, we need to compute two items. Number one, we need to determine how many shares were issued by the company during the right issue. And number two, we also compute something known as theoretical ex-right price, which we said is the expected market price per share after the right issue. I gave you the formula for computing the same. So therefore, what we need to do as far as this right issue is concerned, we need to compute two items. Number one, the shares which were issued by the company during the right issue, because we are not given that. How many shares were issued during the right issue? So as per the information we have in note number 4, we are told during the right issue, the company was to issue 2 new shares. The company was to issue 2 shares for every 10 shares which were held. for every 10 shares which were held. So what we need to do is to ask ourselves, before this particular right issue was made, how many shares were held? And equally, you can't get that in the question, you can only get that from your computation. So before this right issue was made, you can see the shares which were held or which had been issued by the company were 3,500. So those are the shares which were held. So we need to determine how many shares were issued during the right issue. We cross multiply, then we divide. 2 times 3,500 divided that with 10. So this will give us 700 shares. So these are the shares issued by the company during the right issue. Those are the shares we are going to split into two components. Shares issued at full market price, shares issued free of charge. But before we do that, we need to compute something known as theoretical ex-right price. This is something which the examiner will not have given you. You have to compute that. So there is a formula which we use and which you covered in FM, Financial Management Intermediate level, but I gave a very simple approach of computing this in the previous session, because if you go back to the information which we have, there is some information or some details I want us we get there from note number 3. We are told in the last sentence of note number 3, the right price per share was 42.5. So mean that because during the right issue, the company was to issue 2 shares for every 10 shares which were held before, these 2 shares which were to be issued by the company during the right issue, each share was to be issued at 42.5. But now, the shares which were held, or basically the market price per share before the right issue was 48. So that information, we need to have it here. So and therefore, once you have that information, we said you come here and you say, before the right issue, if you held 10 shares, and each share was trading at 48, that's what we know, then during the right issue, as a shareholder of this company, you are to be issued with 2 shares. Record the shares there, 2 shares at a price of 42.5. At a price of 42.5. So basically what that means is that after the right issue, as a shareholder of this company, will be holding 12 shares. If you held 10 before, after you'll be holding 12 shares. And what will be the total market price of these 12 shares? To get the total market price of those 12 shares, we need to multiply this and this, which will give us 480, and then 2 times 42.5, which will give us 85. So and then we add the 285 plus 480, which will give us 565. So basically what that means is that after the right issue, a shareholder will be holding 12 shares, and the total market price of those 12 shares is 565. So what is our interest? Is the market price of 1 share after the right issue. So which is equal to the price of 12 shares, and then we divide that with the 12, so that we get the market price of 1 share after the right issue. So that will give us 47.083. So this is basically the theoretical ex-right price, the market price per share after the right issue. And I think having that now, what we need to do is we proceed and we split these shares into 2. The shares which were issued during the right issue, we split them into 2 components. Number 1, we determine the shares issued at full market price. And we said in terms of how we compute this, we compute, first of all, we determine the amount received by the company from the right issue, which will be equal to the shares issued during the right issue, 700, times the amount which was to be paid per share during the right issue. The shareholders were to pay 42.5. Then divide that with theoretical ex-right price, which you have computed down there, 47.0833, that is 0.83. And because these particular shares are issued at full market price, the rule is that they should be weighted on time basis. They should be multiplied with the proportion of time they were held. So these shares were held from April to September. So how many months do we have there? Those should be 6. So we have April May, June, July, August, and September. So we have 6 months out of 12. Make sure your computation there is correct. And then finally, we compute the bonus shares. Bonus shares, these are shares issued free of charge. We looked on the formula and we said we take the total number of shares which were issued during the right issue, 700, minus the shares issued at full market price. The shares issued at full market price is what we have here. Not the final answer you get here, but what you have here. In fact, just transfer this here. These are the shares issued at full market price, 700 times 42.5 divided by 47.083. And equally, we said that these particular shares, we don't weigh them on time basis. We don't weigh them on time what? Basis, because they are shares issued free of charge. Yes, so let's first of all determine the shares issued at full market price, 700 times 42.5 divided by 47.03083, which will give us 631. 631. Okay, let's take that again. So we have 700 times 42.5 divided by 47.083, okay, times, or basically divide that with 2. So that will give us 315.9. 315.9. Can we take it to as 316? Yes, let's take it as 316, and then we compute the bonus element here. So we have 700 times 42.5 divided by 47.083. Okay, and then we deduct that from 700, which will give us 68, around 68 to the nearest whole number. Remember, these shares are not weighted on time what? Basis. Yes. And I think now with that, we can be able to get the one-offs, the weighted average number of ordinary shares, by adding all what we have there, 35 plus 316 plus 68, which will give us 3884. 3884. Basically, what that means now, we have the one-offs, we have what? The patos. Having that, finally, let's compute now the BEPS, the basic earnings per share, which will be equal to the patos, profit attributable to ordinary shareholders. We divide that with the one-offs, which we have here, 3884. So this will give us what? This will give us an amount of what? That okay, that is 5827 divided by answer, which will give us 1.50. 1.5 what? 0. So that is it. Basically, that's what was required as far as that question is concerned. And how many marks were allocated in that particular question there? 6 marks. So definitely 1 mark, or basically this was one of the items to be marked there, the profit attributable to ordinary shareholders, and determining the number of ordinary shares issued and fully paid at the start of the year, and also computing the number of shares issued during the right issue, splitting them into 2 components, into shares issued at full market price, the bonus element, and also this particular price here, the theoretical exact price, mostly that is allocated a mark, because most of the students have a challenge in terms of how to compute what? That. And basically by doing that, a candidate secured how many marks? 6 marks. So therefore that is it, that what the examiner was requiring as far as that question for November 2019, question number 5A is concerned. And that is all about the computation of the basic earnings per share. So once we come back in our next session, I want us to discuss on the second type of earnings per share, the diluted earnings per share. We look on how it is computed, why companies are required to compute the diluted earnings per share. And then from there, we look on an illustration question, which is also based on a past paper question. So see you in the next session. Hi candidate, welcome to another session of manifested online classes. So in this session, I want us we continue with the topic of earnings per share, and specifically I want us we discuss on what is diluted earnings per share and the computation of the same. So diluted earnings per share, this is the earnings per share which is computed by those companies which have issued potential ordinary shares. So potential ordinary shares are what? These are those securities which will have been issued by the company at the end of the year, or contracts which the company will have entered into and which requires the company to issue ordinary shares in the future. A good example of a potential ordinary share is convertible securities like convertible debentures, or stock options which are granted to the employees and which are to be exercised in the future. Definitely, once these particular potential ordinary shares are converted into ordinary shares of the company, then the interest of the original shareholders will be diluted. And therefore, International Accounting Standard number 33 requires any company having potential ordinary shares to compute diluted earnings per share and disclose that as part of the notes together with the basic earnings per share. So therefore, it is important to note that this diluted earnings per share is only computed by those companies which have the potential ordinary share. So therefore, we can say that DEPS is computed by entities which have potential ordinary shares, potential ordinary shares, e.g. convertible debentures, comma, share or stock option, or stock options, etc. So the reason why these companies are required to compute now the diluted earnings per share is because once these potential ordinary shares are converted into ordinary shares, then the interest of the original shareholders will be what? Will be diluted. That's why we are saying is a requirement by IAS 33 for these companies to do what? To compute the diluted earnings per what? Per share. So we can say IAS 33 requires companies or entities having potential ordinary shares, that is abbreviated as POS, potential ordinary shares, IAS 33 requires entities having potential ordinary shares to compute and disclose DEPS together now with the basic earnings per share. So this diluted earnings per share, we said it must be disclosed as part of the note now to the financial statement. So therefore, any company having POS is a requirement. It has to do what? To compute and disclose what we refer as what? The diluted earnings per share. Why? This is because once the POS, the potential ordinary shares, are converted into ordinary shares, the interest of original shareholders will be diluted. Will be diluted. And therefore, by computing now the earnings per share, the diluted earnings per share, what the company will be doing, it will be communicating to the shareholders of the company of the earnings per share, or basically the effect of the earnings per share, the effect on the earnings per share once these potential ordinary shares are converted into ordinary shares. If, for example, a company has issued convertible debentures, we know that the holder of these particular debentures will convert them into ordinary shares. So once they convert them into ordinary shares, so what will be the implication of that to the earnings per share of the original shareholders? That's why we are saying that these particular companies which have potential ordinary shares is a requirement under IAS 33 for them to compute and disclose what we refer to as the diluted earnings per share, together with what? The basic earnings per what? The basic earnings per share. So how is diluted earnings per share computed? So maybe you can just look on the computation of diluted earnings per share. How do we compute the diluted earnings per share? So in computing this DEPS, we compute it, or basically it's computed on the assumption that the potential ordinary shares of the company were converted into ordinary shares. Basically what that means is that if, for instance, you're given some information, you're told the company has issued convertible debentures, then for you to compute DEPS, you do what? You assume they were converted into ordinary shares during the current year, and now you ascertain the implication, or basically the effect of that conversion of convertible debentures into ordinary shares on the earnings, or basically the profit attributable to ordinary shareholders, and also you ascertain the implication, the effect of that conversion on the weighted average number of ordinary shares. So that is very, very important, that this earnings per share is computed on an assumption that the potential ordinary shares were converted into ordinary shares. So that is maybe the first important point we can say, that DEPS is computed on the assumption that potential ordinary shares were converted into ordinary shares during the current year, during the current year. And once that particular assumption is made, then I've said that we need to ascertain, or basically an entity will need to ascertain the implication of that. If this convertible, for example, the convertible debentures were converted into ordinary shares, so what would be the implication of that, both to the profit attributable to ordinary shareholders, and also what would be the implication of that to the number of ordinary shares issued by what? By the company. Like, maybe let me just illustrate what I mean by that. Let me illustrate here. We assume that a company, or we are given some information that a company has issued, for example, 8% convertible debentures, debentures having a value of like 5 million shillings, 5 million. So for us to be able to compute now the diluted earnings per share, given such information, then what we do is that we assume that these particular convertible debentures were converted into ordinary shares during the current year. If that was the case, then that would have or that will affect the profit attributable to ordinary shareholders, and two, the number of ordinary shares issued by this company will do what? Will reduce. Sorry, will increase, that is. And therefore, what you do once you assume that this particular convertible debentures were converted into ordinary shares, you proceed, you compute two items. One, you determine something called the increase in earnings. And number two, you also determine something called the increase in number of shares. So first of all, when we talk about the increase in number of shares, we are referring to the number of ordinary shares which would have been issued by the company on the assumption that these particular convertible debentures were converted into what? Into ordinary shares during the current year. In terms of how we compute this, is very simple, because what you just do, you use the conversion rate. Use the conversion rate which is provided to you by the examiner, to compute the number of ordinary shares which would have been issued on the assumption that those particular debentures were converted into ordinary shares. Then also determine something called increase in earnings. What is increase in earnings? Increase in earnings, this refers to the amount by which the profit attributable to ordinary shareholders would have increased with, on the assumption that these particular debentures were converted into ordinary shares. And if these debentures were converted into ordinary shares, it means that the interest payable on these particular debentures, that interest would not have been paid. In other terms, the company would have saved because that interest would not have been paid. And therefore, the profit attributable to ordinary shareholders would have increased with the interest which was paid by the company during that year, interest paid. And because this particular interest paid is tax allowable, then we take that interest net of tax. So to get the interest net of tax, we multiply that with 1 minus what? Tax rate. So therefore, what we are saying here is that in computing the diluted earnings per share, we assume that the potential ordinary shares were converted into ordinary shares during the current year. Once you make that assumption, then go ahead and determine the amount by which the profit for the current year would have increased with. And number two, you determine the number of ordinary shares issued by the company would have increased with how many shares. And once you determine these two items, then you proceed and automatically compute the diluted earnings per share, of which to compute the DEPS, we take the PATOS, profit attributable to ordinary shareholders, which is used in the computation of basic earnings per share, and then to this you add the increase in earnings. Increase in earnings, I've explained what we mean by that there, and then divide that with 1, still used in the computation of basic earnings per share, and then to this you add increase in number of shares, and equally I've explained what we mean by increase in number of shares there. So that is the general formula, or basically the formula which is used in computing the DEPS. In computing what? The DEPS. Now, from there, we proceed and we look on specifically how we deal with the various types of potential ordinary shares in computation of diluted earnings per share. And I want us to start by looking on the treatment of the first type of potential ordinary share, and that is the convertible debentures, or convertible bonds, or even convertible own stock or own notes. So these ones are treated in the same way when computing the diluted earnings per share, because these are types of potential ordinary shares. So if you come across some question and you're told the company had issued convertible debentures, convertible bonds, convertible own stock, the first thing you need to recall is that this is a potential ordinary share. These are financial instruments issued by the company, which require the company to issue ordinary share in what? In the future. For you to compute the diluted earnings per share, you basically assume that this particular convertible securities were converted into ordinary shares during the current year. Once you make that assumption, then you proceed, you compute two items. The increase in earnings. This refers to the amount by which the profit for the current year would have increased with, on the assumption they were converted into ordinary shares. And in terms of how we compute this, we take the interest which was paid, or compute the interest which was paid by the company during that year, and then you multiply that interest with 1 minus tax rate. Reason being that this interest is tax allowable. That's why we are getting that interest net of what? Of tax. And then also you compute something called the increase in number of shares. Increase in number of what? Shares. So, and to compute the increase in number of shares here, I've said just use the conversion rate provided. Use conversion rate provided. Use the conversion rate which is provided. But in this case, in computing this particular increase in number of shares, it is also important to note that if these convertible securities issued by the company were outstanding at the start, meaning that these convertible securities had been issued when the year was starting, then we assume that the conversion equally would have taken place from the start of the year. And that means that those shares which would have been issued on conversion, the number of ordinary shares which would have been issued on conversion would have been held for the whole year. For the whole what? Year. So those particular shares, don't weigh them on time basis because they would have been held for the whole year. But if a convertible security was issued in course of the current year, for example, the company issued convertible securities, convertible debentures, maybe 6 months to the end of the year. 6 months to the end of the year. So in that case, we assume if they were converted into ordinary shares, they would have been converted from the date of the issue. Meaning that the number of shares which you are going to get, which would have been issued on conversion, you have to do what? You have to weigh them on time what? Basis. You have to multiply them with the proportion of time they would have been held, because automatically those shares would not have been held for the whole what? Year. They would have been held from the date of conversion, which is the date of the issue, to the end of the year. So that is how first of all we treat the convertible debentures, convertible bonds, convertible loan stock in computing the diluted earnings per share. Number two, we have convertible preference shares, preference shares. So this is still a potential ordinary share. Reason being that these preference shares are convertible, means that the holder of these particular preference shares can convert them into ordinary shares. So equally, if you come across a question, you're told a company had issued convertible preference shares, for the purpose of computing DEPS, you assume those convertible preference shares were converted into ordinary shares during the current year. As a result of that, you proceed equally compute the two items. You compute number one, increase in earnings, of which the increase in earnings here is equal to the preference dividends, paid during that year, preference dividends paid during that year. And then number two, you determine the increase in number of shares. So equally to determine this increase in number of shares, what you do, you equally use the conversion rate. Use the conversion rate provided. Use the conversion rate which is provided. And equally, what I've said here, if the convertible preference shares were issued in course or during the current financial year, you assume the conversion would have taken place from the date of the issue. Basically, what that means that the number of ordinary shares we are going to get as the one or as the shares which would have been issued on conversion, what you do, you have to weigh them on time basis. You have to multiply them with the proportion of time the shares would have been held during that year. Then let's proceed and look on how we compute or how we treat the other type of potential ordinary share in computing DEPS, and that is the share or stock options. Share or stock options. So when talk about the share or stock option, we know that this basically a privilege is a right which is given to the employees of the company to buy the company shares in the future at a price which is below the market price. Equally, in computing the diluted earnings per share, we assume that these stock options or the share options were exercised during the current year. The employees of the company bought the shares of the company during the current year, but at a price below the market price. So therefore, what you do, you equally have to proceed and you determine the two items. Number one, increase in earnings, of which the increase in earnings, as far as these potential ordinary shares are concerned, then increase in earnings is always equal to zero. Reason being that here the employees of the company are just granted an option or a right or a privilege to buy the shares of the company in the future at a price below the market price. As a result of the employees being given that right, they are not entitled to any form of return until the time they buy the shares. So therefore, even if they bought those particular shares of the company during the current year, that action by the employees will not affect the profit attributable to ordinary shareholders, simply because they are not entitled to any form of return. So by exercising that option, the company will not save anything, so the profit attributable to ordinary shareholders will not be affected. It will not increase. That's why we are saying increase in earnings for stock option is always equal to 0. And then number 2, we determine the increase in earnings. Remember, the increase in number of shares, not increase in earnings. Increase in number of shares. This one we have said refers to what? To the ordinary shares, which definitely would have been issued to the employees of the company, assuming they exercise this right, this privilege during the current year. And what we know is that if the employees exercise their option during the current year, then they would have been issued with the shares of the company at a price below the market price. So therefore, what we do here is, number 1, we determine the shares which would have been issued to the employees at full market price. That is the issue at a full market price, assuming they exercise the stock option during the current year. And in terms of how we determine these shares issued at full market price, first of all, we compute the amount which would have been received by the company from the employees, and then divide that with the average MPS, average market price per share. Now, these particular shares, because they are issued at full market price, these shares, we say they are not dilutive. Not dilutive. So not dilutive means that they do not reduce the earnings per share. These are the shares the company issue. The company receive additional resources, receive an amount of money from the employees. That money is invested. By the end of the day, the profit of the company do what? Increase. And equally here, the number of shares increases. So here we are increasing both profit and also the earnings per both the profit and the number of shares. So therefore, these shares issued at full market price, they do not reduce the earnings per share. And therefore, these shares here, for the purpose of computing the DPS, are ignored. So these shares are ignored for the purpose of computing DEPS. We don't consider them. So what we consider is now the other element, number 2. And the other element, number 2, is what? Is the bonus shares. Bonus shares. So the bonus shares, this refers to those particular shares which would have been issued to the employees of the company, assuming they exercise the stock option, the right, during the current year, but free of charge. So how do we compute this? So number 1, we take the total shares which would have been issued to them, assuming they exercise the stock option during the current year, and then deduct the shares which would have been issued to them at full market price. And the shares issued to them at full market price is computed using this formula. So we deduct issue at full market price. Now, these particular shares are the ones which are dilutive, So meaning that these shares reduces the earnings per share, because what happened here, the number of shares issued by the company increases, there is no any increase in profit. So generally, we know in computing the earnings per share, you take the profit attributable to ordinary shareholders divided that with number of ordinary shares. So here we are saying the company is just increasing the number of shares issued, but the profit remains constant. The profit does not change. What is the effect of that to the earnings per share? The earnings per share automatically will reduce. That's why we are saying those shares are dilutive. And therefore, these are the shares which are used in computation of the diluted earnings per share. So therefore, the increase in earnings here, as far as the stock or share option is concerned, we say this is equal to the bonus element or the bonus shares. So those shares which are issued free of charge are the ones which are considered here. And you also have to remember that the bonus shares, how do we compute them? We take the total shares which would have been issued to the employees, assuming they exercise the stock option during the current year, minus the issue at full market price. Full market price. And also it is important for me to mention here that this particular bonus shares, we consider them as dilutive. We don't treat them as shares issued free of charge. Here, for the purpose of computing the diluted earnings per share, we treat them as what? As dilutive number of shares. So meaning that if this particular stock option or the share option was granted to the employees during the current year, then the dilutive number of shares which you get here, which are equal to the bonus shares, those shares will also be weighted on time basis. If the share option was granted to the employees during the current what? During the current year. So that's basically how we deal with the share or the stock option. And then next we have number 4, we have partly paid shares. Partly paid shares. So partly paid shares, these are those shares issued by the company at full market price, but at the end of the year, the shares will not be fully paid. So these particular shares are only considered to be potential ordinary shares, if by the time the shares will be fully paid for, the market price per share will have increased. That is the only time we consider them to be potential ordinary shares, and therefore we use them in computing the diluted earnings per share. But if by the time the shareholders will be fully paying for these shares, the market price will not have changed, they are not considered to be potential ordinary shares. So therefore, they are only considered to be potential ordinary shares when or we can say they will only be considered to be potential ordinary shares if by the time the shares will be fully paid for, the shares will be fully paid for, the market price per share, will have increased. Market price per share will have what? Will have increased. And therefore, in such a case, what you do is that you compute those particular shares which will be issued free of charge. Because if, for example, the shares were issued to the employees, to the shareholders, or even to the members of the public at a price of like 20 shillings, and maybe at the end of the year, the shareholders will not have fully paid for their shares. Let's assume that those shares which will not be fully paid for at the end of the year are 1 million. So, but now at the time they will be paying for these shares, the market price will have increased to 40. So remember here the shareholders will still pay the price of 20 because the shares were issued to them at a price of 20. But at that time, the moment they are fully paying for their shares, the shares are trading at a price of 40. So meaning that they will pay a price which is less than the market price per share. And basically the concept for share or stock option also applies here. Some of the shares will be deemed to be issued to them at full market price, whereas other shares are deemed to be issued free of charge. So therefore, what you consider here are the shares which will be issued to them free of charge. You consider the bonus elements or the bonus shares. So in the bonus shares, the formula is just the same here. So the total shares which will be paid for, total shares to be paid for, minus the shares which will be issued at full market price. So assuming this is the information we are given, the shares now which will not have been paid for are 1 million. So these are the shares now to be paid for by the shareholders, and then to this you less the shares which will be issued to them at full market price, which will be 1 million times the amount they are going to pay per share, and then divide that with what? With 40. So these are the shares which will be issued to them at a full market price. Automatically, that means that the other shares, which I think should be what? Should be 500,000. So these particular shares will be issued to them free of charge. And these are the shares now which we consider in computing the diluted earnings per share. So therefore, as far as the partly paid shares are concerned, it is important to know that these are only considered to be potential ordinary shares if by the time the shares will be fully paid for, the market price will have increased. If that is the case, it means that the shareholders, the existing shareholders or the shareholders issued with those shares, they will pay a price which is less than the market price, and therefore you have to determine how many shares will be issued to them free of charge. And basically what you do, that is what you consider the bonus shares. And automatically here, because this we are saying is equivalent to stock option or share option, the increase in earnings for such shares, increase in earnings for such shares is always equal to zero, So finally, I want us to look on how we treat the other type of potential ordinary share, and that is the contingently issuable shares, which should be number 5. Contingently issuable shares. So this is something we defined in our first class or in our first lesson of this particular topic, and we said contingently issuable shares. These are those particular ordinary shares to be issued by the company in the future upon fulfillment of certain conditions. For example, in this case, we said the senior managers of the company can be promised to be issued with the shares either free of charge or at a little consideration upon satisfying certain conditions. And therefore, these particular shares will only be considered to be potential ordinary shares and therefore used in the computation of basic earnings per share if two criteria have been met. Number one is that the condition agreed between the company and the senior managers, that condition has been met. If the condition was that the senior managers will be issued with the shares either free of charge or at nil consideration once the profit of the company exceed a certain amount, for these shares to be considered as potential, that condition must have been met. The profit must have exceeded that particular amount. And number two, or the other criteria, is that the shares have not been issued. Shares have not been issued. And in most of the cases, because now these particular shares will be issued at a price which is below the market price, we treat these particular shares, contingently issuable shares, as an equivalent of share or stock option. So mean that in computing the diluted earnings per share, we assume that these shares were issued during the current financial year to the, for example, senior managers. As a result of that, you compute the two items, the increase in earnings, which will automatically be zero because we are saying this is equivalent to a share or stock option. Here the shares are issued to the senior managers at a price below the market price. So the increase in earnings is equal to zero. What about the increase in number of shares? Increase in number of shares is also equal to the bonus element. Those particular shares which would have been issued to the senior managers free of charge. The formula for computing the bonus element remains the same as the ones we have discussed here. So the total shares which would have been issued to the senior managers minus the shares which would have been issued to them at full market price. So basically that's how we treat different types of potential ordinary shares in the computation of diluted earnings per share. And those concepts we have discussed here are very, very important because you need to recall them in tackling any question for DEPS. So I want us to stop at that point. Once we come back in our next session, we are going to look on an illustration question which is based on a past paper question. Hi candidate, welcome to another session of Manifested Online Classes. So in this session, I want us to continue with the topic number 1, and specifically I want us to look on the subtopic of deferred tax. So this, first of all, is an extension of what you covered in financial reporting and analysis, intermediate level, where you did something to do with the accounting for current taxes and also accounting for deferred tax. So at the advanced level, you need only to cover the concept of deferred tax, but At the advanced level, also the examiner will test the concept of a group account. For example, you need to know how to compute things like the unreleased profit and so on, because the examiner may give you some goods which were maybe sold by the parent company to the subsidiary, and you're told some of the goods were not yet sold at the end of the year. So basically, you have to be able to determine the cost of those particular goods. And for you to do that, you must be in a position to determine the unreleased what? Profit. So therefore, at this level, you just need to cover the concept of deferred tax, but now with a group what? With a group aspect. Now, I want us to look on some few illustration questions, but before you do that, I want us to look on a quick recap of basically what you need to know as far as the deferred tax is concerned, so that we can be able, we can be on the same page. So first of all, a deferred tax, basically we say this is a provision created by the company during the current financial year for a tax which is supposed to be paid by the company in the future, or a tax which is supposed to be recovered by the company in what? In the future. So equally, when computing for the deferred tax or determining the amount of deferred tax which is to be provided for in the income statement, we have two approaches which may be used by an entity. Number one, we have the income statement approach, whereby the deferred tax to be charged in the income statement, to be taken into account in the income statement, is computed using something called the timing difference. The timing difference is the difference between the accounting profit and taxable profit, and which give rise to deferred tax. But now, International Accounting Standard number 12 do not recommend, do not prefer entities to use that particular word method. And therefore, the other method which is recommended by IS 12 is the balance sheet method, whereby the deferred tax is computed based on something called the temporary difference, based on something known as the temporary difference. So what is a temporary difference? A temporary difference basically is the difference between carrying amount and the tax base of the asset and what? Liability. So which in this case we have two types of deferred temporary difference. We have the taxable temporary difference and also the deductible temporary difference. Maybe you can just start our recap there. We say that deferred tax, this one, according to the balance sheet, maybe you can just say according to a balance sheet or statement of financial position approach, and which you have said is a method which is recommended by International Accounting Standard number 12. According to balance sheet or statement of financial position approach, deferred tax is computed using temporary difference. Using temporary difference, which is abbreviated as TD. And what is a temporary difference? A temporary difference, this is the difference between the tax base and the carrying amount of asset and liabilities. So temporary difference, which is abbreviated as TD, is the difference between the carrying amount, which is abbreviated by CA, and the tax base. The tax base. So when talk about the carrying amount, we have to recall what you covered in the lower level. Carrying amount is the value at which an asset or even a liability is recorded in the company's statement of financial position. For example, when talk about the carrying amount of PP, we are talking of the net book value. So on the other hand, when talk about the tax base of asset and liabilities, this is the value of an asset or liability for tax purpose. For instance, equally when talk about the tax base of the PP, we are talking of the written down value. Written down value, which is computed by taking the cost of the PP minus the total capital allowance, or minus the total wear and tear what allowance. So that is the first thing you need to recall, that what is carrying amount and also what is tax base. Now in this case, this temporary difference can either be taxable temporary difference, or deductible temporary difference. Taxable temporary difference, abbreviated as TTD. Deductible temporary difference, abbreviated as DTD. So a temporary difference is taxable whereby the carrying amount of asset or liabilities exceed the tax base. But on the other hand, if the carrying amount of an asset or liability is less than the tax base, then you get something called a deductible temporary difference. A deductible temporary difference. Now, a taxable temporary difference, this one gives rise to something called a deferred tax liability. Deferred tax liability, abbreviated as DTL. And therefore, to compute the deferred tax liability, we take the taxable temporary difference times the tax rate, abbreviated by TR. So this taxable temporary difference times what? Times the tax rate. But on the other hand, a deductible temporary difference, this one gives rise to something called the deferred tax asset. A deferred tax asset is a tax which is recoverable by the company in the future. Deductible temporary or deferred tax liability is a tax payable by the company in what? In the future. So how do we therefore compute these deferred tax asset? To compute the deferred tax asset, we take the deductible temporary difference, DTD, equally times what? Times the tax rate. Times what? The tax rate. So therefore, this is the first thing you need to recall from basically what you covered in financial reporting and analysis intermediate level. And I think with that particular small recap, we can be able to proceed and look on a question from a past paper. And basically, this is a question which was tested in the sitting of August 2022. And specifically, it is question number 2B. So we go through the question, we see what we are told, and it reads, T Limited, a public limited entity, is a holding company in a group of companies. The following transactions related to deferred tax or the foreign transactions relating to deferred tax were extracted from, for the purpose of finalizing a group financial statement for the year ended 30th April 2022. Number one, you're told T Limited own property, plant and equipment that cost shilling 625 million when purchased. Depreciation of shillings 250 million has been charged up to the reporting date of 30th April 2022. The entity has claimed a total capital allowance on property, plant and equipment of shillings 300 million. And then you're told on 30th April 2022, the property, plant and equipment was revalued at shillings 575 million. Number two, we are told on 31st of October 2021, the company completed a development project and incurred a cost of 200 million, which it capitalized in accordance with IS 38. The estimated economic useful life of the intangible asset was 5 years at 31st of October 2021. Then you're told the company obtains a full tax relief for research and development expenditure on cash paid basis. Number three, we are told during the year which ended 30th April 2022, T Limited transferred goods worth shillings 1,500 million to one of its subsidiaries. T Limited made a gross profit margin of 20% on its sales. And then you're told a third of these goods remained unsold by the subsidiary at the reporting date of 30th April 2022. And then number four, we are told the trade receivables were carried in the consolidated statement of financial position at shilling 480 million. This was after allowance for doubtful debts of shilling 60 million and unrealized foreign exchange gain of shillings 80 million. The allowance for doubtful debt and the foreign exchange gain stroke losses are only allowed for tax purpose when realized. And then you're told number five, the balance on the deferred tax liability account of T Limited as at 1st May of 2021 was shillings 25 million. And then number six, we are told the income tax rate applicable to T Limited for the year which ended 30th of April 2022 was 30%. So what are we required to do? Roman 1, compute the relevant temporary difference as at 30th April 2022. And Roman 2, we are required to prepare a deferred tax account. So basically, this is a question for deferred tax. But as you can see from the information which is provided here, this is information relating to a group of companies. That's why we are saying at this level, the questions which will be tested for deferred tax, they do have the aspect of the group. aspect of what? Of the group. So let's start with Roman 1 of that particular question, whereby the examiner was requiring the candidate to compute the relevant temporal differences. So how do we prepare these temporal differences? We need to prepare something called a segio of temporal differences, a segio of TD, temporal differences. So this, in this segio, we need to have a number of columns. So the first column here will be for the various items of asset and liabilities which are provided. And then the next column here will be for something called the carrying amount. Carrying amount abbreviated as CA. We have another column here for tax base. Tax base, and the last column here for the difference between the tax base and the carrying amount, which is the temporary difference. Also, if you check on the figures which are we are given in that particular question, those figures are in million of shillings. So we need to indicate that our figures here will be in million of shillings, in million of shillings, like that. Yes, so what we need to do, let's start with the information which is given in note 1. And in note number 1, we are given information about PP. So therefore, what we do, we first of all record that item here. We are given the item of PP, property, plant and equipment. And you're told that the cost of this property, plant and equipment was 625 million when it was purchased by the company. And then you're told it has been depreciated, or the depreciation which was charged as at 30th April of 2022 was 250 million. In other terms, this is the accumulated depreciation as at that date. And then you're told the entity has claimed a total capital allowance on property, plant and equipment of 300 million. And then you're told at the end of the current year, this particular property, plant and equipment were revalued at an amount of how much? 575. Now, as far as the PP is concerned, we are given three values there, or basically we can be able to determine three values. Number one, we can be able to determine the net book value of this PP, which will be equal to the cost minus accumulated depreciation. So the costs of this particular property, plant and equipment is 625 million, and you're given the accumulated depreciation of 250 million. So we need to get the net book value. Remember, the net book value is the same with the carrying amount, or basically, yes, this will be the same with the carrying amount. And then also we are given the revalued amount. We are told these items of PP were revalued at the end of the current year at an amount of 575 million. And also from the information which you are given in that question, we can be able to get something, or to compute something called the written down value. The written down value, this one is equal to the cost minus the total capital allowances. Capital allowances which have been claimed by the company. So we know the cost is 625 million, and then the total capital allowances claimed by this company is 300 million. So this will give us 325 million. So this 325 million, maybe to start with that, that is what if far as the carrying, not the carrying rather, this is the tax base. This is the tax what? The tax base. So the value of an asset, or basically those particular assets which qualify for capital allowance, their value for tax purpose is always equal to the written down value, which is equal to the cost minus the capital what? Allowances. So therefore 325, that is basically the tax base. Remember, the tax base is the value of an asset or liability for tax what? Purpose. So therefore, the value of these items of PP for tax purpose is written down value. What about the carrying amount? Now, for carrying amount, here we have two values. We have the net book value and the revalued amount. Now, a question arises here. Whenever the company has revalued the asset at the end of the year, those particular assets in the statement of financial position, are they supposed to be recorded there at net book value? Are they supposed to be recorded there at the revalued amount? So automatically, anytime the company revalue the asset, those assets are recorded in the statement of financial position at the revalued amount, not at the net book what? value. So therefore, the carrying amount, which is the value at which these particular items of PP will be recorded in the statement of financial position, is what? 525. So, and then what we need to do is basically to get the difference there. The difference or the temporary difference, this is equal to this minus that, which will give us to 50. And because it's a positive figure, we refer to that as taxable temporary difference. If you get a negative figure, it is a deductible temporary difference. But it's also important to note that from the information which are given here, you can see these items of PP were revalued to 575. But in this case, we have the carrying amount, or basically the net book value, I think, which we needed to compute here. So this will give us 375. So that was the net book value of these items, but they were revalued to an amount of how much? 575. Automatically, what that means is that there was a revaluation gain equal to the revalued amount, 575 million, minus the net book value, 375, and basically this should give us 200 million. So 200 million, this is a revaluation gain. And according to IS 12, anytime the company revalue items of PPE, and that give rise to a revaluation gain, then the entity should do what? Determine something called the deferred tax expense. So how is this deferred tax expense accounted for? We take the revaluation gain times the tax rate. So the revaluation gain in our case is 200 million. And then the tax rate, as per, we're given the tax rate in the additional information number 6, 30%. So this will give us 60 million. So how is this deferred tax accounted for? The deferred tax expense accounted for. This deferred tax is accounted for by debiting the account called the revaluation reserve account, and then we credit an account called the deferred tax account. So when answering, or basically when preparing the deferred tax account as required in Roman 2 of that question, that is the moment you're going to take into account that particular word, deferred tax expense. That deferred tax expense will be credited in that account. But what we need here is the carrying amount and also the tax base. So let's move to point number 2 here. And in point number 2, we are given information about the development project which was undertaken by this company, where we are told the company incurred a cost of 200 million and capitalized that cost in accordance with IS 38. So anytime the company is, for example, developing a certain product and so on, and the company has incurred some development cost, that development cost should be capitalized. In other terms, it should be treated as an asset. Now, in this case, what we need to do is to determine the carrying amount and also the tax base. Now, the carrying amount, or basically the amount at which this particular development cost will be recorded in the company statement of financial position, is always equal to the cost. So the carrying amount of this development cost is equal to the cost. This is the carrying amount is equal to the cost minus the accumulated amortization. Amortization is the amount which has been written off. So we know the cost is 200 million. And then in this case, we are told that this particular development project was completed on 31st of October 2021, meaning that this 200 million, it was capitalized from that date. Or in other terms, it was treated as an asset from 31st of October 2022. But in our case, we also know that the current year is ending on 30th of April 2022. We are told this cost was capitalized from 31st of October 2021. So how many months do we have here? So we have November, December, January, February, March, April. 1, 2, 3, 4, 5, 6. So mean that we have 6 months. Or basically this development cost was capitalized 6 months now to the end of the year. And the reason why that is important is because the amortization we are going to deduct from this particular cost will not be for the whole year, but rather it will only be for 6 months. So therefore, what we do to compute the amortization, we take the cost, which was capitalized 200 million, we divide that with the estimated useful life of this asset, which are 5 years, and then this will give us amortization for the whole year, but in our case, we are only interested with amortization for just 6 months. So this will give us 40, and then half of that is 20. So this will give us 180M. 180M is the carrying amount. What about the tax base? Tax base, in this case, is equal to the amount which will be allowed for tax purpose in the future. There is some information which you are told in this question that the company incurred this particular development cost during the current year, or basically before the end of the year, 6 months to the end of the year. And then in the last sentence, we are told the company obtained a full tax relief of research and development expenditure on cash paid basis, meaning that anytime the company has incurred development cost or even the research cost, that amount will be treated as an allowable expense once it has been paid. Once it has been what? Paid. So mean that this development cost has already been paid. Then the tax base, in this case we are saying, will be the amount which will be treated as an allowable expense in the future. And take into account the full amount has already been treated as an allowable expense. So the amount which will be treated as an allowable expense in the future will be what? 0. So therefore, that is the tax base. So we get the difference here, which is 180, still a positive, and that is a taxable temporary difference. So let's move to point number 3, where we are given some information. We are told during the year which ended 30th of April 2022, T Limited transferred some goods worth 1,500 million to one of its subsidiary, and then you're told T Limited made a gross profit margin of 20% on its what? Sales, and then you're told a third of these goods remained unsold by the subsidiary at the reporting date. Now, from that particular point, what our interest is the inventory. Basically, what we know is that, or what you're told is that the parent company, which is T, sold some goods now to the subsidiary, and basically some of those particular goods had not been sold to third parties. So meaning that some of the goods remained in the inventory, or were part of the closing inventory of the subsidiary. That is our interest here. How much goods were not yet sold by the subsidiary at the end of the year? And in this case, we can be able to determine their value because here we are told the goods which were transferred by the parent to the subsidiary, they had a value of 1,500 million, but now the goods not yet sold at the end of the year, we are told they were a third. A third of that is what? Is 500 million. So this particular 500 million is basically the cost to this company. Is the cost to this what? To this company. But now what we know is that these particular goods have an element of unrealized profit. Have an element of unrealized what? Profit. So what we need to do is basically we take 500 million, we less the unrealized profit. How do we less the unrealized profit? The unrealized profit, this one is computed by taking the unsold goods. The unsold goods 500 million, 500 million times the gross profit margin. That is how we compute the unrealized profit from what you have covered in the topic of group accounts. So what we do, we take 500 million minus the unrealized profit, which will be equal to unsold goods 500 million times the gross profit margin. The gross profit margin in our case we are told is 20%. So this will give us 100. So 100 million. So therefore, this will give us for what? This will give us for 400 million. 400 what? Million. So this particular 400 million is basically the cost. And basically what we know is that anytime a company is preparing, or even a group of companies preparing the consolidated statement of financial position, the inventory should be recorded there, mostly at the level of the net realizable value and the cost. So we know the selling price is 500 million, but the cost is what? Is 400 million. So therefore, this particular good here will be recorded in the statement of financial position at what? at that particular amount which you have computed there. So therefore, in our case, we have the tax base, which is now 500 million. But we have said in the statement of financial position, this particular inventory will be stated there at what? At the cost, which is 400 million. And basically, we get the difference, this minus this, which will give us 100 million. And because it's a negative, that is a deductible temporary difference. Deductible temporary difference. So we are through with point number 3. Let's move to point number 4, where we have information about the trade receivables. The trade receivables. So for the trade receivables, we are already given the carrying amount. The amount at which the receivables are carried is the statement of financial position. No problem with that, which is 480. But we are told this figure was arrived at by this group of companies after making allowance for doubtful debt of 60 million and including unrealized foreign exchange gain of what? Of 80 million. Now, for you to be able to know how to determine the tax base of the trade receivables is always equal to the gross amount, because now what you are given here for 80 is the net amount. So this net amount of 480, is arrived at by the company after having deducted a provision for doubtful debt of 60 million, and also after including 80 million, which is unrealized, unrealized foreign exchange gain, unrealized forex what? Forex gain. So this unrealized forex gain is like an accrued income. It has been added in arriving at the figure of 480. So how do we get the gross amount? Because we are saying this is a net. Whatever you have here is a net. And we are saying that the tax base of receivables is always equal to the gross amount. So the gross amount in this case will be equal to 480. And then we add what has been deducted, 60, and then we less 80, which has been what? Added there. So that is how we arrive at the gross amount, which you are saying is what? Is the tax base. So this is like 480, and then we deduct 20, which will give us 460. So 460 in our case is what? Is the tax base. Yes. So I think we are done with that point. And then in point number 5, we are given the deferred tax liability at the start of the year, which we are going to use in Roman 2, and also in part 6, number 6, we are given the tax rate. So tax rate, basically, we are going to use it here. So therefore, what we need to do, we get the difference, this minus this, which will give us 20, a positive, and is a positive, so mean that is a taxable temporary difference. So take into account we don't have anything else or any other item of asset or liability which you are provided with. So what we need to do is basically to get the net amount here. So we add off that. We see what it will give us. So we have what? We have 250 plus 180 will give us 350, which is a positive figure, and we refer to this as net taxable temporary difference. Difference. So that is it, that what was required in part A of that particular question. And basically by doing that, the marks allocated there were 6. And generally what is marked in such a question are these figures here. These are the figures which are marked. Basically by doing that, a candidate was supposed to get 6 marks. So let's move to Roman 2 of the question. And in Roman 2, we are required to prepare the deferred tax account. Deferred tax account. Deferred tax account. So this one is basically quite simple. Because what we first of all record here is the deferred tax asset or deferred tax liability at the start of the year. And if we go back to the information we have in note number 5, we are told the balance on the deferred tax liability account of this group at the start of the year was 25 million. So I hope you can see we are told that is a deferred tax liability. So, and because it's a deferred tax liability, we record it as the opening balance in this account. On which side? On the credit side, because we know all liabilities have an opening credit balance. So the balance brought down is 125 25 million. There is also something else we also need to remember here. Okay, before we record this item here, remember there is an item which we said will be recorded in this account here, this one. So before we record that item, so first of all, we need to determine the amount of deferred tax at the end of the year. And take into account at the end of the year, there was a net taxable temporary difference. You have to recall what we said here, that a taxable temporary difference give rise to something called a deferred tax liability. So what we need to do is to compute the amount of deferred tax liability at the end of the year, which is computed by taking the taxable temporary difference, which is 350 million. We multiply that with what? With the tax rate. Tax rate we know is 30%. So this will give us now the deferred tax liability at the end of the year. So we have 350 times 30%, and that will give us 105 million. 105 million. So this is the deferred tax liability at the end of the year. And such deferred tax liability at the end of the year, we record it on the debit side of this account, but down here. So the deferred tax liability at the end of the year is 105 million. So the other item which we need to record is what we have here, the deferred tax expense on revaluation gain, which we said in the deferred tax account will be that will be what? Credited. So we have the deferred tax expense